Welcome to the second day of Financial Inclusion Statistics Conference. Good afternoon, good evening, wherever you also may be joining us. We are the Kenya School of Monetary Studies for the live event. And for the virtual attendees, we live here with us, joining us through our YouTube channel and the link provided. I'll ask that we start with the national anthem, the Kenya national anthem, and then the East Africa Community Anthem. Thank you.
Mungu twaomba uilinde Jumuiya Afrika Mashariki, tuwezeshe kuishi kwa amani, tutimize na malengo yetu. Jumuiya yetu sote tuilinde, tuwajibike, tuimarike, umoja wetu ni nguzo yetu, idumu jumuiya yetu. Uzalendo pia mshikamano iwe msingi wa umoja wetu, na tulinde uhuru na amani, mila zetu na desturi zetu. Jumuiya yetu sote tuilinde, tuwajibike, tuimarike, umoja wetu ni nguzo yetu, idumu jumuiya yetu. Viwandani na hata mashambani, tufanye kazi sote kwa makini, tujitoe kwa hali na mali, tuijenge jumuiya bora. Jumuiya yetu sote tuilinde, tuwajibike, tuimarike, umoja wetu ni nguzo yetu, idumu jumuiya yetu.
Thank you. Thank you very much. So on this second day, we are looking at how financial inclusion is supporting economic growth, economic opportunities and livelihoods, and also from a regulatory perspective. And as was highlighted yesterday, this conference is organized as a collaboration between Central Bank of Kenya, Kenya National Bureau of Statistics, and Financial Sector Deepening Trust, Kenya. So to start us off, we'll start with remarks from the three institutions, and I'll ask James Kashangaki from FSD Kenya to come and give his remarks. After which we'll have Colin Somondi and Robert Mudida from Central Bank. Thank you. My name is Tabitha Mwangi from Kenya National Bureau of Statistics, Macroeconomic Statistics. Thank you.
Thank you very much, Tabitha. I suppose I should introduce myself. My name is James Kashangaki. I'm the Chief Program Officer at FSD Kenya. And I've been asked to deliver our remarks to this conference. to the colleagues who will present after me, Mr. Collins Omondi and Professor Mudida, other distinguished guests, ladies and gentlemen, I'm going to say all protocols observed. The Financial Sector Deepening Trust is privileged to be part of this research conference, and that over the years we could play a small part in a fruitful partnership with the Central Bank of Kenya and the Kenya National Bureau of Statistics in designing and conducting the FinAccess survey. Since 2005, the FinAccess survey has been successfully conducted 6 times, and with the latest version being in 2021. The FinAccess survey is as old as FSD Kenya itself. And the insights from each successive survey have informed our work over the years. It is therefore no coincidence that we are implementing our 6th strategy. More than being useful for our work, the survey has been instrumental in supporting Kenya's financial sector in the journey to making Kenya an international example of increasing inclusion through the provision of useful solutions to all segments of the Kenyan population. Over the survey's life, financial inclusion has increased from 26% in 2006 to 86% now. This is of the adult population. FinAccess started as a partnership between policymakers, development actors, and the private sector to provide the evidence base that would guide market development over time. Since 2006, the survey has been carried out every 2 to 3 years, the last one being in 2021. All surveys prior to 2021 were conducted based on the old pre-2010 constitution provinces. The 2021 survey was the first that was done at a county level. It is hoped that this will enable the counties to pursue policies that will increase usage of safe and affordable finance for those Kenyans sadly still left behind. The survey has borne witness to the transformation of Kenya's financial inclusion landscape and its increasing formalization underpinned by digital technology. At the same time, the survey is one of the few data sources that highlights the continued use and importance of informal services like chamas, table banking, and investment groups, indicating the increasing richness of Kenya's individual financial portfolios. And now a few words on FSD Kenya's new strategy, 2022 to 2026. Given the success of the financial access and inclusion journey, many would conclude that the need for an organization like FSD Kenya has passed. However, despite this progress, the survey highlights persistent pockets of exclusion, which is of concern, especially given the growing importance of formal accounts for accessing goods and services. Many women and youth lack the tools to access and make use of these appropriate forms of finance. Along with the changing financial landscape, our thinking has evolved. In the early days, FSD was concerned to expand access to financial services as a key element of household welfare and growth. As the years went on, we became increasingly interested in usage patterns and behavior. For example, it is not much use to have access to M-Pesa if it is too costly to use it more than once or twice a month. More recently, we have become concerned with the quality of financial services and ensuring that consumers are protected. As we come to the present, we have turned our attention to not just to expanding financial access, but to questioning the relevance and impact of finance in improving household welfare and growth. Indeed, the 2021 survey showed that while formal financial inclusion has grown, financial health has gone down. FSD's objective in its current strategy is to promote a financial system that increasingly delivers value for a green and inclusive digital economy while improving financial health and capability for women and micro and small enterprises. The objective statement I have just read reveals FSD's 4 strategic drivers, namely gender, MSME, environment, and digital. The focus of our strategy is on catalyzing value-enhancing solutions in the areas of agriculture and food processing, housing, affordable housing, health, trade, and green finance. FSD's efforts to catalyze sustainable solutions are anchored in an effective policy and regulatory environment, as well as open financial market infrastructure. In conclusion, FSD Kenya's work is 100% built on evidence, and this research conference is a major milestone for us in understanding and exploring the interesting insights and ideas emerging that will support a more inclusive financial system that ensures all citizens thrive as they live life. We look forward to the sessions today and tomorrow, as well as the launch of the 2022 Financial County Report on Friday, the very first since the start of the surveys. We encourage all here physically or joining the proceeds online to get involved fully through your questions, challenges, and contributions. Thank you and enjoy the day.
Thank you. I will request Mr. Simon Gaido to come and give the remarks, the director. So Simon Gaido is a senior manager in charge of external sector, government finance statistics and monitoring financial statistics. Thank you.
Thank you very much, Tabitha. Tabitha is my colleague at the Kenya National Bureau of Statistics. And as she has rightfully put it, I'm here to represent the Director, Macroeconomic Statistics, Collins Omondi, who would not have been with us here today. He's in another engagement. So for that reason, I will just read the statement on his behalf. So, distinguished guests, distinguished participants, ladies and gentlemen, all protocols observed. As set out in the theme for the conference, the main purpose of our gathering here today is to reflect on the use of financial inclusion statistics in informing policy and in creation of economic opportunities. As we do this, I'm delighted to know that this has resulted from findings of a series of in-access surveys which were carried out from 2006 to 2021, as the previous speaker has observed. And out of these series of surveys, there are some basic reports which one can find in the websites of the partner institutions, that is KNBS, CBK, FSD. And inside those basic reports is useful information on the access, usage, quality, and impact of financial and related products and services in the economy. I want to point out that the 2021 FinAccess Household Survey in particular was conducted between June and September 2021, and the report was launched in 15 December 2021. The results indicate that the country has made significant progress in the issue of financial inclusion, particularly with the access to formal financial services and products, expanding significantly from 2006 to the level of 83.7% in 2021. And the report notes that the increase was mainly on account of rapid adoption of financial technology and innovations, especially in the mobile technology and mobile banking. I also want to point out that every year, Kenya National Bureau of Statistics publishes the annual economic survey report, which presents the GDP growth rates, levels of employment, inflation, balance of payments, money supply, and other macroeconomic indicators. And then I wish to point out that for these indicators to look good and for the country to achieve targets in the Vision 2030, the medium-term MTP, party manifestos, and other policy documents, citizens must be exposed to continuously improved access and usage to quality finance products and services. So for that matter, this 3-day conference is an opportunity for participants to discuss financial inclusion related issues, having in mind the way they contribute to the GDP growth and to the general macroeconomic performance of the economy. I'm therefore delighted to note that today and tomorrow, there will be sessions to discuss financing of economic sectors, the extent financial inclusion has enabled economic opportunities, financial statistics, the way they inform broad-based financial inclusion policies, the extent Kenya's financial inclusion journey has been fair, inclusive, and value-adding, the link between the climate, environment, financial inclusion, and whether Kenya's financial sector is serving women. Yeah, I know that yesterday there were some papers that were presented at the University of Nairobi, and one of the findings was analysis of the FinAccess findings on gender issues. And I remember very well there were some gender disparities in the way, in the access, usage, and so on of these products and services. So I hope some of these issues will be addressed in the sessions that are coming, especially this one on whether Kenya's financial sector is serving women. Then I'm also delighted to know that there will be a presentation on key highlights from County FinAccess Survey report, as well as award of Financial Inclusion Research Prize during the last day of this conference. Again, here I want to point out that this has been further work over and above the basic report that covers now the country, the whole country. There has been some further disaggregation to look into the county's perspectives in terms of these dimensions of the access, usage, quality, and impact of financial products and services. And this workshop will present an opportunity to launch that report. And on Friday, this is going to be done. And then, of course, out of the work, research work that has been done, there will also be award of prizes, and this will happen on Friday. So, in a nutshell, we know that this will be a useful workshop or forum to link now what the previous speaker has noted, the surveillance results from the FinAccess survey, and the issue of policy formulation, and of course also the monitoring and evaluation of existing policies, so that we see where we are as a country. So with these few remarks, I wish you enjoy the participation in this workshop. Thank you.
Thank you. for the comments. At this time, we would want to have the opening remarks from Professor Robert Mudida, who's the Director of Research of the Central Bank, and so that you can have can hear from the Central Bank perspective what is expected and how you can go enjoy with the conference. Welcome, Professor.
Thank you so much, Tabitha. So the CEOs present, financial sector regulators, our partners, the Kenya National Bureau of Statistics and FSD Kenya, researchers, faculty, students, and all participants in person and virtual, county government representatives present, and also country government representatives, global participants in particular, Alliance for Financial Inclusion, my colleagues present, ladies and gentlemen. So good morning, good afternoon, and good evening, depending on where you are. All right? So yesterday, we had a very engaging intellectual discourse in the first part of this conference that was held at the University of Nairobi at the Confucius Institute. And this was one of the first value creation activities derived from the FinAccess survey data sets generated through this very vibrant partnership between the Central Bank of Kenya, KNBS, and Financial Sector Deepening Trust Kenya, as well as other regulators and private sector players in the financial sector. So allow me, ladies and gentlemen, first of all, to appreciate the immense effort and sacrifice by the team from all three institutions. They've really worked tirelessly in the last few months to make this conference a reality. Being the first event of its kind, the Financial Inclusion Statistics Conference, November 8th to 11th, has so far proved extremely worthwhile. And I think those who were there yesterday, already you could sense the dynamism and excitement that there was there. I also wish to thank all the participants who accepted our invitation, panelists in the different thematic areas and papers, and all those involved in the entire preparatory stages of the conference. I observed a lot of this sort of preparatory work personally, and I must say I was very impressed by how the teams coordinated and the many, many late hours that they put in. So very, very excited that this actually has materialized. So this conference, ladies and gentlemen, was conceptualized close to 9 months ago, following the successful launch of the top-line findings of the 2021 FinAccess Household Survey on December 15th, 2021. That itself was quite a journey, eh? So we were very excited when it came to an end and the survey was launched. As the report generated more interest with many media commentaries and discussions in different arenas, the question arose with the three institutions and questions related to deeper understanding arose. More specifically, what value indeed underlies these massive data sets? This prompted the need to commission deep dive studies from seasoned researchers to unravel what underpins the data sets. So just as we looked at the top line findings, there are many, many interesting areas that came out, and we saw that this should be interrogated further. We should get more insights into this. There are further nuances that could actually be explored. So this conference therefore provides an opportunity to discuss the research findings from these studies for regulators, development partners, and private sector players to appreciate how much value each institution can gain by sifting through the data sets. I look at the theme of this conference, leveraging financial inclusion, statistics for policy and creation of opportunities, inspires one to appreciate the role of quality statistics to influence policy by enabling evidence-based research. I remember how when I spent my years in the academia before I joined the central bank, I always used to dream of this, this notion that policy could be influenced by research and be much more evidence-based. So I'm so happy when I see this being realized. For those participating in financial inclusion events for the first time, where high-quality researchers present their research findings, it is essential to provide some background information. The CBK, together with KNBS and FSD Kenya, have been generous enough to provide high-quality demand data sets to measure the financial inclusion landscape among households in Kenya. As a result, FinAccess household surveys undertaken every 2 to 3 years since 2006, aimed at measuring trends and dynamics in financial inclusion and the ecosystem as a result of technological innovations, changing demographics and consumer behavior, policy changes, and even economic shocks to consumers. In fact, this time, in the latest version, there's been a lot of discussion about financial health and the conceptual issues related to improving that particular index. So this particular data set is much more interesting in that sense and much more versatile. The indicators used are assessed along the dimensions of access, usage, quality, and impact of financial inclusion and how these affect the lives and well-beings of Kenyans. The 2021 FinAccess survey, launched in December 2021, for the first time measured these indicators across all the 47 counties, thus bringing out uniqueness and challenges affecting the different counties. And I must say that this is one of the really exciting trends of the last few years, when we have now county-level data, so that you're able to see across counties what happens, and very critically, these data sets are now emerging over time. So you're able to have a panel, and you can see the dynamic development of these particular trends. This was not largely unavailable just a few years ago. So this particular collaboration contributes to that, to that understanding at county level, and I think that's a tremendous milestone, I must say, in this particular regard. So this particular county perspective survey will be launched on November 11th, this Friday. You don't have to wait too long. That's just in a couple of days. And I urge all of you to get a copy and really look at it and study it, because I think it gives some really sort of insightful ideas. The report also focused more on the quality of financial services and products by providers, as well as the impact on welfare derived from using such services and products. Measurement of the latter dimension has raised policy discussions on the relationship between financial inclusion, financial health, and financial consumer protection, each proxied by a composite index. And you know, often as researchers, we're concerned, being in the development space in one area or another, we're very concerned about impact of our work on the quality of life of citizens of a particular country. So this again is a very critical step in that direction. So I'm happy that a lot of the research output to be presented will attempt to disentangle some of these concepts further. Besides, the Commission deep dive studies whose findings were presented, there are also tracker surveys on MSMEs, and now this FinAccess survey county report that I mentioned. This development has created vibrant research that is now getting into the public domain. Ladies and gentlemen, the program of this conference covers very interesting papers that would try to answer many research questions, in particular the questions related to climate-related finance, consumer protection issues, digitalization, consumer behavior, and even implied barriers to financial inclusion. I want to ask this conference the same questions that I raised in the student seminar yesterday, where I was very privileged to be as well. Firstly, why is there still a large proportion of the adult population in Kenya that's still excluded from any form of financial services, despite Kenya having had a head start in adopting technical innovations? What is it that we are not seeing that researchers could bring out? How can we work towards this 100% financial inclusivity? Secondly, what is the future of traditional banking and use of cash in the economy? Is digital finance the new normal in driving the economy? You can imagine in central banks we think a lot about this, because we're very concerned as well and sort of very interested in these developments and the trends that we have there. But of course it's also of interest to the wider research community. Thirdly, is the population well prepared to use financial services and products responsibly? Who is taking care of the vulnerable in the use of financial services and products? Of course, with economic shocks occasioned by the COVID-19 pandemic, there was increasing, let's say, increasing interest and increasing concern about vulnerable members of the population. That brought it out much more to the fore than probably even had been the case before. And now we're continuing this kind of assessment through research. And then fourthly, the nexus between financial inclusion and financial health exposition to rigorous research inquiry to inform policy and industry players as they continue to shape the future of the financial sector ecosystem in serving households and the overall economy. I trust that over the next 2 days, this conference will shed light on some of the answers to these questions, while others might require further research. So as you're discussing one set of research papers and findings, you find new questions emerge in that particular discussion. I'm sure that's going to happen. So I know we'll have a very interesting series of papers maybe emerging over the next few months that will actually arise directly from questions and discussions that we've had in this particular conference. So I challenge all of you to present in this room and those following us online to access the FinAccess datasets available on the KNBS, CBK, and FSD Kenya websites, and to conduct further research on these and many other areas, not probably specifically covered at this conference, but where there might be some insights gained. By these opening remarks, ladies and gentlemen, it's an honor to declare this conference officially open, and I wish you very fruitful discussions and deliberations in the quest of new knowledge. Thank you.
Thank you, Professor. Yeah, we are challenged to go beyond the 83.7% of access to financial for inclusion and look at the 4 questions that have been raised. And that is what we intend to do in this conference. I ask the people online to follow us and give their comments and follow the conversation at KNBS Stats, FSDKE, and at CBK Kenya on Twitter. So the program for today is looking at how we finance economic sectors, to what extent financial inclusion has enabled economic opportunities, and the issue of a broad-based financial inclusion in terms of regulation. So we'll start off with the first session on financing economic sectors, and I'll ask David Sandagi to come and lead us in moderating that session going forward. David Sandagi is the Acting Manager Compliance from SASRA, SACCO Societies Regulatory Authority. Welcome.
Right. Thank you, Tabitha, for those introductory remarks. Ladies and gentlemen, distinguished participants, to all the CEOs present, good morning. Indeed, it is my singular role this morning to chaperone us through the first session of the day, which ideally needs to focus on financing economic sectors. As was initially planned, we have envisaged to have 3 institutions participating in this session. That is the Kenya Deposit Insurance Corporation, the Agricultural Finance Corporation, as well as GSMA mobile program. We wish to register apologies indeed from the Kenya Deposit Insurance Corporation, as well as the Agricultural Finance Corporation, who seem to have had other engagements and hence kindly accept their apologies in being unavailable for this session. To start us off, indeed, we will have a presentation by Mary Gishuki, who is the Advocacy Manager for GSMA Mobile Money Program. And the focus of the discussion will be on the role of financial inclusion statistics in digital finance. I shall take this opportunity indeed as well to introduce you to Ms. Mary Gishuki. Mary Gishuki is a seasoned telecommunications and financial services policy expert. She has worked in the technology and telecom space for more than 7 years. She is currently the advocacy manager within the mobile money program at the GSMA. I think the question we have then really is, what is GSMA? This is a global organization unifying the mobile ecosystem to discover, develop, and deliver innovation, innovation and foundation to positive business environments and societal change. Under the Mobile Money Program, Mary works with international organizations and other policymakers to inform and advocate for enabling policy intervention in the digital finance ecosystem. Mary has been at the forefront of the development and formulation of ICT and financial sector policies and regulations, such as data protection regulations, consumer protection policies and guidelines, to promote a sustainable ecosystem for technology and telecom companies. We appreciate Mary Gishuki and acknowledge the wealth, breadth, and depth of your experience and exposure. So it is my pleasure to invite you, Mary, to take us through the session on the role of financial inclusion statistics in digital finance. So welcome, Mary.
Anthropological project had as its first objective trying to understand how people use mobile phones here in Western Kenya.
M-Pesa is a mobile money sending service that was introduced in Kenya in 2007. Since then, it has become extremely popular. Many development economists approach the study of mobile money from a financial inclusion perspective. This project takes an anthropological approach. It sees the practices of mobile money as a part of an existing social and cultural background. This area is a rapidly changing but still predominantly rural area.
People are involved in agriculture, but also many other ways of making a living. Trading, having small shops.
One important source of income is mobile money remittances. Remittances have a variety of purposes in Western Kenya.
Ebulwale nalwala eja nanyolekana nda accident mala omundu wandumala chisende narumisila kaba japu niye wandumala mala chanjenda.
Kama ukitaka kununua ng'ombe ama kujenga nyumba, ani shughuli kubwa kubwa, ama mtu amekosa school fees.
Just some slight technical issues, but we've been able to sort them out. So thank you, David, for the warm introduction. Ladies and gentlemen, all protocols observed, good morning. As David mentioned, I'll be discussing about the role of financial inclusion statistics in digital finance. But before I start, I would like to highlight some troubling statistics that I found out yesterday. So apparently 63% of baby boomers are moving towards retirement without enough money to put aside to provide for themselves for as long as they're going to live. I don't know what the numbers are in Kenya because this is American numbers. And I've used the word apparently because I cannot ascertain the data source. But that's something for us to think about. Anyway, so to start us off, I'll be looking at, I'll do a brief introduction of what is financial inclusion. And basically, financial inclusion refers to the state in which all people who can use financial services have access to a full range of quality financial products and services provided, but this needs to be provided at affordable price, conveniently, and with dignity for the client. The Alliance for Financial Inclusion gives us another definition on what digital financial inclusion refers to. And this is using and promoting digital financial services to advance financial inclusion. What does this mean? This means that payments, transactions, including savings, credit, and insurance, are delivered with using a digital financial platform in a responsible, safe, and a sustainable way. The World Bank has identified financial inclusion as a key enabler of 7 out of the 17 SDGs. At the same time, we see that mobile money contributes to 13 out of the 17 SDGs. So access to transaction ideally is seen as the first step towards greater financial inclusion because it allows people to store money and send and receive payments. All transaction accounts serve as a gateway to other financial services. So ensuring that people worldwide have access to one remains a key priority to all stakeholders and is among the main drivers for digital financial services. We see that evidence suggests that households and businesses with access to financial services are actually more resilient to financial shocks than those without. The ability to store and send and receive funds enables account holders to invest in health, education, businesses, regardless of whether their accounts are held with a bank or regulated institutions, such as a credit union, microfinance, or mobile money service providers. So I'll look at the contribution of mobile money. We see that the data from the Global Financial Inclusion tells us that savings in Kenya has actually become a trend where we have 33% of Kenyans saving any form of money. This is followed by 22% who are saving at financial institution or using mobile money accounts, while 18% are saving using a mobile money account. And 16% goes to actually the use of clubs or persons outside the family. This is a good number, but I believe more still needs to be done. And the fact that there's still an increase in savings towards a mobile money wallet is a positive. So what has been the contribution of mobile money to financial inclusion? Digital financial services such as mobile money accounts have enabled users to store funds, as we've seen, cheaply and securely, and to transfer them rapidly over the great distance. This has increased domestic remittance and consumption. During the COVID-19 pandemic, we highly evidenced this because in terms of the value of digitized currency via mobile money agent networks grew by 18% in 2021, reaching a total of 216 billion annually, or more than 715 million daily. So that's the growth that we experience. There was also a rise in the trend where more cash was converted into e-money, and this either continued to be circulated or was used digitally or spent digitally than being cashed out. So in a nutshell, for every $3 that was cashed in, only $2 was cashed out, and this actually presents a 25% drop from 2012, where for every dollar that was cashed in, $0.88 was cashed out. A study conducted in Kenya in 2019 discovered that mobile money users who experienced an unexpected drop in income were able to receive money from a more geographical dispersed social network of family and friends and did not have to reduce household spending. A second study that compared the development outcomes of women in regions where mobile money accounts were rapidly prevalent, the development outcomes of women compared to the development of outcome in regions where mobile money accounts were not rapidly adopted, the women in the regions where there was high prevalence of mobile money, 9% fewer women lived in poverty, and their consumption also increased by 18.5% compared to the latter. So what is digital financial what is the state of digital financial inclusion in Kenya? I'll go to the first slide where we look at the trends, the financial inclusion trends in Kenya. So I got this data from a Deloitte Insights paper. However, this is aligned with the Fin Access data report that came out. So from this, we see that 83.4% of the Kenyans have formal access, while 4.7% of Kenyans have informal access, which leaves an 11.6% of Kenyans being excluded. Out of the 83.7% with formal access, 81.4% of them use mobile money, and this is a 53.5% increase since 2009. What this data shows is that there's an increase in mobile money service uptake compared to other financial services. However, there's a need for us to invest in the industry in order to enhance security and increase trust in the use of mobile money and other digital financial solutions. As we look at these numbers and we see there's a growing trend in terms of mobile money, we still have a section of Kenyans who actually do not have a mobile money account. And if you go to the chart on the second chart, 53, ideally, so again, looking at the global financial inclusion data, we see that 56.33% of Kenyans who do not have mobile money accounts give the reasons that they do not have mobile money account is because they do not have enough money to use mobile money. So they lack the funds to actually use mobile money. They also, 45.88% say the reason they do not have a mobile money account is because they do not own their own mobile money phone. And then 32.02% say they do not own a mobile money account because they do not have the necessary documentation needed, while 25.93% do not see the need of it as they use available mobile money, they use agents and someone else to make payments. So this is 22.42%. The 25.93%, they say the reason they do not use or do not have a mobile money account is because the mobile money products are too expensive. So these are numbers that we need to really look at and ask ourselves, how can we address this challenge to have more people included into the financial services? So I'll give a snapshot of what all this means. These figures demonstrate that mobile money is critical tool for increasing access and closing the financial inclusion gap. However, more needs to be done to improve the mobile money landscape and empower people to feel confident enough to use their mobile money accounts. Industry stakeholders must collaborate to create sustainable, reliable, and safe digital financial system. There's a continued need for more enabling regulatory intervention, especially when it comes to addressing the lack of necessary documentation, as seen in the numbers we've seen, and frameworks to increase access, drive uptake, and safe use of digital financial services. Investment in financial literacy and financial health initiatives is also something we need to start considering. That mobile money can be used as a tool to help the country's economic growth agenda, and there's still room for all stakeholders to improve the use, drive uptake, and adoption of mobile money. So what is the role of financial inclusion statistics in digital finance? With the overarching principle of big data plus analytics equals to insights, which equals to financial footprint, I take note of the fact that providing everyone with sustainable and appropriate financial services, inclusive digital activity, can bring a new generation of data footprints. Digital financial services companies have one leg lodged firmly in the financial system, and the other building on digital intelligence. As mentioned earlier, financial statistics data has been a critical driver of the digital financial industry. This is because the data has been used to inform the development and formulation of industry policies, the development of products and services, to drive the adoption of global standards and best practices, to encourage greater collaboration and development of industry-led initiatives. The data has also been used as an industry yardstick for players to measure themselves against global standards and market forces, to analyze and understand where providers are lagging, especially in addressing consumer needs. In conclusion, I know that effective financial inclusion will still remain critical, especially in low middle income economies, which are working hard to uplift the welfare of all citizens within their borders. In Kenya, the discussion around financial inclusion has been highly data-driven, and now we have gotten to the point where we have to think about going beyond financial inclusion. By addressing the new phenomena which we are actually currently seeing, which is financial health and financial literacy. As we've seen from the latest financial health report, financial inclusion doesn't necessarily translate to financial health. This conversation should ideally not be addressed by one stakeholders, but by all the stakeholders. Now more than ever, all industry players need to collaborate more in addressing these new challenges, just as it has been while addressing the financial inclusion gap. However, even as we sit here today and talk about the use of statistical data and its attribution in driving decision making, let's not forget the importance of conducting this analysis within the confines of the laid out regulations on data protection laws and principles, and also ensuring that you're protecting the consumer. As the GSMA, the critical role we play in guiding the industry is why we use the data to advise and inform our members about existing opportunities and to promote the safe and sustainable adoption and use of digital financial services. We've developed several statistical reports, such as the state of the industry, the Mobile Money Prevalence Index, the Mobile Gender Gap Report, the Financial Health Report, and other based on industry data from a global perspective. This has been done to create value for our members and support the industry's sustainable growth. We'll continue to share the insights gleaned from the data in our various research products, conduct evidence-based engagement, and focus on data-driven advocacy. We applaud the work that the Central Bank of Kenya, the Kenya National Bureau of Statistics, and FSD Kenya are doing in conducting surveys and using this data to inform policy. By working with the mobile money industry to understand their challenges and enabling Kenya digital financial ecosystem to grow, we can see the impact delivered by more digital financial services, especially mobile money. There's still more work to be done, and we urge the government to continue assisting the industry in driving this forward through collaboration and implementing favorable policies. Thank you.
Thank you very much, Mary, for the very insightful presentation. I'm sure, all of us have really, gotten to appreciate, from a very insightful point of view, the hindrances that really, prevent, uptake of mobile money, literally from the pinnacle of the role of financial inclusion, statistics in digital finance. I believe Mary deserves another round of applause, ladies and gentlemen. We at this juncture then take it out to the floor to perhaps, take a deep dive into the presentation as has been given. And we then request your questions, comments, or otherwise to Mary as she's here on the basis of the presentation that she's made. So we could take perhaps 10 or so minutes, dependent, of course, on the kind of, engagements that we'll have from the floor to really engage Mary as appropriate. So we open it up to yourselves to engage Mary on the presentation as she has given.
Thank you. James Kashingaki from FSD Kenya. I just want a point of clarification because I'm aware that there may be members of the press here and they may put out a statistic. You said, what is the percentage of Kenyans that don't have a mobile money account? Because I think somewhere in there you said 53%, and doesn't seem to be true.
So, again, as mentioned, this data came from the World Bank data sets, and let me just give you the total number. But then we could even look at the data that we've given, which we have 81.4% of Kenyans who have actually a mobile money account. So the 56, it's out of the ones without. That's now the percentage that we've given that are not using mobile money or do not have a mobile money account because they do not have enough money. So this is the difference of the 81.4%. Yeah.
So 19 or 20%.
Yes, exactly.
Thank you. I'm George Mngao Konji from the Civil Society. You touched briefly on the area of data protection. How much have you done in this area? Because it is very sensitive. Data protection.
Maybe you could be a bit more specific.
You just touched passingly on the data protection. You know, this is an area when it comes to mobile banking, mostly M-Pesa, and we do give details, and again, it's open to fraud. Large fraud. That's why I would like to know how much research have you done to protect the data that I give for the protection of, just like the banking system, whereby they take very high precaution in protecting my money. But M-Pesa, I don't want to go into details, has been prone to hackers, whereby most users of M-Pesa have lost money to fraudsters in this area. So I would like to know, how much have you done in protecting my money as an M-Pesa user in this area? Thank you.
Ideally, I can't address a specific company or a specific industry, specifically companies' ways of addressing data protection. Maybe to give more context into what I meant is that when we're collecting statistics, we also need to ensure that consumers are informed. That's just in terms of working within the confines of the data protection laws and principles. And I believe FSD, Central Bank, does that when they're collecting the data. So this is just to the larger research community as well. It's just something that we can't forget. That's the point at which I was addressing it to. So I can't address your specific issues, but there's also the regulator, the Data Protection Commissioner, who you can actually also be able to reach out to, and they'd be able to give you more information on what they're doing to help consumers address their challenges when it comes to data protection.
Thank you, Mary. I had two questions. I think I might have mixed up the numbers. So you said that for every $3 deposited, 2 is withdrawn. That is as of today in 2022. And yet in 2012, I think for every $3, 0.88 was withdrawn. So what I wanted to understand is, how do we factor in the fact that currently mobile money can be used, you can use other channels to transfer the money or to make payments through pay bill and buy goods. So that could maybe explain where there's a drop. And then out of curiosity, is it good to have more money on mobile money or less money?
I don't know about your last question, if it's good or bad. Ideally, this needs to be informed by the user. However, we see that when you're able to have the money in the ecosystem, it's easy to track, even for your own security. It's easy for you to be able to even look at what am I spending on. So in terms of when we speak about financial health and financial literacy, one of the things we're trying to push for is even consumers being able to learn how to budget for their own money. I don't want to go into other details, but ideally, it depends. This is very subjective, I'd say, in terms of having more money. The drop was, and also the numbers are not for as of 2022. This is as of 2021 when we did the State of the Industry report. The new State of the Industry report will be out next year. That will capture on 2022 data. I hope I've answered your question.
My question relates to the slide on the hindrances to the uptake of mobile money. And I noted that the main reason which was given by in that survey was a lack of enough money to use that service. And now, since your presentation is about the role of statistics in digital finance, I think this is already good information. But there's something I learned yesterday when in the presentation of those academic papers, because the discussions were very particular on policy recommendations. Yeah, so that a survey, it gives a problem, but then there should be some policy recommendations. I don't know what policy recommendations you can give on this, and maybe even looking at the current initiatives. Like now, we've seen the issue of Hustlers Fund. Yeah? How can it be, maybe what recommendation can you give in terms of use of that initiative to solve that problem which was identified in that survey? Thank you.
Again, gleaning on data and research that we've seen, especially during the COVID-19 pandemic, where we saw governments in different markets actually leveraging on mobile money to send funds, be it the pension funds, be it funds just to support people who are struggling economically. That is one way that could be looked. But then again, giving funds is never a solution. So this looks, we need to, as a country, there's a bigger conversation of unemployment in Kenya. And also, are we coming up with sustainable policies that is helping the growth of the gig economy that is coming up amongst the youth? So these are policy matters that we need to look at. Also, need not to rush to tax everything might be also one thing that we can look at actually, so that we'll find more users actually taking up mobile money services. We've seen in markets where actually implementation of taxation has actually reduced the uptake of these services because it becomes more expensive. So that's something we can consider.
Okay, this is Geoffrey. I'd like to make a contribution to what our colleague was actually trying to inquire about the security of the information of the users. When we look at the two financial institutions, the digital finance providers and the banking systems, I think there is a lot that has gone into protecting the information from fraudsters. And that's why through civic education, they are always telling the users to keep their credentials as secretly as possible. Because a fraudster can be able to take away what, I mean all that you could have saved if you give out some information. And this is between the fraudsters and the users. But in terms of accessing your savings through these other platforms, I think the providers have done a lot in terms of protecting the systems. I remember some circumstances where fraudsters have managed to take away some people's savings, both from the mobile banking providers, like, okay, I need to be very specific, Safaricom, and some banks. Within a very short duration, very short, like within seconds actually, they take note of the fraudsters trying to access people's accounts. And using their systems, they stop that and try to reverse the transactions. There is this other incident where some bank was attacked by fraudsters through the systems, whereby fraudsters accessed the ATM, installed some electronic appliance, and they were able to tap people's information as they could use the ATMs. And that went viral, and but it was so much detected in good time and stopped. So if these systems have been well protected, and then the users now become vigilant not to give out their credentials, then we are as safe to use the digital platforms. Thank you.
Thank you for that.
Thank you for the great presentation. My name is Judith from Kipra. Well, closing my eyes to all the reports we get from international institutions, my own institution, CBK, and everyone else, financial inclusion is the access and use of quality financial services. So what is quality in increased uptake of M-Pesa? The reason I'm asking this is because she asked a very good question about if the money comes in and goes out so fast, then is it, I mean, M-Pesa is there just as a tool to help us make payments, right? So does the increased numbers in people uptaking M-Pesa really mean anything in terms of financial inclusion? I mean, in terms of financial health? And also when we celebrate because there's increased uptake of M-Pesa or other mobile money, who is actually benefiting? Is it the institutions? Is it, I mean, we all know how much we pay, how heavy we pay for transacting using M-Pesa, even Fuliza, etc. So whose benefit is it? Where is the quality? Yeah, thank you.
I think we need to quantify what quality means. And in the perspective of digital financial services, it's the fact that I give you a product that you can use, that is easily accessible, that you can actually transact easily without having to depend on other people to support you or help you navigate through the platform. That's what we mean by quality. And the fact that you actually have, outside the transactional aspect of it, of payment, you might be able to save, you're able to actually access some form of credit, and over and above that, we're seeing even digital financial services going into the insurance side. So that's adding a protection layer. When we talk about financial inclusion, what we mean is that we're bringing people into the formal financial services, which we need to be in the formal financial services for them to also be protected and also to be able for them to manage their finances better. So in terms of who is it benefiting? Well, it depends on how you look at it. From where I'm sitting, there's more benefit to the consumer in terms of, we've seen, and I'll give an example of Safaricom that has been talked about. They introduced the Pochi la Biashara, which was actually to address MSMEs who had for the longest time been excluded, and they were not even able to access loans. And through the Pochi la Biashara now, banks even have some financial history that they can actually use even when, and they're able to even approach other financial institutions for credit services off the M-Pesa statements. So at the end of the day, when you look at in terms of transactional costs, I think is one aspect of it, but there's a bigger picture that we might be missing if we just look at transactional costs as an element of benefit to the consumer or to the business provider. As a consumer, you're also protected in terms of, we've seen fraud cases that have been resolved and people have been able to get back their money. So would that had happened if you had put your money under the mattress? That's a question for you to consider.
Right. Thank you very much for the most stimulating engagement and indeed giving credence to the presentation as was presented. I think there are certainly certain policy discussions that have come to light. Number one, of course, on data protection and the impact or desire thereof of enhanced consumer protection as we leverage on digital financial services to enhance financial inclusion. Of course, again, a further stimulating discussion on perhaps the leverage on affirmative funds to sort of increase and enhance the use of digital financial services. And I think these then certainly raise certain policy questions with a desire to enhance that line of enhancement of digital financial services. So with that, I wish to bring to a close the first session of the day, and just again to request you to kindly give a hearty round of applause to Mary. I trust it has been a most engaging discussion. So let me take this opportunity to take this back to Tabitha to define the next set of activities for the day. Thank you.
Thank you so much, Mary, for your presentation and the discussions. At this juncture, I want to take a break, a health break. We resume in 20 minutes so that you can continue with the next session. Thank you so much. See you after the break.
This anthropological project had as its first objective trying to understand how people use mobile phones here in Western Kenya.
M-Pesa is a mobile money sending service that was
So
introduced
40, you
in
can
Kenya
go on
in
the left
2007.
or on the right.
Since then,
Once you exit
it has
the
become
hall.
extremely popular. Many development economists approach the study of mobile money from a financial inclusion perspective. This project takes an anthropological approach. It sees the practices of mobile money as a part of an existing social and cultural background. This area is a rapidly changing but still predominantly rural area.
People are involved in agriculture, but also many other ways of making a living. Trading, having small shops.
One important source of income is mobile money remittances. Remittances have a variety of purposes in Western Kenya.
Ebulwale nalwala eja nanyolekhana nda accident mala omundu wandumira chisende narumisira kaba japu niye wandumira mala chanjenda.
Kama ukitaka kununua ng'ombe ama kujenga nyumba, ani shughuli kubwa kubwa, ama mtu amekosa school fees, unaweza uenda ukatransfer ukamsaidia.
Remittances have economic uses, but they also have important social meanings. They express caring and create relationships based on the exchange of assistance.
When I'm just feeling good and I have a little money, then sometimes I'll send it to something to my grandmothers.
For urban or international migrants, they are a way of maintaining social relationships and social presence in a community. There's an interesting duality to the mobile phone. On the one hand, mobile phones create connections and relationships.
I think M-Pesa has made relationships stronger, and they help you save on time and energy and money.
On the other hand, mobile phones also highlight the ability of individuals to create and shape their networks. They give individuals a lot of autonomy or agency in shaping their connections with others. People use mobile money to participate in groups.
Through mobile, it's easy for people to send their monthly subscriptions or contributions.
A quarter of the money that is contributed in steering committees when we have funerals is by this.
This concept of money pooling has become very, very common, and I found it to be widely used amongst siblings, family groups, but also students.
In order to understand how money circulates in groups, I've been using social network analysis to actually draw the pathways of mobile money remittances in families and groups. As an example, Sarah is a Maragoli woman living in Kimilili. Her mother was the third wife of a polygynous man. At his death, the other wives chased her mother away from the homestead. They moved to Kimilili, where Sarah's older sister Joyce married a Dutch man. Joyce now lives in Holland and sends Sarah $200 to $300 each month. She uses the funds to support her friend and fellow seamstress, Cecilia. She also sends remittances to her brother, her mother's brother, and her mother's sister's children. Her 20-year-old niece, Flora, attends an accounting college. Flora receives the most remittances in this network. She receives money from her mother, her aunts, and her uncles. Using mobile communication, individuals like Sarah can shape networks based on dormant kinship ties and on the existing importance of siblings in Kenyan families. The project drew mobile money graphs for 14 families. This allowed us to examine the main properties of the networks. They are based around groups of siblings. They are often connected to other groups of siblings by relationships of descent or marriage. Men and women participate equally in these networks, and people of all ages and genders can become central in networks. Furthermore, these networks are dense. Individuals have many connections to other individuals. These are properties that maximize the distribution of mobile money across a family group.
They represent the way long-term traditions of mutual support and reciprocity are now expressed through the medium of mobile phone use. One thing we found was that women tend to receive a lot of remittances. Just because women receive a lot of remittances doesn't necessarily mean that they benefit from them in ways that we expect.
I know my grandmother, she has many friends and they'll come to her for help. They'll be like, my sons are not working and I have this problem, can you help me out? So they'll be like reaching out to her for help.
So the ethic of generosity also places pressure on people to recirculate remittances to a certain degree. The individuality of mobile money and mobile phones often means that the secrecy, the privacy, and the exclusion that is allowed by mobile phone communication is very important.
People use their phones as a way to shut out people that they don't want to talk to.
People try to manage their participation in these groups that circulate money by turning off their phone. In an extreme case, you could even get a new SIM card, which is often taken to mean that you want to sever contact indefinitely. We met many people who complained about the ability of mobile phone connections to disrupt other important social relationships.
A husband may beat his wife because of the phone.
Mobile phones have caused marriage breakages in our country.
Mobile money has empowered individuals to create a networked self. In so doing, it has allowed individuals to create new connections, but also to sever connections. Social life in Kenya is being dramatically changed by the use of the mobile phone, as individuals create more control over the social connections that they produce and participate in. This anthropological project had as its first objective
My name is Caroline Gina. I'm an entrepreneur. I run a cleaning company called Miss Clean, where we specialize in professional cleaning services, both domestic and commercial. We've been in business for the last 13 years. As a business, we run a lot of transactions that are money related. When we started, I remember mostly the biggest mode of payment was checks, especially for corporates and individuals who could pay us via cash. Looking at the involvement of money handling and transactions has changed, and mostly even when COVID happened. I remember there was a big shift from cash handling to now more of online transactions. And most of my clients ask for bank details, and they currently do transfers, especially the corporates. They do just bank transfers. That walking and walking out of a bank was like something we had to keep doing. But these days we don't have such things. It's just at a touch of a button, either on your phone, on your laptop, and things are just happening. So that has even helped us as business people, such that we don't have to wait for money. I remember I used to go to the bank to ask them to give me an uncleared effect so that I can do my next job, especially when business was really still struggling with cash flow. But now, instantly, you have your client pays, and instantly you have your money. We do internet banking from our main account to mobile banking. When it's transferred to the mobile banking system, then it's transferred now to every employee. That has created a lot of efficiency, because the person paying doesn't have to go to the site where our staff are working from. It's just at a touch of a button, or while they're just seated in the office, they can easily pay people, pay them timely. By the time the work is ending, everyone has their money and they can access it and go home. A big part of our transaction, especially receiving payments, involve a lot of the domestic part, where clients, we serve them on a daily basis and they have to pay us on a daily basis, not waiting at the end of the month, like the corporate clients. So most of them use mobile banking. We actually cancelled cash payments years ago. We no longer receive cash as a company. We only operate with mobile banking. Internationally, we also procure mostly our machineries, because it's easier, of course, and cheaper to get them there. Once we've settled with a supplier, we go to our bank and we give them the supplier's details. Sometimes the bank also helps us also get to know the credibility of the supplier and all such details. And then they help us do now the bank transfer, which is all, again, instant. And once it's done, we have the transaction evidence, which we send to our supplier, and our supplier is able to just send the materials and machinery to us within no time. So yes, that has helped us a lot. We don't have to go through so much changing money here, taking the money, or picking the money in cash, or carrying the money in cash, which evidently would lead to enough times, loss of cash.
Kwa majina naitwa Penina Nashipal. Mimi ni mkazi wa Kibiko, Kajiado County. Mwanzo nilikuwa nafanya kazi ya beadwork, kushona shanga napeleka Masai Market. Wakati corona ilipoanza, ikawa ngumu sasa kwenda Nairobi. Nikakaa nikafikiria, nikasema ni biashara gani nyingine yenye naweza kufanya kando na hiyo. Nikaangalia, nikajaribu kuona kwa hii eneo yetu hakuna duka. Nikaanza kaduka kadogo. Customer wangu wengi wanalipa kupitia simu, na inawarahisishia pia na wao, kwa sababu kama mtu ako na pesa kwa simu hata lala njaa. Katika boma yangu niko na mbuzi, na pia hao ninawalisha kwa kununua unga, na si lazima nitoke nyumbani niende ninunue. Ninaweza lipa na kupitia simu, na ninaleta hiyo chakula ya mifugo yangu hapa nyumbani. Wakati ninatumia simu kulipa, inakuwa rahisi kuliko mimi kutoka hapa kwenda pale. Hapo kitambo ilikuwa ngumu kidogo, kwa sababu huenda nitakuwa nimesafiri, nimeenda mahali ambaye hakuna bank, na itakuwa ngumu kwangu kusaidika wakati ninahitaji pesa kwa uharaka. Sasa ninaweza toa pesa pali popote bila shida. Kwa kulipa karo, hapo kulipa na simu imetusaidia sana. Wakati mwingine tulikuwa tunaenda shule ikifunguliwa, tunakuwa na laini kubwa ya kulipa school fees. Unaona mtoto amechelewa kwenda shule, lakini kwa sasa imerahisishwa, kwa maana unaweza toa pesa kwa simu na ulipe school fees ya watoto na waende vizuri shuleni.
Kwa majina naitwa Susan Okoth, na ninafanya kazi ya samaki. Hii kazi nimefanya kwa muda mrefu. Sasa hivi niko na 15 years kwa hii samaki. Naenda Kikomba very early in the morning. 4:30 nishaamka kwa nyumba. 5 nishapanda gari. Kitu kama saa 12 niko Kikomba nachagua samaki. Cause ni ile original. Ukichelewa huwezi pata. Sasa naenda asubuhi kabisa, by 6:30 shaisha. Nikishachukua tunapima, alafu tunalipa na simu. We don't pay cash. Saa hii biashara ya samaki ni mzuri na kutumia simu. Nimefurahia sana simu. Juu nikiuza na save. Inanisaidia tu kusave. Saa hii tu nikiuza tu hivi naweka kwa kwa savings. At the end of the day ama at the end of the week unapata umesave mingi sana kwa simu. 0710 75 Brand Muvea. Asanti. Nina save pale nimekaa. Na save hata nikitembea, na save hata nikilala. Nikiamuka hivi, natoa hivi, natoa pesa, natumia Kikomba. Hata kama sijafika Kikomba, pesa yangu imefika hapo. Mimi nikienda napata tu samaki yangu. Pesa inaenda mbele kuniliko just because of simu. School fees pia ni simu. Juu sahi account ya shule. Kama mimi watoto wangu walikuwa nasoma ushago, tunaweka kwa account direct. Hatuendi na fee yangu imefika. Hata watoto wako wanafukuzwa na tunalipa tu na school fees na simu.
FSD has been working since 2005 to promote financial inclusion in Kenya. Kenya has made huge financial strides during this time. Over 75% of the population have access to a formal account, even if it's just a mobile money account. But are formal financial services really delivering value to low-income Kenyans?
My business partner and I went to the bank and we asked the manager if he could give us a loan, and then he asked us how much we needed at the time. The manager asked us if we have exhausted all our other options, like if we've asked family, if we've asked friends before, because he was he wouldn't advise because of the interest rates and everything. So he was now if we don't get anywhere else, now we can go back and he can see if we can get. Okay, it was a bit disappointing because I thought we bank with you guys, probably you'd give us a good rate or something, considering you can see how our account has been growing. After the first experience, it was a bit discouraging, so I'd rather I feel like I should just look for other options before I consider them as an option. So far I haven't gotten any loan from a bank.
Despite these achievements, our research shows that the relevance of these financial services in the everyday lives of Kenyans is minimal. So why is it that Kenyans just are not using banks?
Well, I think that's a really good question, because although we've seen the numbers of people having bank accounts go up, what we know is that they don't use them so much.
Yeah.
And I think, again, it's about the fact that when you put your money in the bank, it's not being put into this enabling you to build friendships, to build relationships. People would love to have a relationship with the bank, but then they find that it's really hard to get a loan from the bank.
Right.
And if they do get it, then they find it really hard to manage it, because maybe they've had some crises and the bank won't really listen to them when they need to change
not as flexible.
Yeah, and therefore that puts them in more of a problem than when they started.
What happened now, we had to go back and now ask our family members for money. So now I was lucky enough, my mom assisted, also my dad gave me some money. Luckily it was interest free.
Kenye unaenda kufungia line, unapeleka nini? 500. Sasa nikaona hiyo chama yangu wewe ina nini? Inafanya mzuri, na kila siku wakipitia hapa, tuseme hata niko na 200, niko na 100, nawapatia na wanachukua. Na hiyo pesa wanaenda wanaweka, na hiyo pesa ni yangu. Hiyo best roko sako. Ukiwaitisha tuseme loan, unataka loan, wanakupatia tu. Hawakuangi na process mingi.
There are two really important realities to understand about low-income people's lives, and one is that their incomes are really, really small. So whenever they need to spend money for one thing, it means trading off with another. So the incomes are really tiny. And we also saw that they're really volatile. So from month to month, income goes up or down by about 50%. So that's very difficult to plan around. And we also saw that people were very rarely just putting money aside in a savings account or under the mattress even in large sums, because they needed every shilling to be working. It couldn't just be sitting there. To just leave it sitting there would be wasteful. So they needed that money constantly working for them, whether that was in a savings group, where when it wasn't with them, it was with...
Nunua mbuzi, nakuja nazo, napeleka kichinjioni, naenda kuchinja. Nikichinja nakuja nauza. Mbuzi anaweza kama ni wa 3,000, anatoka kama 4,000. Sasa zile pesa nikipata nikichinja wale mbuzi wakiisha, zile pesa narudisha tena sokoni. Zile faida ile napata napeleka kwa chama. Capital ya kazi narudisha tena kazini. Kwa kucirculate namna hiyo inaenda ikizaana faida ambayo naiona. Ndio kwa banki ni sawa, sikatai. Lakini hii naiona nafanya kazi na immediately.
People have sort of two competing priorities that come out of that. One is stretching their budget to make it work when income is low or something comes up that they weren't expecting. And the other one is growing their incomes so that they're investing in a better future, whether that's in an actual income earning activity like a small business, or whether it's investing in school fees or buying a piece of land. And when you have such a small amount of money to use in terms of savings, you have to be really creative about balancing those two priorities of stretching the budget and growing your income. We found that people were using lots of different financial devices at the same time to try to make those two priorities work together. So they might be taking credit at the shop, borrowing formally and informally, belonging to a number of savings groups. We found like more than 10 in a household that were happening simultaneously.
Mimi ni fundi. Sana huwa nashona na mapato yangu ndio najisaidia nayo kutoka hapa kwa kibanda yangu. Huwa ninaingia kwa vikundi vya kina mama. Natoa tu kidogo kidogo. Baadaye nikipata huwa natoa karo ya shule, nanunua chakula, mavazi, najisaidia. Sasa si unaona vile nikiweka kwa vikundi vya kina mama, za zingine watu napeleka bank. Alafu sikikuja kwa nyingi tunakuja tunagawanya.
Chama niko na 2. Ya kwanza natoa 200 kila siku. Na inanisaidia mimi kulipa nyumba ama kulipa school fees. Hiyo ya pili nachukua, naangalia biashara venye inaendelea, nachukua doko napeleka bank.
Which of these services do you value the most? The bank or the chama?
Chama. Ndo napata pesa haraka haraka. Ndo napata pesa kama pesa ni mingi.
When I did research, I found that Kenyans value financial services not just for what they can get in economic terms, but as we said, also for them to fulfill other well-being goals and well-being values. And actually, respondents and people I talked to say that they can have a lot of motivation in terms of saving in the bank and also in terms of planning for their expenses. But at the same time, it's very difficult for them to build relationships through the bank. So while the banks can give them a sense of social status, it's very difficult for them to actually build a sense of identity and belonging, because through a bank account, they can't really develop relationships and social networks. And at the same time, also, banks don't seem to operate on those modes of development that are typically in communities, so the mutual development and mutual support. Because it's not clear when people put their funds into banks whether they can actually get these funds to work for the community through, for instance, loans.
Uplifting a friend means you cannot just focus on yourself. For example, sometimes a member of the chama may not have any money and she may not want the whole community to know she is struggling. The chama can help by supporting her so that people don't know what she is going through. That's how we run things. We agree not to expose each other's challenges to people outside the chama. We can't do that for people who aren't members of the group, but if they are members, then we are able to assist. So by sheltering one another like this, We cover each other's nakedness in times of need.
Tawaambia waingie waungane, waanze vikundi, watoe pesa, wakiunganisha pamoja wapate kitu ili waanze kazi.
And I think Mshwari is really interesting in the way it's come up, because of course it has got a bank behind it, but it's got a very different identity. Yeah. And what people are seeing with Mshwari is that they can take loans, they can learn about it, but they're seeing that the Mshwari is trusting them with their money. And I think there's a perception in banks that the bank doesn't trust people
the client
with its money. You have to trust the bank with your money before it will trust you with its money. And Mshwari is slightly doing that the other way around. And that's partly why it's very popular. So it's building a relationship which people start to value, because they want to be able to build that relationship and able to develop in the long term. They want a relationship which is around finance that can take them into the future.
Watoto wamesoma, niko na kijana amemaliza, niko na msichana pia, kijana amemaliza college na ameanza kujisaidia mwenyewe. Niko na msichana amemaliza last year, pia amemaliza form 4. Na pia niko na mwingine mdogo. Naendelea na mimi na babangu.
If formal financial providers want to develop solutions that work for people, they need to come out and talk to people. There is a lot to learn.
Mshwari is designed for the people on the move.
Mobile technology has made our work to be more easy than it used to be.
In fact, the mobile money has transformed the way we work.
The purpose of this research is really to understand the use and the impact of Mshwari amongst the Jua Kali sector in both rural and urban Kenya.
The word Jua means sun, and Kali, the hotness of that sun.
It signifies the informal sector in Kenya.
Jua Kali is 90% service industry. We're talking of masons, we're talking of plumbers, we're talking of all the artisans.
The Jua Kali sector is very critical to Kenya.
It is the one that employs so many people every year.
About 19 million people are self-employed in the so-called informal sector.
The only way we can provide solutions to unemployment in this country, which is a serious national problem, is by expanding the Jua Kali sector.
Before the mobile telephone came along, the bankable populace was very, very little.
For a long time, the traditional system has been walking into banks physically.
Some of us who had accounts would walk maybe from Kaloleni to Mombasa, 44 kilometers, just maybe to make one transaction.
This in itself cuts out quite a segment of the population out of the banking services.
There were many difficulties for artisans opening an account with maybe Standard Chartered or Barclays. It was very difficult.
Mshwari, I can just say, is an idea that came at the right time.
It's a product that has been developed by Safaricom,
which allows people to bank electronically and to access credit electronically.
It's really to help provide access to resources, small loans, and also access to savings for many small and medium-sized businesses.
Good morning.
like us here in Jua Kali, there are things.
Session number 2. We want to look at this question or to address this question. To what extent has financial inclusion enabled economic opportunities? And to answer this question or to address this question, we'll go through a number of presentations together with some being guided by the presenters, and we'll have some discussants also. So this session will take us up to 1, and as we go through, I wish to request all of us to be attentive and also to participate fully so as to achieve the objective of this session or conference. So I will call upon Dr. Amrik Heya, Senior Specialist, Research Specialist at FSD, at least to give us some insights on what this question entails and to give some guidance on how we are going to move. So welcome, Dr. Amrik.
Thank you very much, Atwasi. Good morning, everybody. It's very nice to see many of you here, many familiar faces here. And I just wanted to welcome you all for this next session on how financial inclusion has enabled economic opportunities. I think it's very nice for us to be focusing on this topic as our first panel discussion on the deep dive research that we've been conducting. Because after all, often when we talk about finance, we talk about the extent to which people are included, whether they have formal accounts, and so forth. But we don't perhaps pay enough attention to the role of finance in inclusive growth and in enabling opportunity for households and MSEs. And that, of course, is why we have the financial sector in the first place. That is precisely the role that the financial sector has been put in place to achieve. So I think it's very appropriate that we are focusing on that to start with. And I think our recent data on financial health has also called into question, really, the value of financial sector growth in terms of these ends that it has been set up to achieve. So I'm not going to go into great detail on this session, because I really want us to get started with the presentations. We've got some very, very interesting papers which we're going to be presenting today. And we have some very, very expert researchers who've been digging into the data and really mining Finaccess data in a way that we have not really previously done. So whereas we've had research papers in the past, the objective of these papers is really to focus on research for policy. We wanted to use the data to mine it deeply, to derive insights that could actually really inform our development and our policy decisions as a country, both public sector and private sector. And that's why we commissioned the papers that we did. So they're sitting at that cusp of research and policy. So I just want to briefly introduce the three papers that you'll be hearing this morning in this morning's session. The first gives a sort of, perhaps I should say, an overview, a bird's eye view of what's been happening since 2006 in the financial sector and also in Kenya's economy more broadly. It looks at trends in livelihoods, in well-being, and how these have interfaced with Kenya's financial inclusion journey, which has really sort of expanded during that period. And I guess ultimately it's asking the question is, what has that amounted to? How has Kenya's financial sector development really been instrumental in supporting the kind of development that we're seeing? And where can it also improve? Because in fact, in recent times, we're actually seeing a decline in many of those metrics, which the paper will go into. A second paper, and that paper is being given by Finmark Trust, our sister organization here at FSD. In fact, Finmark were the originator of the FinScope surveys, and so we actually owe them a lot, because the Finaccess surveys since then have really added so much to our knowledge across the continent. So we have Bobby Berkowitz from Finmark Trust, who's a senior analytics specialist, and he's come in from South Africa yesterday to present for us. And he's joined by Tabitha, whom we've already met this morning, who's the head of financial statistics at the Kenya National Bureau of Statistics, Tabitha Mwangi, and by Carol Matiko, who is the research director at G. Moritz Consulting, and who has also worked for many, many years on financial data and is an expert qualitative researcher. Second paper is going to take a much closer look at particular livelihood segments. And these segments have been identified because they should represent low-hanging fruit for the financial sector. They should, they're segments which have been chosen because they have slightly higher incomes or they have a larger size, and therefore they really represent a financial, an opportunity for private sector. But the question that we're asking is, to what extent have their needs been met? You know, are these segments still having unmet needs that could be better served by the sector? And so we have Jess Roby from 71.4, which is, again, a data science and analytics firm from South Africa. And 71.4 is sort of, its niche is really mining data to derive insights for policy and market development. Jess is a consultant with 71.4, and she will be presenting this segmentation analysis. She's also worked closely with us previously on MSE data and a previous round of the same segmentation for the 2019 survey. And then the third paper is on, in fact, it's our very own, really, because it is on an MSE tracker survey, which we put in place. It was the first tracker survey that we've done under the FinAccess suite. And we put this tracker survey in place during the pandemic to see what's been happening to MSEs during the pandemic. It was really stemming from a conversation that we had with the governor where he said, I want FinAccess to be useful for us in, you know, in supporting policy during this critical time of the pandemic. I want it to provide useful information for decision makers. And that kind of inspired us really to put in place this tracker survey on a very important population, which is small and micro enterprises. We already had a number of household trackers around, but we didn't have a bespoke tracker on that very crucial segment. So Tabitha Mwangi will present some sort of data from the tracker survey, but she will also make the case for why tracker surveys are important. After all, we have data on MSEs in the main FinAccess survey, and it's very detailed and rich data. But what we don't see, we have data from 2019 and 2021, but what's happened during that time? Why have we seen a decline, for example, in people being able to derive their livelihood from MSEs? So she's going to talk about the importance of tracker data. And that's the three papers that we have. And so for now, I'm going to hand over to Bobby, Carol, and Tabitha from the FinMark Trust team. And I'd also like to invite Jess, please, to come to the stage. So maybe all of you could be seated and then take your turn at the podium to give your papers. After which we will be inviting the moderator for the panel discussion, Ansat Zawere, together with two panelists who we have with us today, Peter Juguna from Sasra, and Duritu Muridi, who's an economist who's also joining us today. Thank you. So I'd like to, without further ado, hand over to Bobby to take us through the first paper.
Thank you, Amrik. And thank you for having us. Welcome to distinguished colleagues in our financial inclusion community, and I'm hoping that all protocols are observed. I'm really pleased and excited to be part of this landmark event. the FAM partnership between CBK, KNBS, and FSD Kenya is showing, I think, all financial inclusion champions across the world how to collaborate and innovate on financial inclusion research. And earlier this year, we've already seen this recognition given by the Alliance for Financial Inclusion. The partnership actually presented a case study that I think is an inspiration for other members of AFI. As Amrik mentioned, I'm from Finmark Trust. We are a sister FSD to FSD Kenya. It's my second time actually here at KSMS. The last time I was here was, I think we would all call it now before the COVID era. And it was in preparation for the 2018-2019 FinAccess study. CBK organized a special session for the regulators to introduce to them and to inspire them in terms of how to use financial inclusion data for monitoring and for targeting their own policies and how they can actually have a financial inclusion focus. And we were part of sort of sharing that data as part, other colleagues from the ITI facility we hosted at the time. So what I'm going to do over here, as Amrik has said, is I'm going to talk about the entire sort of timeline of FinAccess to see when it comes to key measures. And some of those measures are actually welfare. They are financial health measures, proxies for for different dimensions of financial health, as well as different areas of financial inclusion and how these have changed over the period. What is really key here is the 2016 year. Everything hinges around 2016, and we're going to see this through all the data that we look at. What we can see here when we're starting off, this is looking at a couple of measures of welfare, we can say proxies for financial health. In blue, we've got food poverty, the proportion of Kenyans who often or sometimes go without enough food to eat. And in yellow, we've got the median personal monthly income. We can see actually from 2006, and particularly since 2013, there was a significant improvement on both these measures. The proportion of Kenyans experiencing food poverty pretty much halved in this period, and personal median monthly income actually went up 50%. So a tremendous improvement, particularly 2013 to 2016. However, since then, in the last 5 years, we've seen declines on both measures of food poverty as well as on measures of median personal monthly income. Other measures of welfare, or let's say financial health proxies, one over here is the ability to access a lump sum in a short period of time. The other is perceptual, whether Kenyans say that their financial situation has improved in the past year. And again, since 2016, these are really dramatic declines on both these measures that we're witnessing across the timeline. So we're looking at all welfare measures declining since 2016. And again, 2016 is this pivotal hinge. There's improvements before then, and there's dramatic declines in welfare since. We now are turning to different measures of financial inclusion. Here we're talking about traditional finance. So we are seeing traditional bank accounts, chamas and SACCOs as all examples of traditional finance, let's say before we were seeing digital finance. And again, we see some improvements on these things, particularly when we're looking at chama uptake up to 2016. Of course, we have the sort of rise of mobile money, and obviously Kenya is synonymous with that. And we can see, as mentioned, mobile money was launched in 2007. The first survey that covered mobile money was in 2009, and there's a dramatic increase in mobile money uptake. But since 2016, in terms of traditional finance, we see the decline in traditional bank account uptake. We see the decline in chama uptake. But we still see mobile money expanding, although most of the expansion took place before 2016. Now, mobile money is really synonymous with remittances. That's the sort of key use case. I'm not showing remittances here. That is very high, that is very close to the overall mobile money throughout the period. What I am showing over here is digital payments. Separate from mobile money, this is when you're paying for bills, fees, or taxes digitally. And here we can see that, again, in this period, a dramatic increase from a very low base. But since 2016, it's actually a use case that is becoming almost synonymous, or in the same way that remittances have been with mobile money. And obviously, we know that the pandemic era was a key aspect for changing digital behavior and around payments beyond remittances. Other things that are sort of pivotal and key in terms of increasing across that same period are digital savings, and that you can see in this orange line, and digital credit, also expanded since 2016. And then we've got, beyond the overall uptake, we've got other measures of traditional finance. We can say traditional formal savings, traditional formal credit, informal savings, informal credit. So between 2006 and 2016, there were declines in informal borrowing, uptake, expansions in informal saving. Since then, we've seen the digital credit and digital savings rise. At the same time, there's a rise on the left, as you can see, in informal borrowing, while traditional formal savings and informal savings have both declined since 2016. In the last session, Mary was talking about some pivotal research that showed very strong welfare relationships between digital finance and these key measures of welfare. So I'm repeating some of the findings that Mary was alluding to. I'm just showing the sort of key papers. And these are key papers for Kenya, but they also are key papers for demonstrating the digital financial services use case for the world. And what we see here is the strong relationship with digital financial services and consumption, self-employment, income, helping people dealing with shocks and being more resilient. What's important over here, as we can see, is that most of these papers are from the period before this 2016 hinge. So a lot of the research is happening at the time that digital finance has expanded, but so has welfare overall, whether it's connected to digital finance or separate. So we want to focus on the 2016-2021 period because it's actually under-researched, and it's at a time when there's been a lot of declines compared to the previous period. What is different with FinAccess is FinAccess is a cross-sectional landscaping study. So it's not set up for experimental research. A lot of these papers actually had an experimental design. FinAccess doesn't have that. But FinAccess does have data, and rich data, and as we see from 2021, county-level reporting data that does allow us to do different things. We've applied some econometric techniques over here to come up with what we call a kind of quasi-pseudo panel to look at things. And again, we're reporting in each of these columns on different measures of welfare, or let's say financial health. We've shown food poverty, being able to raise a lump sum, a financial situation having improved. And we run different models to look at those relationships with financial inclusion. We hold other demographics constant to see what those impacts are, and also where we can actually control for them, and then look at the partial effects of financial services. And things on the demographic side make sense. So people that live in a rural area are more likely to experience food poverty. People from higher education levels are less likely to experience food poverty. People from higher education levels are more likely to raise a lump sum and say that their financial situation has improved. What is very interesting is there's a negative relationship between digital finance, and particularly between digital savings and digital credit, and these welfare measures. Food poverty, raising a lump sum, financial situation having improved over the past 5 years, the 2016 to 2021 period. Now, this doesn't mean that digital finance causes negative welfare. When we've actually looked at it in more detail than what we think is going on, is that digital finance has actually led to accessibility and product development for people that are vulnerable. And vulnerable people, as we can see en masse, are facing difficult times between 2016 and 2021. They're facing difficult times, and they also have access to products that allow them to better weather those difficult times. So in terms of the design of our models, let's say that we have two similar people. Let's say we have two 23-year-old men from a rural area, and that they both have secondary level education, and that they earn a similar income, or let's say even the same income. So we control for all those things. If one of those 23-year-old men is experiencing food poverty more frequently, that man is more likely to have digital savings or digital credit. And he's more likely to have digital savings and digital credit because he's able to access those things, and they're helping him deal with his liquidity and resilience issues. So these are very interesting findings, and it's important to see how the causation works. People are getting into these difficult welfare situations, and there are products that they can access, digital products, to help them deal with their, to deal and weather those storms. Now, I'm going to pass over to my colleague, Tabitha, my colleague on this aspect, who's going to provide us more insight in terms of the context in which we found these changes going on.
Okay, thanks, Bobby. So we want to look at the socioeconomic context in which this study and analysis is based. And I'll start with where Bobby had initially indicated on the issue of the reduction in the poverty. The poverty head count rate reduced from national 46.8% to 36.1%. But this reduction largely took place in the rural areas. So what it indicates is in urban areas, the reduction just, the people living below the poverty line only reduced to 29.4% compared to a reduction of to 38.8% from almost 50%. Half the population in rural areas were living in below the poverty rate. So what underpins this the improvement in welfare and decline in jobs? There are four broad drivers that we want to look at. That is the structural change, the composition of GDP. And the other element we want to look at is the demographic composition, that is especially the youth bulge, and a skill mismatch that may explain the situation. And then the other important element that has happened between 2006 and 2021, the period of we are reviewing, is the county government. County governments came into place in 2013 after the new constitution. So how is that a driver? And then the fourth pillar that we're looking at is issue of access to markets, local consumption, and the issue of what we're exporting. So in terms of government policies and coordination, with the evolution, some functions were transferred, or they became the main the focus of the county governments from the national government. And that transition period had some challenges in terms of roles. For example, especially in agricultural sector, like extension services, and also support offered at county level. The other element in terms of from a macro side is the issue of the fiscal deficit. And here we are looking at the indicator as a percentage of just GDP. It was a negative 0.4% to a high of negative 8% in 2021. And that has implications in terms of funding government functions and services it can offer in terms of development, the scope, how far you can go. The other thing that has happened during that period that we're focusing on is the issue of the cap in interest rates that happened. And you can see in terms of private sector credit and the government lending, that the private sector credit went down. Of course, there's that movement in the government borrowing. And what is observed is that there was some form of crowding. There's some form of crowding out of the private sector with government lending, which impacts, of course, on what the private sector can access in terms of loans, in terms of support from the banking system, for example. The other pillar we want to look at is in terms of our production, and especially the issue of the composition of GDP. The level of exports has declined from 27% in 2006 to 11%. This composition is important because our key exports, some of our key exports, they also drivers, or they employ a huge majority of the population, especially casual labor. And these are the key crops like tea, coffee, and the horticultural crops, sugarcane. So in terms of the key component of exports, when there is a decline in terms of productivity, of course, you can see that there is a lower demand for labor, especially for that sector. So what is constant during this period is, of course, the private consumption that is driving the GDP, and which has been constant at around 75%, with minor changes during this period. So whatever we produce, the implication is that whatever is produced locally should drive, the domestic demand should drive the growth, is what is driving growth, and needs to be absorbed since there is a decline in exports. The structure, in terms of structural composition of the economy, there's a gradual structural change from agriculture to services. In 1990, for example, the share of agriculture was like 38%, declining to around 31% in 2018, and further lower. And also the composition in terms of employment. A lot of employment now, from 71%, for example, in 1990, 50% in 2008, to a decline to around 44% in 2018. We are focusing on this. This is what we're highlighting because Bobby will highlight again the other in terms of employment shares. And what it means is agriculture sector is not able to absorb all the labor, and most of the shift, especially for the unskilled and lower skilled workers, have to go into services, for example, in wholesale and retail trade, also in some part of industry which has grown to 19%, which grew to 19% in 2018, like construction and agro-processing. So that shift also explains some of the gains that are there in terms of welfare, and also constraints in terms of course, of the labor market in terms of earnings. There's a shift, yes, but what is the value of that shift, and what is the level of earnings that is there? Are they good enough to support our incomes, and of course the quality of the livelihoods in that form of earnings? So quality of jobs is lowest. Quality jobs have grown slowly, whereas the economy has grown faster. And in terms of employment, the significant growth is in the informal sector. And you all know that the informal sector is precarious in terms of the labor. There's lower security, is characterized by lower earnings, and of course the lower skilled population, which are the majority, moving in and out of sectors. And that is what we are seeing here. So for example, in 2006 to 2021, you can see the growth in the real GDP in terms of trillions to like 9 trillion. Whereas, and you can see the growth in the informal sector workers to 15 million in 2021. Whereas the formal wage, like the private sector wage employment, that is growing slowly. So what this implies is the economy, the employment, the labor market, or labor is structured in a way that most of the jobs created are in the informal sector. And whereas we have a lot of training happening, and a lot of graduates, for example, some skilled, it's still low. So what we want to, what we are trying to indicate here is, you can see the labor force participation rate. It has been growing, but there was a shock like in 2016, and that decline that has happened. So in terms of job growth, the number of jobs being created are not in tandem with the adult population growth. So if you reach 18 and you're no longer, for example, in college, you need to take up a job, which most of our youth don't transit to the higher tertiary level in terms of the number of people. So the labor force, the adult population, there's a gap between the adult population and the employment that is there. So you can see, for example, as we had alluded earlier, the growth in the informal sector to 15 million people from like 7 million people in 2006. This shows that the way the economy is, there's a labor issues, labor market issues in terms of what you're able to provide in terms of a quality job for the population. And this is important in terms of what we started with, that is coming out of poverty and staying out of poverty, and also having enough sustenance for both savings and for investment. So the other quadrant we want to look at is the demographic characteristic, how our country is. There's a youth bulge. So in 2021, and this is the share of the population that is aged between 16 and 25 was 34%, compared to like 28% in 2006. And you can see the lower pen showing in terms of the education level. So there's a higher increase in people who are going up to tertiary level, and also secondary, completing secondary school. Like for example, in 2021, 13% transited in completed secondary. No, 36% have had a secondary education, 13% have a tertiary education. But that proportion of the population is not absorbed in the, what you could say, quality jobs, or the skills that they have attained are not being absorbed in the labor market. The other thing we just want to highlight is the issue of in terms of equality. For example, we looked at the competencies across, for example, various grades. You find like in terms of mathematics and science, the competency has declines. Like there was a research, this is a research on around 2018-19, that in terms of mathematics competency in grade 3, it was 59%, what you're supposed to know when you're in grade 3. But as you go forward in terms of Form 2, and that is grade 10 also, only 6% people have the competency, if they're in Form 2, of what is required for that grade. So it shows that you start well, but the skills as we advance are not matching what you're supposed to be doing, which of course has implications in the labor market. So the other aspect that is very important in terms of our livelihood is what we all are aware is the inflation. So here we have shown the movement in the trend in terms of overall average inflation, and the movement in food prices. That is the food inflation. It's a roller coaster moving up and down of food, which is a major composition in terms of expenditures. Why does it matter? If the majority of the population are earning low wages, and there's no predictability in terms of food prices, so there's a high and up and down movement in food. It means that a lot of the population are living in precarious situations. Most of their money or earnings going into sustenance, food, and which of course affects how they can progress, for example, and move out of poverty, invest more in education, invest more in other elements. So this is important in terms, especially for the two dichotomies that we analyze, the rural populace and the urban. So whereas we measure these inflation numbers are, for example, urban-based, we collect prices in urban areas, the prices affect both the rural and the urban, because we also have rural connections. You know, the price in, for example, Nairobi or some areas, there's that minimum threshold that also is translated or is transmitted in rural populations. There's only so much you can grow. In terms of, you also need to buy some stuff. So the rural population is also affected usually by poverty, and also is a significant number of the population, which means that, therefore, that as much as there's this growth that we're experiencing, the rural population is hugely affected, and much needs to be done in terms of what financial services and inclusion can do for the population. So in brief, those are the four pillars that undermines this analysis that we are doing and driving decline in quality of jobs and the implications for well-being. Thank you. I would want to call Bobby to continue with the results from the analysis. Thank you.
Thanks very much, Tabitha. So I think with the context that Tabitha's provided, one of our key focus areas in this paper is actually on the livelihood lens and how this has shifted over time and what it means for welfare as well as for financial inclusion, and how at a livelihood level financial inclusion is assisting welfare. What Tabitha has shown is that particularly in the last 5 years, 2016 to 2021 period, there's been a lot of pressures on the economy that people are working in, and actually the labor market has struggled to absorb people, and it's particularly in rural areas. You can see that roller coaster of food prices in rural areas is actually saying that there's very little stability for people in rural economies, and if there's little stability for people producing food in rural economies, there's little stability for people working in rural economies, for people selling and trying to make business in rural economies, and it's very difficult. In addition to this jump in the population because of a youth bulge and an economy that's growing, but not growing in a way that can absorb that much labor that's entering it. And we see this actually coming in now with livelihoods. So in 2016, the average number of income sources for an adult Kenyan was 1.5. In 2021, it's now 1.2 sources. And actually, the sources that have been dropped are farming and small business. We saw the Juakali video going earlier on, and that is supposed to be a segment that can absorb a lot of people. But in actual fact, over the last 5 years, it's a segment that shrunk. In addition to more formal ways of people earning money, whether it's through employment or through formal businesses, we can see that farming is the proportion that are earning any money from farming and the proportion earning any money from businesses declined. And then on the other side, what's really swelled is casual work, because maybe a casual worker had their own business as a core income source. But now if they're only left with casual work, that is now their main source of income. And then, of course, a lot of people are joining the labor force, but they're not earning income and they're dependents. And we can see this when we actually look at it from an age perspective. So on the left here is the youth breakdown over time. In the middle, it's the productive age. And on the right, it's the older age group. And we actually really see that in 2021, the proportion of youth that are dependents has swelled. And the proportion of productive age that are casual workers has also swelled. A real structural change in the economy and in terms of livelihoods. The next thing that we are looking at here is the relationship between livelihoods and welfare. So the first thing that we've seen is the proportion of chama usage of business owners. That is a segment that's declined, but it is also where chama usage is high, and there's a reason for that. In terms of traditional bank ownership, the vulnerable segments, dependents, farmers, and casual workers have the lowest uptake of traditional bank accounts, and unsurprisingly, wage and salary earners have the highest proportion of bank account use. They also have the highest proportion of SACCO use, where it's low for most other segments. In terms of digital finance, we saw this real increase, particularly in digital savings and digital credit in the past 5 years, so that half of Kenyans are digital savers, and a quarter of Kenyans have some form of digital credit. What happens here is that there's a relationship as we go along the continuum of digital finance. So most of the Kenyan segments have a high uptake of mobile money. It's dependents, and we've seen that dependents have been swelled by the youth that have the lowest. And there's a similar situation in terms of digital savings and digital credit, and obviously it is a proportion of overall mobile money uptake. What's interesting with digital credit is casual workers have a higher uptake of digital credit than we'd expect from their other digital finance uptake proportions. And finally, with welfare, we've seen all welfare measures declined. So in 2021, only 8% of Kenyan adults have the ability to access a lump sum in that period of time, and half of them are experiencing food poverty. On food poverty, most segments are quite high. Employment is the lowest, but even then, 1 in 3 wage and salary earners say that they often or sometimes experience food poverty. In terms of ability to access a lump sum, hardly any of the vulnerable segments can. And of course, wage and salary earners, 1 in 4 of them can. And then, we took a growth measure, let's say, in terms of people's personal monthly income. It's low for most segments. Even for wage or salary employment, a median of 15,000 shillings is much higher than the others, but the own business segment, that has dropped a lot. So that now in 2021, it's a 6,000 median personal monthly income. And then the next one, wage and salary earners, is 2.5 times that amount. So we did some other econometric work now when we're going down onto the livelihoods level to see the relationships between welfare and finance. And of course, in terms of food security, savings makes a big difference. But the biggest difference is made by SACCOs and banks. And we've seen that those don't have the highest uptake. And unsurprisingly, there is a bias towards wage and salary earners when it comes to SACCO and bank uptake. Digital savings and mobile money does make a difference. It has a lower impact than SACCOs and banks, but of course, the uptake levels are much higher. So many Kenyans are benefiting in terms of food security from the digital savings. When it comes to the income, the sort of growth measure proxy, bank uptake's got the greatest impact. Of course, again, wage and salary earners are the ones that really have that high uptake and benefit. Chama uptake is another one, and there we saw that small business owners have the highest Chama uptake, and that leads to improved income, although the impact is smaller than banks. I'm going to hand over to Carol now, who's going to expand on some actual stories of people and interviews that we had.
Thank you, Bobby. So this qualitative complements what Tabitha and Bobby have said, and the qualitative assignment was basically to try and understand at what point do financial services support accumulation and growth. And in terms of the approach, it was based on looking at the livelihood journey of a selected number of respondents. So one of the things we found that there's other underlying factors that will influence whether or not one can actually harness the most in terms of these financial products. And that's education, social support, and obligation will determine your livelihood trajectory. And this is best illustrated by 2 livelihood journeys. Both ladies have certain similarities. Both of them worked in casual work at one point of their life. So we start off with Cynthia. Cynthia completes her secondary school in 2012. She's not able to proceed with college because her parents then decide to prioritize her siblings. She wanted to be a nurse. She specifically says that they prioritized her brothers. She then starts engaging in casual work, and this casual work involves construction, but also daycare. Of course, she gets M-Pesa, she has a home bank, and she gets married in 2014, has a child. And I think what is unique about her, because she has the support of her spouse, she's able then to leverage on chamas where she saves in a chama that gives her ×3 and a Roscar, and opens her own salon. She's on track to expand, and she moves even to a safer location in 2019. And she's adopted all these modern technologies like till numbers, and she still uses mobile lenders, but she's very clear that they're not putting a strain on her resources. Then on the other extreme, we have Paris. And here you can see the main thing is Paris actually drops out of primary school. She ends up working as a live-in help at the age of 14, gets married at 17, gets a child. By the time she is 19, she has 2 children, an alcoholic spouse. But for her, Fuliza has been a lifesaver. And she uses Fuliza not only for the small payments, but also for big lump sums. For example, she had just taken some credit for her son's school education. So what differentiates Tabitha, Cynthia and Paris is that you see that Cynthia's higher education and the support that she has is what puts her into that path of accumulation through the formal financial, through chamas and also the support she gets from her family. Whereas on the other end, we see that Paris, it's mainly because of her strong financial capabilities that helps her to use the digital finance to maintain her obligation and also to meet any resilience issue. So that, I think, confirms what Bobby said. I think Bobby said at one point that the data shows that it is those that are more vulnerable that are inclined to use the said digital solutions. And then I think Tabitha did take us through the food roller coaster. And one thing we noticed is that it means that the rural Kenyans are also facing the same challenges. You know, there's a squeeze on liquidity, and I think she did say that, you know, the investments in the key sectors has reduced over the years, and one of those sectors is agriculture. So for you to have a business in rural areas, you have to contend with the fact that there's climatic issues, there's seasonality, and also you're dependent on a population that relies a lot on remittances. So when remittances dip, your business struggles. So based on that, we know that running a rural business can be very challenging. And even for young men, specifically these young men who have the support of their families, Evans and Gideon, they have the benefits of inheriting some asset. They have family that can support to pay some of the bills. We see that they're really struggling in terms of making those opportunities work for them. And just to take you through, so Gideon is a young man, of course. He opts to drop out of school in Form 2, opts to drop out because his father can actually pay, and his father then takes him to a Baba school, pays for rent for 6 months. He still stays with his parents. His parents are very core in his life. They somehow connect him, and he ends up being a member of a farmer's circle, and I think contribute some money for him as well. But he's totally unable to maintain this shop, so he keeps closing, and he becomes a dependent, then goes back into business. And you saw Bobby saying that the proportion of dependents has increased, even among young men who should be actually earning a living. So Evans is one of them. Evans, of course, has an M-Pesa to bank. He loves it because he's able to save. He has M-Shwari, and remember, he also has Sacco. Then on the other end, we also have Gideon. He finishes Form 4 and gets into the family business, which is retail. Almost immediately, he gets a bank. Unfortunately, his father passes away in 2014 and inherits the family grocery shop. And during all this time, he has a very successful sister who is always there to support him in terms of business and hold his hand. You know, he's done a little bit more in terms of expanding his father's business. He's put in agency, he's put in till number, but he has a problem with debt. So by 2019, he had loans from the bank, loans from mobile lender, and actually he says that he really can't trace what he did with the money. So of course, in his indebtedness, he then sells the family bull. So I think what we are trying to say is that we are seeing these young men who probably have seen their fathers succeed, or older generation, based on their hard work and many other factors, years ahead, and they are trying to achieve the same. They have very high aspirations, but they seem to struggle to achieve the same. So what is happening is that although they have access to all these financial products and have the capabilities, I guess, to access them and to use them, they're using it mainly for consumption as opposed to capital accumulation. And that, of course, then results in cases where they are very indebtedness. And I think, though we've not looked a lot at young females in rural areas, we speculate that the scenario might be slightly different. They might not have the same backing in terms of productive assets from their family, and they start totally different businesses. They start retailing vegetables by the roadside, then eventually open a little stall in the market, and they don't seem to get into as much indebtedness as young rural males. And I think something we can ask the audience is, what else can explain that trend that we are seeing among our young men living in rural areas? Of course, eventually they'll move back to Nairobi or something. And then the last livelihood journeys is what Bobby said, confirms what Bobby said. Bobby said that the people who are harnessing the most from this form of financial providers are actually those that are in private employment. But even with private employment, we see a difference. We see that it is the public sector workers whose trajectory most benefits from the formal financial institutions. chamas continue to play a role, even for those who are in formal employment. Although they play the same role in terms of supporting those trajectories, the only issue is the role is smaller in terms of the amount they're able to provide. And also all this is built through social relations. So this is a scenario I think most of you, if you're Kenyan, you understand very well. Someone who worked in the public sector. And Lucy and Regina, entry salary was very similar. You know, there's a whole difference in terms of age, but in terms of the earnings was not a factor in terms of that trajectory, initial earning at first day of employment. Yet Lucy, who worked in the former Nairobi City Council, manages to put up rental units. Yes, they're in Mathare. They get destroyed in 2007 during the post-election violence, but she's still able to leverage on her salary to get more cash to rebuild new ones in her ancestral home. And she's on track on even building more. She's subsequently retired, and after retirement, she then joins a circle purely for social purposes, not that she intends to necessarily save and take a loan from it. And then we have Regina, on the other hand. Regina also works in a formal farm, and she's actually a supervisor. She has 4 kids. She tried the circle, and it was extremely difficult for her. She was unable to repay and struggled. But for her, what really has been working is that she has so many circles. She has daily circles, weekly circles, monthly circles, and that's what she's been able to leverage on. So we see that the use of banks to accumulate productive assets for those who are in public sector is mainly, of course, supported by the fact that they have institutional relationships that can be able to enable them to access these resources. Whereas Regina, yes, might be in a formal institution that maybe for one reason or the other is unable to engage with those financial institutions to get the same services. She then relies on those social relations and her chamas to provide similar security and stability. And another case that really illustrates Lucy is that we had someone else. He was able to educate. He's just a deputy headmaster in a rural school and was able to educate 8 children through university and college, again, depending heavily on his circle. So I think what we can realize is that even those with chamas can still get that liquidity and resilience from their chamas, but what we see is that truly those who are in public sector have so many more advantages that others might struggle to access. So thank you, and I'll get it back to Bobby so that he can conclude for us.
Thank you so much, Carol. So just to quickly summarize, there was obviously a lot of components in this research. Looking at an overall level, looking at livelihood level, we looked at the context, we had Carol with qualitative research. Just in terms of Kenya welfare and financial inclusion, we saw that up to 2016, Kenya had impressive pro-poor growth, and it absorbed many into the labor market. We actually saw from Tabitha that the labor market excess sort of labor population declined during that period. And it was led by rural Kenyans where the poverty rate significantly declined. So it was pro-poor growth and also pro-rural in terms of that absorption. This was also a time when both traditional finance and mobile money uptake grew. But since 2016, while Kenya's registered impressive economic growth and has continued to grow, the adult population has swelled, while the sectoral growth drivers have been less labor absorbing. And we've seen now welfare and traditional finance measures have declined. We've also seen the sources of income shift away from farming and business and towards dependency and casual work. In terms of how finance supports livelihoods, we've seen with rural Kenyans increasingly vulnerable, finance does not appear to be a straightforward route to accumulation and improved livelihoods. Pre-existing qualities like social connections, gender, education, they open up different capacities for Kenyans to accumulate funds. And once you're very well positioned, let's say particularly if you have the fortune of being a public sector worker and all those opportunities with formal finance that are open to you, you can successfully accumulate finance and invest in the future, particularly through bank SACCOs and chamas. On the other hand, more vulnerable earning Kenyans, they have opportunities where digital finance actually provides an avenue for survival. It's accessible, it's appropriately designed, and so particularly if Kenyans have better digital financial capabilities, digital finance is actually a way for them to weather the storms of liquidity and resilience challenges. Thank you very much.
Thank you very much, Bobby, Carol, and Tabitha. Okay, that's fine. That was a fantastic presentation. Yeah, it was incredibly rich and detailed. I think one of our most rich and detailed presentations, actually, that we have for these deep dive analytics. So that means we have run a bit over time. And so I'm going to ask Jess to come up next, followed by Tabitha. Tabitha, you might want to stay here because yours. And then perhaps I could ask Jess and Tabitha to be a little bit brief with their presentations. Yeah.
go. Technical problems. There always has to be one in a day. But thank you, everyone. Is this right? You can hear me okay? Cool. It's wonderful to be here. I nearly didn't manage to make it here, so it is great to be able to be here today and be in Kenya again. As was mentioned, we are, us at 71.4 and myself, we've been looking at livelihoods a little bit closer and really just trying to understand, if we look at the wealthier and our more economically active segments of the population, are there still unmet financial needs that might be able to be served by the public sector or perhaps through better policies? And I'm going to start with a disclaimer. It's always good to start with one of those, to say that I actually have the easy job here. We've looked at the data and we can show you what looks like some unmet needs and opportunities, but you all have the harder job in actually taking that forward and doing something with it. Okay, so what did we do? We have taken the entire population, that's everyone age 16 and up, so it's the FinAccess population, and we split it into 16 distinct livelihood segments. So these are, as I mentioned, distinct, mutually exclusive segments, so one person can only belong in one group. And we use the main income source as the starting point here. And then using a few other demographic and sometimes sector level variables, we've kind of sliced and diced the population into these sectors of interest. If you see there within the casual workers, we've kind of separated out your older casual workers, so those individuals above the age of 56, and then we've identified your rural and your urban casual workers. Likewise in agriculture, here we first looked at the more formalized farmers. So can we identify those that are selling through more organized value chains, so selling through cooperatives, selling through companies and agencies, other institutions? We've identified them first to say they are more formalized farmers, and they're a bit different to everyone else. So your livestock and your food crop farmers who are selling through more markets, through traders on the side of the road, etc. Not sounding good. Okay. With the business owners, we split the groups here based on the number of paid employees that they have. So your micro business owners, your urban and your rural micro business owners, these are individuals who run businesses but have no paid employees, and they're compared against to your small firms who have between 1 and 21 paid employees. And you can just see quite similar segment sizes there. And then the last one, just to note, is the employed segment. So in the last presentation, the public sector was spoken about a lot, so we've obviously identified them too. And then with the private employees, we've split them out into what we've called more formalized private employment. So those are individuals who have any type of pension product. Okay, any better? I still feel like I sound like I'm in a tin can. Should I just speak? No, use the mic. Okay. Okay, so I was... That's not working. Our more formalized private employees, they have any form of pension compared to the less formalized who don't have any pension. Okay, so with these segments, we've tracked them over time, also just back to 2019. And Bobby and team spoke a lot about these kind of large population trends, and of course we're seeing the same thing, but just at a bit more of a granular detail. So these large shifts away from agriculture, shifts towards dependency and towards casual work. And what's interesting just to note, because I'll speak about them later, is the increase in the share of that urban core casual work. So between 2019 and 2021, that segment has increased by 25% as a share of the entire population. And within the business owner group, it's also interesting to see that the small firms have increased slightly, but perhaps they're kind of absorbing some of the losses in the employed groups. And our deep dive focused on 8 segments, as we mentioned. Amrik spoke about some of the lower hanging fruit. So here they are, as we've identified them. There are 8 segments, and they've been selected based largely on their size. So they've got good market potential either because they're really big. You can see in the case of your food crop farmers and your urban core casual workers, really big populations. Or they were selected because they have larger than the kind of average population median incomes. So here we're seeing, and I've just highlighted the kind of more highlighted bars are these kind of priority segments we've selected with their median monthly personal incomes reported as per FinAccess at the top. And what's interesting when you look at this from a total market opportunity perspective, so that's just total segment size times by the median monthly income. It's a very crude measure, but nevertheless it does allow us to look at the relative importance of some of these segments. And it shows us some really interesting things. So if you look at the public sector employees, as was just mentioned in the last presentation, quite an easy segment to serve. They're sitting at a total market opportunity at 22 billion, and that's slightly lower than your urban core casual workers who've got a total market opportunity of about 25 billion rand. And of course, not all of that opportunity can be easily accessed and served, and so we'll dig into a bit more about their financial products and services to understand that a bit better. So again, Bobby mentioned that a lot of these segments are very well included already, so I'm just going to focus mainly on the savings and credit side of things. And here what we see in that first kind of line of bar charts at the top is the proportion of that segment that has any savings product. And I'll show you on the next slide kind of where that savings is held. But what we can see here is that across all of these segments, they have higher than average savings. And it is lower within your kind of food crop farmers and your urban aspirational youth, but still, more than 70% of that population are saving in one form or the other. And although these are quite different segments in terms of their livelihoods, they have very similar savings needs. So liquidity, that's kind of day-to-day household needs, or savings for emergency is really coming up as a major use case across all of these segments for their savings. Education is also a top priority. And some of that liquidity need for business owners would also be kind of contained there within that savings for livelihood purposes. But perhaps it's worth paying attention to kind of the savings for your more wealth-generating productive assets like your housing and land. And we can see this is low across all of these segments. So how can people be better incentivized to save towards these productive investments? And if anyone, we're really only seeing this amongst your employed segments, so very much in line with what we heard in the previous presentation. Okay, and where are these individuals keeping their money? Well, a lot of them are leveraging formal financial services. So here, what we've called traditional is your banks, your MFIs, and your SACCOs together. And we split that out to see the difference between the digital savings. And whilst this is relatively high across all of our segments, what I want to draw your attention to is still the significant amount of savings that's kept within your more informal and your social networks. And still, I think Mary mentioned it, still a lot of savings being kept underneath the mattress. And of course, your more informal and social networks for savings, like your chummers, like Carol spoke to, are incredibly valuable. They're very familiar savings mechanisms and channels. And this is by no means making a judgment call to say that they're bad and that needs to be, reduced. But they are less verifiable saving sources. They're not easily trackable. They're not digitized. And so my question to you in the audience is kind of what value can the private sector kind of add to perhaps take more of the savings into the formal domain so it can be leveraged towards more productive investment. Okay, on the credit front, again, we see quite a similar story in that there is a high usage of any credit product across all of our segments. It's lowest again in our food crop farmers, and as we would expect, lower again in our youth segments, but high within our small firms. So we see 74% of our small firms have at least one form of credit product, and that's the same level that we see amongst our public sector. And again here, I think we can start to see, here we can start to see a bit more of the contrast against these segments. So while day-to-day, using credit for day-to-day needs is a major use case, even amongst these more economically kind of active populations, we also see a bit of credit usage for investment, more so within our business owner segments, and again within our private and our public former segments. And I think what would be great to see if maybe we hear again in another 4 years' time is, can we see a bit more of that balance being seen in some of the other segments, so amongst our farmer segments, can we see a bit more credit usage for investment purposes? Can we look at where they're getting their credit products from? Here again, some really big stock differences in these segments. Again, what was mentioned in the previous presentation is your traditional banks and your MFIs and your SACCOs are really only serving the employed segment. So again, it would be wonderful in a couple of years to see perhaps more of traditional banks, MFIs and SACCOs serving the other segments. Digital is obviously filling a really important gap for the others. We see 44% of small firms are saving through digital, are accessing credit through digital sources, similar levels with our urban micro businesses. But again, a large amount of credit is still being accessed from your more informal and your social networks. And that's fine, right, when you need to kind of tide you over with day-to-day needs. But they become less useful channels when you want to kind of get access more larger sums of credit towards productive investment. Okay, so clearly there are some needs, but I'm sure you're sitting here wondering, well, tell me a little bit more about these segments. Who are they? What are the risks in trying to serve them? Can we really try and understand this opportunity a little bit better? And what's quite nice is that I've chosen to focus a bit more on your urban population. So you heard a lot about the rural population earlier. So I'm focusing a bit more on the urban population. And I'm just going to talk you through two segments in particular and contrast them a bit. And that's your urban core casual workers and your urban micro business owners. And you might immediately be thinking, well, these are not your low-hanging fruit because they've got volatile income sources. But again, I want to draw your attention to the size of these segments. And also, a really important point that's been mentioned a lot is that the casual worker segment is becoming increasingly an increasingly important segment for the entire population. So given the size and the importance of them relative to the economy, can't really ignore them. Okay, so what's really nice about these two segments also is that they kind of provide a bit of a gender lens. So our casual workers are predominantly males, 59% males making up that segment, contrasted to your micro businesses where it's predominantly females. I mentioned the casual workers are very young, so 70% are younger than 35 years old. The micro businesses are also young, less so, but also we've got 58% there are 35 years or younger. Education levels are not great, so most of them don't have secondary education, but financial literacy levels are decent. So here we're looking at 82% of urban core casual workers can either read a transaction SMS or calculate an interest rate. So some level of financial literacy. And again, just kind of drawing out the median monthly personal incomes. Of course, these are still low, but they are higher relative to the average population. So there is some money there. I mentioned the volatile income flows and the kind of unpredictable food prices results in liquidity challenges. Of course, we know this. It's a problem across the population. It is a problem in these two segments too, and something that you need to be aware of when looking at these segments to serve. So here we looked at just the more severe kind of liquidity metric. So we said, what percentage of this segment have experienced liquidity distress on a daily or weekly basis in the past 12 months? For your urban core casual workers, we see it's at 37%, so just slightly higher than the population average, whereas for your urban micro business owners, it's slightly lower at 30%. And the bar kind of on the right-hand side of that is looking at the main strategy these individuals are using to cope with their liquidity distress when it comes up. And again, the importance of your social savings and your credit mechanisms coming out very strongly here. And this picture alone can't be solved by the financial sector, right? A lot of the stuff that's been mentioned previously in presentations, so bolstering the economy, supporting value chains. Maybe there's a lot of work that can be done with casual workers in terms of the platform economy to kind of improve their frequency of jobs. A lot more needs to be done beyond what the private sector can do to kind of solve the story. But just interesting to see that really the main strategies that these segments are using at the moment to cope with liquidity is either non-financial or social at the moment. And perhaps this is a picture we're comfortable with, right? What we certainly don't want to see, I think it was Gideon, he was from the rural areas, but I'm sure there's a Gideon in the urban areas. We don't want to see more Gideons with a lot of debt distress. It is something that we're certainly still seeing in these segments. So here we're just looking at one kind of indicator of debt distress, whether these individuals have paid a loan late, missed a payment, or haven't paid anything at all. And you can see amongst your urban core casual workers and your urban micro businesses, relatively high levels of debt distress on this metric in particular. So we don't want to see this over-reliance on credit for day-to-day needs and this debt spiral. So perhaps more needs to be done in other realms, savings, etc., to kind of help with the liquidity management. What will really help with the liquidity management is improved digitization of income flows. So just the first indicator here in the kind of left-hand quadrant, we're looking at the percentage of the segment that are receiving their main income via cash, and it's over 90% in both of these segments. And without visibility on those income flows, it's very difficult for the private sector, right, to understand how to kind of support these individuals with liquidity management and kind of consumption smoothing tools. But they're ripe for digitization. In fact, they are already very digitized, more so than the average population. So smartphone ownership is higher in these two segments than it is for the average population. So it's 49% with your casual workers, 57% with your micro businesses. And daily mobile money usage and making digital payments, again, like Bobby looked at, beyond remittances, is also high amongst both these individuals and segments. So they're very comfortable with digital financial services. Really the opportunity lies here in bringing more visibility into those income flows. And when we sort out the digitization story, we can start to sort out the liquidity story, and then we can really start unlocking some of these individuals' goals and aspirations. And these are highly aspirational segments. So overall, kind of as a group, over 60% of individuals in each of these segments are trying to achieve at least one goal. And what's interesting is that many of these casual workers are trying to get into business. So they're really trying to kind of move towards some upward mobility. And the question for the public sector and the private sector is how can you support that better? Because again, what we see here is that the main strategy being used to achieve these goals is largely non-financial, so kind of cutting back on expenses or working more. Social savings and credit is playing an important role here, but what we'd love to see is a bit more from the traditional space, so that's your banks, your MFIs, and your SACCOs, really working towards supporting these individuals towards productive investment, to again, move towards more upward mobility. Okay. So I'm going to leave it there. This was really just a snapshot into two segments. We'll be doing profiles for all the others. But yeah, thanks very much.
Thank you so much, Jess. That was a fascinating window into a much more deep dive window into some of the trends that we were talking about earlier with Bobby. Tabitha, can I hand over to you now? We are running a little bit late, but we are going to request everybody to give us a bit of extra time at the end so that we finish the session at 1:15 instead of 1 o'clock, and we allow them time for panel. But I think Tabitha's going to briefly take us through some stuff on MSE tracker surveys.
Yeah, thank you, Rick. As I set it up, the tracker surveys that we do are collaboration, just like with the FinAccess surveys. And the results, or what I'll present, has a lot of Amric's input and Jess. Yeah. So I'll start off with what Jess has ended. Most of the casual workers, and even with formal workers, we all want to do something at the side. Like most casual workers, the aspiration is you want to start a business. You don't want to be doing the same. You ask, what do you want to do? or even the formal, like me, when I retire, I want to be a shopkeeper, so that I can be talking to people every day. There is that aspiration to set up a business somewhere. So it is an important segment of the population in terms of labor absorption, and also as a way of people who are transiting out of college, and also some that it's like their main work. So there's a lot of work going on even as we talk. There's a tracker survey. We are collecting data for another tracker survey that we are conducting in collaboration with Central Bank. Thank you very much. And with FSD support also, we partners in this. And we'll see why it is important for that and what is coming out. So we want to look at how MSC tracker surveys can inform policy and the insights that you can get from data that we have collected. So I'll start off with the 2021 FinAccess survey that found livelihoods due to business, or people who are doing business, has declined. And just as a rider, we collected the data for 2021 FinAccess in September, between June and September 2021. And one of the elements, it could be maybe due to an impact of COVID. So these are adults aged, or persons aged 16 and above, earning an income from business. The reason why I put 16 is there are people who are already in employment at that age. And that proportion also, there's a significant proportion of women in business. That is 57% in 2021 compared to 52%. This is, of course, coming from an earlier research that shows that the proportion of men, in the last, when we were launching the FinAccess survey and some other workshop that you had, that they also, men also are affected by, disproportionately more affected by COVID. So from also the FinAccess surveys, there was a reduction, general reduction in incomes from all different livelihoods, but especially from persons in own business, running an own business as a main source of livelihood. So MSCs experience more risk in terms of income, and we want to track how they're affected, for example, by the business environment that they're operating in, and in terms of course, the impact on revenue and employment. So what we are showing is that for the employed, the casual, agri, they were affected, but it was disproportionate to, it was their own business parts, people operating their own businesses were more affected. So the MSC tracker that we want to highlight now was one we did in 2020. It's not, it was before the FinAccess survey. So what happens is when you do the FinAccess survey, we would request all persons to give us their numbers and consent for follow-up interviews. Those are the ones that we target. So the initial sample, we had 3 waves that were conducted over the period, and the sample, as I'll indicate, has declined over the 3 particular waves. And of course, we had some completed interviews over the 3 waves, was around 72–73%. This is what I would want mainly to focus on. The first wave was in November 2020, just after, that is the wave of the data collection. When we had come out of some easing of the COVID, we tried to do some data collection on how they were affected. And then the second wave was in March 2022, not the wave of COVID, our wave of collecting data. You know, there are waves with the COVID. And then the final one was in July 2021. So the focus was on people who were operating a business before COVID, that was in February. And then if they were operating a business in February, we asked if they were collecting a business in the second wave in March. And we also looked at those who were operating then and who had closed after COVID. So 347 respondents were present in all the 3 waves. And what it shows in the bubbles is the particular, in the first wave, 262 persons were operating a business, and 84 were not operating a business during the first wave. And as with panel studies, there's an element of attrition as you come across, either through lack of participation, they don't want to do a follow-up interview, or you are not able to contact them again. So that is the analysis that we base on. So what did we observe in terms of, and what are the main takeaways that you can see from this follow-up of MSCs? Why is it important to conduct this? You are better able to track some of the key indicators and show the implication of policy. For example, when we are having this, when we are doing these particular waves, there are particular events that were happening. Just in November, when we did the first wave, there was a slight easing, but in some places, some borders had not reopened. Some policy interventions had not completely been removed. We are still experiencing the reduction in the removal of the transaction fees, for example, at that particular time. And you're able to see, and of course, the element of people did not want to hand to cash just at the height of COVID. But after, for example, when we were doing the third wave, then things were different. Similarly, when we were doing the first period, there was those roadblocks, for example, preventing inputs that are key for some MSCs, like those who are in wholesale and retail, mama mboga, as you would call the vegetable, where we buy our vegetables, and some other supplies. So what did you observe, for example, in terms of customer demands and in terms of employment? MSCs are also employ a significant proportion of the population. There are those that are one person show, 2 people, and there are those that have enough staff. So we focus on both the paid and the unpaid employees. So in terms of the changes over those phases, in February 2020, which is the first on the right, 75% of the MSCs had paid employment. During lockdown period, which is one of the reference period, it dropped. The proportion of business with at least one paid staff member dropped from 25% pre-COVID to 19% during the COVID period. It's the reverse. 25% had paid employees, which reduced to 19% during the height of the lockdown. In November 2020, when we collected the data for the COVID period and the pre-COVID, this also was at 22%, showing the post-lockdown effect in terms of employees. In March 2021, there's a drop from 463 business owners that responded to 289, but in terms of proportion, 38% that had recovered a bit. And again, in July 2021, that was just 24%. So those who are those with unpaid employees we show that we are able to indicate that in terms of the labor absorption and the labor demand for MSCs, those changes that are there during those three phases that we collected the data. The other important component that we are able to assess in terms of revenue patterns during that period. So the February 2020, before the COVID, is like an index of the changes in revenue. We started, of course, the one, and then in lockdown, April to July, the period when there was not much movement, and then up to 2021. So on average, during lockdown, businesses only earn 38% of what they earned before COVID. And that because of the easing and the changes that happened in terms of policy and also the reopening, there was that increase. But at the end of July 2021, active businesses that had not closed were earning 16% more than what they earned pre-COVID. This kind of analysis is only possible when you are doing the tracker and you are following the same type of businesses to get the insights of what actually happened during these phases. Whereas the attrition is there, but at least you're able to tell the attrition in terms of the numbers of MSCs participating in the study. You're able to properly profile these particular categories of MSCs, both, for example, that are women-owned and those are men-owned. And this is maybe when we finalize, I'll direct you to a particular report that also we have highlighted, we have uploaded in the website of the three institutions and get more insights from there. So from these patterns, you are better able to segment and see the implication of the changes and how MSC is able to navigate the particular shocks and events that are happening, and how they are able to, and this enables us to tell good narratives that inform you users of data what is coming out. And we are able to come up with like 7 segments in terms of revenue estimates. There are those that MSCs, and this is also across particular sectors or clusters that you would say, that there was a continued decline. As much as, for example, previously the general increase in revenue across MSCs, but there are some that had a continued decline, for example, before COVID, that is the lockdown period in November. There are some that totally went off and closed down. There are some that even recovered, and some that were not much affected, that stayed the same. Some bounced back to what they had, closed during COVID, and very little, but they were able to recover in November. And these patterns let us give face and inform the users of this information in terms of the segmentation, especially for particular categories of MSCs, the sectors, which is detailed in the report highlighted, and there's also some good qualitative work that has happened with that. And from the last wave that we did, we're able to segment the MSCs that participated across like 3 broad segments. The ones that recovered, the struggling businesses, and those that totally closed, not operating a business in 2021, like they were totally affected by COVID, where others, they struggled and they're still operating, and some, they have like totally recovered. This provides a rich analysis of what you can do with the data, what you can say much about MSCs in terms of the effects of particular aspects or interventions. And this, just to mention that when you look at the reports that we have uploaded, you're able to, even the issue of digital support that was there, or how they used the digital solutions to navigate the COVID, and also other elements like borrowing and informal support that they received. So in terms of what we saw is that among the recovered segments of the MSCs, those were the more digitally advanced than other segments of MSCs. And this information is crucial so that you can see the element of, for example, the ones that among the struggling and recovered in terms of the use of payments. In terms of the struggling, only 65% were using digitized payments only, and whereas the recovered it was 35%. We have, like, we categorize them across these particular segments. There was an issue of digital marketing and what you are calling digitally advanced. They accepted digital payments and used at least one digital marketing channel to reach customers. Because at that particular point when you had COVID, everyone was like at home, but they could call, use WhatsApp, Facebook, or whatever forms. So the ones that could harness those particular solutions, those particular options that are there for them, the ones that quickly adopted different payment channels, you know, at that particular point of COVID, you could see that explosion in use of digital payments solutions. Yeah, thank you so much. The reports are available in KNBS website, FSD, and Central Bank. Thank you. Amrik is behind all of this.
Thank you so much, Tabitha. Thank you very much for giving us a window into the MSE tracker data that KNBS has been leading along with CBK and FSD. And as Tabitha says, those reports are available on our website, and we'll shortly be producing a policy report with the latest segmentation data as well. Now, we've run somewhat over time. Obviously, very rich material to be discussing here. So I want to invite Ansatsa Were, our senior economist, to the stage, who's going to be moderating the next session. And please, can Peter Njuguna come to the stage as well? And Diritu, I'm not sure if Diritu has arrived. Yes, please do join us. There you are, yes, wonderful. So, yeah. Well done. We have some very youthful panelists who are able to jump onto the stage. That's great. Thank you so much. So, without further ado, I'm going to hand over to Ansatsa and ask her if she would introduce our panelists. And I just beg your indulgence, please, for us to go over to 1:15 with this important bit of the discussion.
Thank you, Amrik, and thank you to all the presenters that presented. And I think if we could get a mic for the other two panelists, that would be really useful. So I think the way we're going to structure this section, I'm going to ask the two panelists for their initial thoughts, and then ask them some questions, and then we'll open to the floor, because I know all of you have a lot of interest in getting insights on this. So I think our first panelist is the CEO of the SACCO Savings and Regulatory Authority. And so he really has oversight over the SACCO sector. He has over 23 years of experience in the sector, so I think getting his views and insights on the data will be useful. And of course, we have Diritu Muriithi, who is an economist. He's a well-known face. I think he was a former governor, and he's also worked with multilateral institutions, such as the World Bank Group. So I think it will be quite useful to get their insights. If you see me looking at my phone, it's because that's where the questions are. It's not because I'm distracted. So I think I'll sort of just start with you, Peter, because you do have that regulatory oversight of the SACCO sector, which I think we saw come up many times. I think my first question for you would be, what are your key takeaways, particularly in terms of the segments that were highlighted? I think you saw Jess and some of the others talk about the key segments, but also just in terms of the sectors that we've seen that are quite active. You know, where does that sit for you as a SACCO, and what has been some of the impact of COVID on those sectors and segments?
Thank you very much for that question, and for the organizers of this. Now, let me commend the team that has put together this work. It's, I would say, excellent piece of work, digging deep into this data. I think we've been stopping at the data, but I can see increasingly we're getting better. And I think for me, the challenge it comes is that we have a regulatory framework where we focus on stability, and therefore you just get the balance sheets and all that aggregated figure for the industry, But above that, if you look at the financial sector development plan, there is also a component of inclusion. So how are this industry and all of us impacting on inclusion? And also the other dimension is efficiency. And I think this, going deeper into this, challenges us to go beyond the headline numbers that we see, because it's very easy for us. Sacco industry, we've seen double-digit growth over years, even during COVID, post-COVID. Headline figures is industry aggregated figures. But I think now we are saying, if it's loan asset, we are talking billions, now approaching $1 trillion, what sectors is this going into? And we can clearly see it will be very unfortunate from this data for us to sit plate and say, the formal financial institutions really that, yeah, we are doing a good job, kudos. Because the underlying sectors are actually bleeding. That's really what we are being told. And I think looking at the structure, and I think what I like is that the Kenyans are on digital finance, social network, finance networks, and they are surviving, but are they, accumulating assets for the future and all that? The answer is apparent, very, very clear, it is a no. But those segments, and then the fact that you looked at the performance of the economy over that period to see what are the root causes of this, I think that's very well done. And the structure of the economy. And I think for me, it's very apparent we have the agriculture industry, service industry, finance sector is actually a service sector. But it should be designed to serve the real economy, the industries and the agriculture. Is it doing that? The data is here to speak to us. Again, challenging us as financial sector players. Are we designing policies that try to incentivize the players to serve the real economy? Because if agriculture is doing like we are saying, employing less, productivity is coming down, even people in farming are moving towards dependence, then we have a serious problem. And yet, agriculture, any economy, food security, all these, we cannot. Industries, most of them rely on agriculture for inputs. So I think there are fundamental questions around there about the impact of financial sector. But I think there is hope. Looking at the opportunities ahead, I think a good job has been done there as well, and pointing very clearly what are the low-hanging fruits. It's a challenge, and I think looking at the data we collect, and perhaps I'll respond to that in second round, there is a lot of work to be done. But fundamentally is to ask, is our financial sector designed to serve the real economy as it is structured today? And for me, it's sad because combined, I think we are over 70% of the GDP. I think currently at 12. If you look at the financial sector, the assets we are reporting are, nearly 70%. But where are we putting this money? It's not evident in the real economy, and except for a few organized, say, agriculture and all that. And we seem to be growing big on service sector. Now, whom shall we serve if the real economy is generating income? That's a big question for us to think as we design policies. No easy answers to it at all, but it's a conversation that has started. Thank you.
Thank you, Peter. And I think that's absolutely the question in the spirit of this conversation. And Sondirit, I really want to ask you, obviously, for your insights as someone who really had oversight over counties, really giving your insights on what was presented, but also giving us the lens at the county level, what you saw in terms of the financial lives of people at county level in particular.
Well, thank you. Well, I'm a bit anxious because, Tabitha said devolution was one of the structural problems that has led to this decline on all the welfare measures. But more seriously, I think, and this is fantastic data, I think the next step perhaps is to look at what is happening on the productivity side. Because as my colleague is saying here, the financial sector is, finance or whatever, it's enabling exchange. So if productivity is not improving, it is likely that, welfare measures will in fact then either be stagnant or declining. And if you look at the data on real wages, even in the formal sector, there's a general stagnation, I would think, for almost 12, 14 years now. So the question is, what is this that governments could do stimulate improvements in productivity. In our case, in Laikipia, we have a couple of samples that could provide perhaps some insight as what could be done. So, in one sample is about 1,600 small businesses that we did something with directly as government to intervene to see how can we improve productivity. And another sample is about 600-700 businesses that were accessing finance because we were doing something. So I would say that that's my take on the whole thing.
I think that's a good point. I think the real economy, I think from a liquidity point of view, the financial sector has to be serving what they view as productive activity. So I think that's a key disconnect that we're certainly seeing. So I think I'll just ask you, Peter, on this is, we saw that the use of SACCOs, and not just in this presentation, but in FinAccess generally, it has been declining over the years. So what we tend to see is that for those who do use SACCOs, it's very valuable. But the feedback we seem to be getting is that there's a lessening popularity of the segment, even as the asset base grows, to your point about not reaching as deep as perhaps would be preferred. So it would be really useful to find out from your position as a regulator, what is driving, this relative, aggregate decline in sort of the relevance of SACCOs to Kenyans, but also, what sort of key activities and strategies are you using to try and make that a really relevant use of finance? Because when it is useful, it is transformational, is what we often find.
Thank you. I think I would say that one, in the FinAccess, there were reasons as to why SACCO's popularity is declining, but I'll speak to what the data actually has indicated here, that SACCOs serve the formal employed people, both private and sector, that they thrive in that. That has stagnated. Two, they also serve organized value chains. When you go to tea, milk, and coffee, they are big time. When you go to horticulture, that market is still not very organized. There are efforts, but it's not yet really there. And therefore you find, and then you go to MSMEs, another segment. There are efforts, but I think that again. So I think the question is, SACCOs were founded on these key value chains and then employed people, and with that segment then declining, you will expect naturally their market. However, they are trying to actually open up. I'm sure the former governor will confirm, like in his county, all the SACCOs there have rebranded. If it was a teacher SACCO, it is now having a name that appeals to the general population. But again, they are attracting these MSMEs, this market where, again, they are not used to, what I would say, the market is not very organized. So those challenges could also come in because lending to that area, so meaning that there is work to be done in lending to MSMEs. How do we, do that? However, the numbers we have collected over the same period, I think 2015 to today, actually show the assets for the SACCO industry have actually doubled. Membership has also doubled from 2016 to actually 2021. Again, telling you the paradox that relative terms, they are not reaching out, there's more work to be done, their popularity, usage and all that, but all the headline numbers are growing. And now and even including the membership they are serving is grown as well, doubled. And I think that now raises questions to, again, look at this, because those who public sector, like shown by the numbers, if it's coffee farmers, tea farmers, they are still faithful to their institution because they have been able to create history, accumulate assets. But I think the question is, as you indicate, are these number declines of these people, then what happens to the SACCO? Where will they recruit members? And I think that's what we are saying, the productive area, we have to do something so that other people can transition in the income ladder and then become credible. And the question is, which tools do we require to support them? And I think that's what the last presentation opportunities that are there in that segment, that's where for me I saw the low-hanging fruit.
Thank you. That's a really good point, because often if an industry just looks at its own performance, it will have a very different story compared if you look at it from a macroeconomic perspective. So I do want to ask you, Nderitu, about the devolution question so that you can highlight, because it is something that we are very curious about. So in your view, what ways did devolution improve the financial inclusion, financial health, and economic opportunity? But also in what ways did you frankly see it didn't really help? It would be really useful just to get your insights on that.
Well, I think it did help. You see, even from a normal economics conversation, decisions should be made closer to where they are required. So if you think about efficiency, say, in the public sector. So for instance, if, a neighborhood, path or footbridge needs fixing, if that decision has to wait for a person who is in Nairobi, then it will go unfixed for 3-4 years. So I certainly think that it has helped. Casual observation would also point to the same. If you go to most areas where, say, rural infrastructure, for example, roads, whether, improved roads or just gravel roads, where they would not have been and have not been possible, for all the years before devolution. I know that, for example, our colleague Tabitha talked to the question of agricultural extension, but you see, the extension officers were devolved, so it's not that they left the service. So our, and I think there is some actual analytical work with the COG and others that does show that there were improvements. But could we say devolution has improved financial access? I think that would be somewhat of a stretch, because the financial access was improving generally, and financial inclusion was improving generally, mainly, in my view, because of digital and mobile phones, and that was across the board. So and I think finally, devolution presents the possibility of multiple centers of growth, which has again been a traditional question in the Kenyan context, whether are we growing across the country, or are we growing only maybe in the major centers like Nairobi, Nakuru, and so on. So I think devolution presents that additional possibility, and obviously county governments are able to intervene, albeit at a smaller scale, in terms of what is happening with the economies.
Wonderful, thank you so much. I think now we now open the floor, and I think when you ask the question, please give your name and your organization and who you're asking the question to. Of course, you can direct the question to the panelists with their rich wealth of information, but also you can direct your question to the presenters that made, so that we have at least 10 minutes of questions from the floor. So is there a mic? And I think you can just raise your hand. And then I think we'll start with Prof at the front, please. And then we'll go to the back. Please do just state your name and your title for record, and who you're directing your question to. Thank you.
Thank you very much. Thanks to the presenters. I must say I've really enjoyed the session. Very insightful data. Thanks a lot to the panelists as well. They've given a lot of good insights. So my questions are directed to Tabitha, first of all, in her presentation, and then Bob as well. So first one is related to crowding out, this crowding out narrative. I think this is a narrative that Tabitha stated that you can actually see crowding out, and crowding out has been increasing, but actually you see a lot of evidence of a counter narrative against crowding out, because crowding out assumes that as the government is borrowing more, you have larger budget deficits, interest rates are rising interest rates actually lead to lower growth of credit. In fact, you've been seeing the opposite happening. Even in recent months, the last couple of months, you've actually seen credit growth going up. The budget deficit has actually been falling. If you look at that, government has actually been diversifying its sources of borrowing. So initially there was very heavy domestic borrowing, let's say a decade ago. And in the last 5 years, you've actually seen a balance between domestic and external borrowing. So in fact, there's been less pressure on the domestic market and substantial increase in external borrowing, so that you have domestic and external borrowing actually at 50-50 almost. So let's just say you don't really see very much evidence of crowding out. So I'd really challenge that narrative that, yeah, we've been moving towards a lot of crowding out, and just say that actually the statistics tell us otherwise. Even in recent months where, because of tightening of monetary policy, the interest rates have been going up gradually as you have monetary policy transmission through the economy. You've still seen, with the exception of a small dip probably around August, you've still seen private sector credit broadly still trending upwards and really recovering. So I'm just saying there's a lot of evidence that actually from the data that challenges this crowding out narrative. So it's something we need to explore. Also, second issue sort of that struck me was on exports contribution to GDP actually falling. I think there, from an econometric point of view, you have to consider that we had a COVID-19 pandemic in 2020, so there was a structural break. So you can't really, if you're looking at the evidence in 2020, 2021, seeing exports to GDP declining, that's a different relationship from what you had prior to that, because of course that was a global shock. Incomes fell very substantially all over the world. You'd expect countries that are exporting, especially diverse exports like Kenya, you'd expect some decline in exports. So just saying that, again, I would challenge the narrative that exports, that you really have a sort of long-term decline in exports to GDP. In fact, there's a lot of evidence to the contrary. When you look at disaggregated data, you actually find that exports are becoming more dynamic. We're expanding our let's say markets. We're expanding export products. We're increasing export product complexity. So I think there's been a lot of dynamism in exports. So just looking at that one number can be really misleading, because it actually doesn't go into sort of the disaggregated story of export dynamism. In fact, exports in Kenya have actually been much more resilient even to the shocks of COVID-19 and the more recent shocks we have from the conflict in the Ukraine than in many other countries. Even our most recent export statistics show year-on-year growth of about 11%, which is actually much better than many of the regional peers. So just saying that, just looking at that one number and saying that exports are actually declining relative to GDP, there are a lot of nuances there that really one has to look at. And one final point is just, this is on Bobby's presentation. Again, very interesting statistics there. But just I would raise a research question, which is, when you say, well, we did some econometric analysis. Based on the econometric analysis, we found this causality. It's really not enough. You have to give much more detail about what kind of econometric analysis, what sort of estimation methods were you using, how did you address key microeconometric problems like endogeneity, reverse causality, how did you address, these are sort of the fundamental things you want to address when you're bringing out causality. When you're looking at the descriptive part and you're saying, okay, these are the sort of trends we see, that's fine. But once you get into causality questions, then now you need to give much more detail. I'm assuming, of course, that there must be some sort of underlying inferential analysis that's quite good, but I think some of that has to be sort of brought out, even briefly, just to give a sense of how did you arrive at those causality relationships. Otherwise, people could question that. So those would be some of my sort of preliminary comments, but otherwise very excited about the conference and the discussion and the insights. Thank you.
We'll collect a few questions and then allow for a response. I think there was a hand there, there's a lady, and then there's a gentleman in the back. Is there a mic that we can, oh, sorry. I think there's the lady there, then there's a gentleman in the back, and then after that we'll allow the respondents. Name and institution, please.
Thank you. My name is Judith. I am from Kipra. My questions are brief. To the presenters, especially the first set of presenters, a very rich presentation, but with very many moving parts, and I kept feeling like if we were to put government officials in this room, what will we tell them? So the need to tease out the policy recommendations is very key so that we can be able to know what are the pressing problems that we can address to make Kenya move forward. And just to give an example, I saw our statistics about the learning poverty, where maybe secondary school education could be, there's a higher learning poverty at secondary school level than primary school level. And recently we just saw an overhaul of primary school education. So I thought maybe some of these things which are coming out could actually, well articulated, could actually inform what the government is doing so that we can address the key problems. Then the other question is just one to ponder on about dependency, increased dependency. And I was wondering whether there's any relationship, if so, between the increased mobile uptake and dependency, more especially that we are able to borrow as and when we can. Also, when you're looking at that particular aspect, maybe somebody could be thinking about how Kenyan, not even Kenyan, African culture around the need to support our siblings. We saw the report for, is it George, who always squandered the money and expected the sister to support. Then what does that mean to our economy? And this is, I think, largely African. And then the other question is the story of Lucy, where Lucy is able to, was a former public, I think, servant, and was able to get money to build some rentals somewhere, I think maybe in Syokimau or so. But then the question is, the Lucy of today is working the public service. Does the story reflect the Lucy of today? Why? Because of the rising gig economy, where, in fact, the people in the informal sector, I don't have, statistics that I can point to, but we can clearly tell that they earn more. In this sense, even the president the other day was saying, we are seeing a lot of, we are seeing minimal collections by carry, yet there's a lot of transaction, money being passed from one person to the other, especially in the informal sector through M-Pesa. So maybe the Lucy of today is not a public servant, but is one in gig economy. And I think that will really inform where tax man should be looking at. Yeah, so I think those will be my contributions for now. Thanks.
Thank you. Please remember to say who you're directing the question to so that they can prepare. So I don't know, was that to Jess or Tabitha? Or?
It was the first set of presenters.
So I guess Bob and Tabitha. Okay. We have a question in the back.
Yeah, thank you. So my name is Kefa Simi, a student at the University of Nairobi. And my question is directed to Ms. Carol regarding chamas or self-help groups. Yeah, because from the presentation, she had hinted at them being beneficial, particularly to women and the youth. However, I have realized that most of these chamas, they never last. So, based on what you have been working on, what insights can we carry forward in guaranteeing the longevity of these chamas? And lastly, I would love to hear whether you have been able to maybe track down some of these chamas for the past 5 years so that we can have an informed understanding of the issue at hand. Thank you.
Thank you. I'll allow the respondents, and please, panelists, if you have a response to the questions, please free to jump in. So I think allow the first round of responses. Can you just bring the mic to, yeah.
Okay, thank you for your comments. I will start by saying first that what we presented is an extract from a larger paper that has been done. On the issue, okay, I'll go now one by one. So the context of what has been extracted, some element may be missing, and probably the gaps in the communication. On the issue of the crowding out, Prof, I think we look into how we are phrasing our narrative, and appreciate your comments. On the table of, there's a chart where we're looking at the issue of exports. Again, in the main paper, we are looking at the exporting, especially for the way the paper is, we are looking at the livelihoods. So we are looking at the core exports, the particular, especially in agriculture, that employ significant proportion of labor, casual labor. So the key, I mentioned the issue of the key crops, although it's not in the presentation, tea, coffee, sugarcane, and horticulture. They employ a significant proportion of the population. So that was the context of that. So lower earnings in those particular exporting sectors I think it's a lack of disaggregation in terms of the key exports, in particular the ones that employ the key crops or key particular products that employ a huge labor. That is what is missing in the presentation, and will that is highlighted in the broader paper. So that was the context of that slide. But it's true that there is a diversity in our exports, in the composition of our exports. I think those were the key points directed to me. I don't know my colleagues.
Yeah, thanks very much, Prof. And I think what you've highlighted to Tabitha in terms of the sort of contextual economic work, it's really important because we were observing some patterns that were taking place particularly after 2015. And of course, as Tabitha pointed out, the credit cap had a very big impact, maybe not in crowding out, but certainly in a reduction in private sector extension at the time. I'm glad to hear that there's a recovery, and hopefully, as Tabitha is saying, the focus of that recovery, whether it's export-based or whether it's domestic economy, is in sectors that are going to be greater employers of Kenyan labor. If that happens, then hopefully we see some of the reversals that we were noticing on the livelihoods perspective. And I think from a policy perspective, that is really important. It is important to have complexity and that complexity is labor absorbing. And then on to the second person who was posing questions, I agreed. Like we can improve in terms of the policy implications and the education as well. Some of the things that Tabitha was detailing is, I suppose, reduced competency as people are moving across grades. But it isn't just that maths and science is going to prepare people to be absorbed in these sectors. As you're saying, with primary school, with primary education being overhauled, and hopefully that takes place, the economy is increasingly becoming more complex. The requirements, especially in terms of digitization for people to be employed, are such that the education system needs to keep adapting to prepare people to change the relationships where, let's say, ICT and insurance and financial services are not employing that many people because the skills that are required are not as prevalent in terms of the throughput coming on. So, yeah, that's a really key point that's being raised. In terms of Prof, on the limitations on our models, agreed. There's more that needs to be communicated in the paper and could have been communicated today. I think one overall thing is that compared to some of the other research that's being done, when we've just been relying on the FinAccess data, which is cross-sectional, it's not panel, doesn't follow, it doesn't have an experimental design, it's definitely limited in terms of the insights that can be made. We can show, a lot of what our insight is descriptive, and it's descriptive with a little bit more. So sure, we did some pseudo-panel econometrics to show that there are relationships between people that are vulnerable and having lower welfare and digitization expansion. And our narrative on that is that it's not digital products that are causing people to have lower welfare. It's really that they're supporting, that they are helping as safeguards. At the livelihood level, we did some propensity score matching. But the propensity score matching is limited by the number of characteristics that you can actually control for. And again, I think FinAccess is, it's not that at the very start of FinAccess design, these kinds of research questions were thought of. So there's going to be limitations, and particularly with propensity score matching, as you were sort of alluding to, it's only as good as the characteristics that you can control for. And I think for a lot of the things we're looking at, there are limitations, but it is something for future FinAccess studies and design that can only enhance. As FinAccess has added so many important areas over time, it's just something more. In terms of some of the other policy questions from the second questioner, on mobile credit uptake and increased dependency, that's a very good question. I think just as a continuation in my responses to Prof, I think we'll probably be limited by the data in terms of being able to identify very strong causal relationships as in terms of dependency and relying on siblings. But as you point out, they are really interesting research questions to continue exploring. And in terms of who will be the Lucy in the future, I think that's a really important question that expands on the sort of structural changes we're seeing. Even if the Lucy, is it even the case that the Lucy in the present, let's say a public sector employee is going to be able to leverage their access to SACCOs and traditional bank credit to have the same kind of trajectory that Lucy, who started in 1999, will have? It's a very important question. And then for someone in the digital gig economy who doesn't have that kind of access to SACCOs and to banks, will she have the same beneficial trajectory? Hopefully that will be the case. And I think that this session is helping us to identify the kinds of support and changes in the financial system to enable that to happen. I'm going to pass over to Carol for the last question on chamas.
So thank you for that question. So I think the first thing to consider is what really makes people come together as a chama sometimes is not necessarily about getting credit or saving. It's also your social support network. I think many of us have chamas with our family members who default, and we've never left that group, isn't it? And also we have to appreciate that chamas realize that those are the challenges, and they're evolving and innovating. We have many chamas now that operate as askers, meaning at the end of each year, they then share out all the finances and ask members who want to rejoin to start afresh. They're also adopting other tech ways of ensuring that some of those issues they do face are addressed. And it is true, maybe chamas fall out, but as we know as women, we exit one chama and tomorrow we've joined another one, isn't it? So I think they do serve that liquidity issue. Whether or not they're able to serve it for a long time for the same members is what might not always be clear. But there's always the option of exiting and starting afresh.
Thank you. I think we'll allow final comments and then close. Go ahead.
Yeah, thanks. I wanted to respond to the question Prof raised. Is there no crowding out? And I would give an analogy. Supposing the Prof and I are running, let's say, in a sports field, and he is in his lane, I'm in my lane, but he's running 5 times faster than I am. I suspect he'll get to the finish line earlier than I will. Now, yes, private sector credit or credit to private sector is trending up, but it's trending up at 3 or 4%, whereas credit to public sector is galloping away at 15, 16%. I would argue there is crowding out because the speed of change is way faster on credit to public sector. On the question of what is the policy takeaway that our colleague asked, I would see plenty. I mean, for example, out there, we are debating something called Hustler Fund. I mean, what problem exactly are we solving? Is it a lack of access to finance, or is it the kind of access? Is it the channel? So I would think looking at this data will help my friend, colleague here from SASRA and others who have to design whatever that fund is going to be. So I would think there is plenty of insight that we can take away from this. And finally, you know, 15 years ago, I think at the time all this was starting, or even earlier, it was thought that access to finance was sort of the key to unlocking, you know, growth in wealth. But what this data is showing is that we may need to rethink that. So I think there's plenty of policy takeaway. Thank you.
Thank you. I think I want to add, there are many policy questions that come from here, policy lessons indeed. And one of the questions, especially the opportunities looking ahead, the micro and small enterprises, you realize that from the data you can see lenders are, you know, are open to markets or segments of the livelihoods that are stable, predictable, and easier to deal with. So in these micro, small SMEs and others, you know, one of the questions is how do they organize this? You know, he's talking about chamas having a high mortality rate. But I think one question that keeps revolving, if it's horticulture and other segments, even, you know, to look at our public transport system, how do we organize it such that it is attractive and sustainable, even from financial perspective? And I think that is where, if you look at what informed some of the farmer-based circles you find in the counties, is because there were a way of organizing those people. Now today, horticulture farmers are starting, and there is, you know, organizing them is becoming a challenge. If it's, you know, matatu, we know we came with the policy of transport companies, transport cooperatives, not circles, transport cooperatives, but still, it's like we back up. And I think those provides opportunity where an industry, a sector is organized, then it becomes easier because there is a, we say, you know, there is this term in economics, we talk of the failure of a market. And if industry can coordinate itself for its own good to address not just capacity, access. And for these emerging MSMEs and all that, what opportunities there to be structured, organized in a way they can converse with the financiers, with the government and all that for their own sake. Because a market that fails to recognize that over in time, you cost it to access credit, difficult to interface with the government, market access becomes issue, quality standards become issue, and that now seems to, so even as we see the opportunity looking forward, I noted digital was highlighted. Remember, digital is still service. What are we doing about the productive economy? So I think I see policy conversations around there. How do we help those farmers? Because they don't know about market access. We collect the data. So there is huge opportunity there, like she asked. I think the data talks to the other side where the productive sectors, policymakers need to see, because finance sector can only thrive when the productive and other sectors also thrive. So there's room for conversation there to see what needs to change. And I think that's part of what, as we deepen financial inclusion, we need to see how do we, as policymakers, have that conversation. Because I think someone said yesterday, there is a lot of silo aspects. How do we work in a synchronized way? Because we know capacity a question, you know, market access is a question, standardization is a question, so that when they produce or they offer service, there is a level of standard that will make their products competitive and possibly improve incomes moving forward. And that way, we'll see the impact down the line on the financial sector. So those are open questions that really need to be asked, even as we say there are opportunities here. Thank you.
Thank you very much. I think we'll close this segment of the session, and thank you very much to the panelists and to you all for your questions. I think if you have follow-up questions, you can try and find the person and corner them. So I think I'll hand over, to Amrik for the closing. Thank you.
Thank you, everybody. That was very, very rich discussion following a rich set of presentations. So thank you. I think there's a lot more we need to say and question and ask really on the basis of the topic that we've just covered and the information that's been presented to us. We could probably spend the whole day on this. However, you know, we also need to eat, and we need to move on to our exciting session in the afternoon with the regulators. So I would now like to invite everybody, please, to proceed and join us for lunch. Maybe somebody can guide me on the provisions for lunch. I'll hand over to my colleague here at Twasi. Are you? Mm-hmm. To the plaza. And somebody will be giving you a meal card. Something to do with Plaza FF, is that right? Does somebody direct us to the plaza in question? It's just here. Okay, perfect. So it's that way, and you'll be given a meal card. Okay, I look forward to seeing you at lunch. Thank you. And we'll be back around 2, if possible. Chiamo, can we come back at 2:15, or is that 2 o'clock? I'm told 2 o'clock, please, is the time to be back. Thank you.
FSD has been working since 2005 to promote financial inclusion in Kenya. Kenya has made huge financial strides during this time. Over 75% of the population have access to a formal account, even if it's just a mobile money account. But are formal financial services really delivering value to low-income Kenyans?
My business partner and I went to the bank and we asked the manager if he could give us a loan, and then he asked us how much we needed at the time. The manager asked us if we have exhausted all our other options, if we've asked family, if we've asked friends before, because he was he wouldn't advise because of the interest rates and everything. So he was now if we don't get anywhere else, now we can go back and he can see if we can get. Okay, it was a bit disappointing because I thought we bank with you guys, probably you'd give us a good rate or something, considering you can see how our account has been growing. After the first experience, it was a bit discouraging, so I'd rather I feel like I should just look for other options before I consider them as an option. So far I haven't gotten any loan from a bank.
Despite these achievements, our research shows that the relevance of these financial services in the everyday lives of Kenyans is minimal. So why is it that Kenyans just are not using banks?
Well, I think that's a really good question, because although we've seen the numbers of people having bank accounts go up, what we know is that they don't use them so much.
Yeah.
And I think, again, it's about the fact that when you put your money in the bank, it's not being put into this enabling you to build friendships, to build relationships. People would love to have a relationship with the bank, but then they find that it's really hard to get a loan from the bank.
Right.
And if they do get it, then they find it really hard to manage it, because maybe they've had some crises and the bank won't really listen to them when they need to change
not as flexible.
Yeah, and therefore that puts them in more of a problem than when they started.
What happened now, we had to go back and now ask our family members for money. So now I was lucky enough, my mom assisted, also my dad gave me some money. Luckily it was interest free, so I'd pay them slowly. Yes.
Unajua zina kazi ingine, kazi ile nafanya ni yangu ya mechanic. Saa hii nikifanya kazi hapa, tuseme nimepata 1,000, 500 naweza kwenda ni save kwa hiyo chama yangu. Hiyo inaitwa Best Rock Sacco. Juu na hao watu huwa wanapitianga hapa wakicollect hizo pesa, badala uende huko bank ufunge line huko na kenye unaenda kufungia line unapeleka 500. Sasa nikaona hiyo chama yangu wewe inafanya mzuri, na kila siku wakipitia hapa, tuseme hata niko na 200, niko na 100, na wapatia na wanachukua, na hiyo pesa wanaenda wanaweka, na hiyo pesa ni yangu. Hiyo Best Rock Sacco, ukiwaitisha tuseme loan, unataka loan, wanakupatia tu, hawakuangi na process mingi.
There are two really important realities to understand about low-income people's lives, and one is that their incomes are really, really small. So whenever they need to spend money for one thing, it means trading off with another. So the incomes are really tiny. And we also saw that they're really volatile. So from month to month, income goes up or down by about 50%. So that's very difficult to plan around. And we also saw that people were very rarely just putting money aside in a savings account or under the mattress even in large sums, because they needed every shilling to be working. It couldn't just be sitting there. To just leave it sitting there would be wasteful. So they needed that money constantly working for them, whether that was in a savings group, where when it wasn't with them, it was with a neighbor who was making an investment. there are lots of different ways that they wanted that money to be active at the same time as it was being saved.
Hii familia yangu mimi utegemea hii biashara ya nyama ndio wasaidia nayo. Mbuzi natoa sokoni. Naenda sokoni, nanunua mbuzi, nakuja nazo, napeleka kichinjioni, naenda kuchinja. Nikichinja nakuja nauza. Mbuzi anaweza kama ni wa 3,000, anatoka kama 4,000. Sasa zile pesa nikipata nikichinja wale mbuzi wakiisha, zile pesa narudisha tena sokoni. Zile faida ile napata napeleka kwa chama. Capital ya kazi narudisha tena kazini. Kwa kucirculate namna hiyo inaenda ikizaana faida ambayo naiona. Ndio kwa banki ni sawa, sikatai. Lakini hii naiona nafanya kazi na immediately.
People have sort of two competing priorities that come out of that. One is stretching their budget to make it work when income is low or something comes up that they weren't expecting. And the other one is growing their incomes so that they're investing in a better future, whether that's in an actual income earning activity like a small business, or whether it's investing in school fees or buying a piece of land. And when you have such a small amount of money to use in terms of savings, you have to be really creative about balancing those two priorities of stretching the budget and growing your income. We found that people were using lots of different financial devices at the same time to try to make those two priorities work together. So they might be taking credit at the shop, borrowing formally and informally, belonging to a number of savings groups. We found like more than 10 in a household that were happening simultaneously.
Mimi ni fundi. Sana sana huwa nashona na mapato yangu ndio ninajisaidia nayo kutoka hapa kwa kibanda yangu. Huwa ninaingia kwa vikundi vya kina mama. Natoa tu kidogo kidogo. Baadaye nikipata huwa natoa karo ya shule, nanunua chakula, mavazi, najisaidia. Sasa si unaona vile nikiweka kwa vikundi vya kina mama, za zingine watu napeleka bank. Alafu sikikuja kwa nyingi tunakuja tunagawana.
Chama niko na 2. Ya kwanza natoa 200 kila siku. Na inanisaidia mimi kulipa nyumba ama kulipa school fees. Hiyo ya pili nachukua, naangalia biashara venye inaendelea, nachukua doko napeleka bank.
Which of these services do you value the most? The bank or the chama?
Chama. Ndo napata pesa haraka haraka. Ndo napata pesa kama pesa ni mingi.
When I did research, I found that Kenyans value financial services not just for what they can get in economic terms, but as we said, also for them to fulfill other well-being goals and well-being values. And actually, respondents and people I talked to say that they can have a lot of motivation in terms of saving in the bank and also in terms of planning for their expenses. But at the same time, it's very difficult for them to build relationships through the bank. So while the banks can give them a sense of social status, it's very difficult for them to actually build a sense of identity and belonging, because through a bank account, they can't really develop relationships and social networks. And at the same time, also, banks don't seem to operate on those modes of development that are typically in communities, so the mutual development and mutual support, because it's not clear when people put their funds into banks whether they can actually get these funds to work for the community through, for instance, loans.
Uplifting a friend means you cannot just focus on yourself. For example, sometimes a member of the chama may not have any money and she may not want the whole community to know she is struggling. The chama can help by supporting her so that people don't know what she is going through. That's how we run things. We agree not to expose each other's challenges to people outside the channel. We can't do that for people who aren't members of the group, but if they are members, then we are able to assist. So by sheltering one another like this, we cover each other's nakedness in times of need.
Tawaambia waingie waungane, waanze vikundi, watoe pesa, wakiunganisha pamoja wapate kitu ili waanze kazi.
And I think Mshwari is really interesting in the way it's come up, because of course it has got a bank behind it, but it's got a very different identity.
Yeah.
And what people are seeing with Mshwari is that they can take loans, they can learn about it, but they're seeing that the Mshwari is trusting them with their money. And I think there's a perception in banks that the bank doesn't trust people
trust the client
with its money. You have to trust the bank with your money before it will trust you with its money. And Mshwari is slightly doing that the other way around. And that's partly why it's very popular. So it's building a relationship which people start to value, because they want to be able to build that relationship and able to develop in the long term. They want a relationship which is around finance that can take them into the future.
Watoto wamesoma, niko na kijana amemaliza, niko na msichana pia, kijana amemaliza college na ameanza kujisaidia mwenyewe. Niko na msichana amemaliza last year, pia amemaliza form 4. Na pia niko na mwingine mdogo. Naendelea na mimi na bwanangu.
If formal financial providers want to develop solutions that work for people, they need to come out and talk to people. There is a lot to learn.
Mshwari is designed for the people on the move.
Mobile technology has made our work to be more easy than it used to be.
In fact, the mobile money has transformed the way we work.
The purpose of this research is really to understand the use and the impact of Mshwari amongst the Juakali sector in both rural and urban Kenya.
The word Jua means sun, and Kali, the hotness of that sun.
It signifies the informal sector in Kenya.
Juakali is 90% service industry. We're talking of masons, we're talking of plumbers, we're talking of all the artisans.
The Juakali sector is very critical to Kenya.
It is the one that employs so many people every year.
About 19 million people are self-employed in the so-called informal sector.
The only way we can provide solutions to unemployment in this country, which is a serious national problem, is by expanding the Juakali sector.
Before the mobile telephone came along, the bankable populace was very, very little.
For a long time, the traditional system has been walking into banks physically.
Some of us who had accounts would walk maybe from Kaloleni to Mombasa, 44 kilometers, just maybe to make one transaction.
This in itself cuts out quite a segment of the population out of the banking services.
There were many difficulties for artisans opening an account with maybe Standard Chartered or Barclays. It was very difficult.
Mshwari, I can just say, is an idea that came at the right time.
It's a product that has been developed by Safaricom,
which allows people to bank electronically and to access credit electronically.
It's really to help provide access to resources, small loans, and also access to savings for many small and medium-sized businesses.
Like us here in Juakali, there are things which we shop in small quantities and within a very short duration. And you know, in that short duration, you can't go to your bank in 2 times in 1 hour. But with this M-Shwari of yours, it is very easy.
Instead of taking my 5,000 shillings to the bank to deposit in my account, the account is here. You don't have to move.
Nowadays, I've reduced in saving at the Equity Bank because of time. After working here, I get money, I just deposit in the evening at the M-Shwari.
You can borrow money from M-Shwari in cases where you need money to improve your business.
You'll just go borrow some money from the M-Shwari. You give an amount to pay with a very, very low interest anytime that you're short of money.
There are a lot of people who would like to use M-Shwari, but sometimes the basic understanding of the product is not there.
It's a very good service, but I don't know how to use it.
To myself, I do understand it's like an account, but I'm not all that sure.
Most of us don't understand exactly the transactions that goes on through M-Shwari.
That is what I want to know. What is M-Shwari? What is it for? What are the benefits of it?
The biggest challenge is that of loan.
The conditions, they're not very easier for small earners to borrow.
They don't tell us how much money you have to put in that account to qualify how much money to borrow.
Among some of these challenges is a lack of adequate awareness.
They don't know who is the owner of the M-Shwari, whether it is Safaricom or Commercial Bank of Africa, they don't know.
How is this link between this central bank and M-Shwari?
The product is good, but it needs follow-up.
Safaricom and that other bank, they have never taken that active role of promoting M-Shwari in the Juakali sector.
But if I'm explained more about it, I'll get more interested. It might be a benefit to me.
Most of the people here want to register in M-Shwari, but they don't know the process.
Many of the mobile money services are available in urban settings, and they're often more understood in urban settings. The people in the rural regions often don't have as much access to financial institutions and resources.
Most of the technology is in English, and most of these people do not understand that language.
What we hope that will come out of this research is that the findings will help encourage service providers and policymakers to ensure that the practices they have in place and the policies they have in place really engage the Juakali sector more in the Kenyan economy.
I wish M-Shwari would either be translated in a vernacular language or maybe in Kiswahili, where majority of this community understand it better.
Safaricom or its agents need to move to the grounds and explain to the people how to use this facility.
Nobody could think that you could do business through the phone. It has really transformed lives.
The saving with the M-Shwari gives you a solution to your financial needs.
M-Shwari with the other modifications and improvements can be taken higher than what it is doing right now.
This anthropological project had as its first objective trying to understand how people use mobile phones here in Western Kenya. M-Pesa is a mobile money sending service that was introduced in Kenya in 2007. Since then, it has become extremely popular. Many development economists approach the study of mobile money from a financial inclusion perspective. This project takes an anthropological approach. It sees the practices of mobile money as a part of an existing social and cultural background. This area is a rapidly changing but still predominantly rural area. People are involved in agriculture, but also many other ways of making a living. Trading, having small shops. One important source of income is mobile money remittances. Remittances have a variety of purposes in Western Kenya.
Ebulwale nalwala eja nanyolekhana nda accident mala omundu wandumira chisende narumikhila kaba japu niye wandumira mala chanjenda.
Kama ukitaka kununua ng'ombe ama kujenga nyumba, yani shughuli kubwa kubwa, ama mtu amekosa school fees, unaweza kuenda ukatransfer ukamsaidia.
Remittances have economic uses, but they also have important social meanings. They express caring and create relationships based on the exchange of assistance.
When I'm just feeling good and I have a little money, then sometimes I'll send it to something to my grandmothers.
For urban or international migrants, they are a way of maintaining social relationships and social presence in a community. There's an interesting duality to the mobile phone. On the one hand, mobile phones create connections and relationships.
I think M-Pesa has made relationships stronger, and they help you save on time and energy and money.
On the other hand, mobile phones also highlight the ability of individuals to create and shape their networks. They give individuals a lot of autonomy or agency in shaping their connections with others. People use mobile money to participate in groups.
Through mobile, it's easy for people to send their monthly subscriptions or contributions.
A quarter of the money that is contributed in steering committees when we have funerals is by this.
This concept of money pooling has become very, very common, and I found it to be widely used amongst siblings, family groups, but also students. In order to understand how money circulates in groups, I've been using social network analysis to actually draw the pathways of mobile money remittances in families and groups. As an example, Sarah is a Maragoli woman living in Kimilili. Her mother was the third wife of a polygynous man. At his death, the other wives chased her mother away from the homestead. They moved to Kimilili, where Sarah's older sister Joyce married a Dutch man. Joyce now lives in Holland and sends Sarah $200 to $300 each month. She uses the funds to support her friend and fellow seamstress, Cecilia. She also sends remittances to her brother, her mother's brother, and her mother's sister's children. Her 20-year-old niece, Flora, attends an accounting college. Flora receives the most remittances in this network. She receives money from her mother, her aunts, and her uncles. Using mobile communication, individuals like Sarah can shape networks based on dormant kinship ties and on the existing importance of siblings in Kenyan families. The project drew mobile money graphs for 14 families. This allowed us to examine the main properties of the networks. They are based around groups of siblings. They are often connected to other groups of siblings by relationships of descent or marriage. Men and women participate equally in these networks, and people of all ages and genders can become central in networks. Furthermore, these networks are dense. Individuals have many connections to other individuals. These are properties that maximize the distribution of mobile money across a family group. They represent the way long-term traditions of mutual support and reciprocity are now expressed through the medium of mobile phone use. One thing we found was that women tend to receive a lot of remittances. Just because women receive a lot of remittances doesn't necessarily mean that they benefit from them in ways that we expect.
I know my grandmother, she has many friends and they'll come to her for help. They'll be like, my sons are not working and I have this problem, can you help me out? So they'll be like reaching on to her for help.
So the ethic of generosity also places pressure on people to recirculate remittances to a certain degree. The individuality of mobile money and mobile phones often means that the secrecy, the privacy, and the exclusion that is allowed by mobile phone communication is very important.
People use their phones as a way to shut out people that they don't want to talk to.
People try to manage their participation in these groups that circulate money by turning off their phone. In an extreme case, you could even get a new SIM card, which is often taken to mean that you want to sever contact indefinitely. We met many people who complained about the ability of mobile phone connections to disrupt other important social relationships.
A husband may beat his wife because of the phone.
Mobile phones have caused marriage breakages in our country.
Mobile money has empowered individuals to create a networked self. In so doing, it has allowed individuals to create new connections, but also to sever connections. Social life in Kenya is being dramatically changed by the use of the mobile phone as individuals create more control over the social connections that they produce and participate in.
My name is Caroline Gina. I'm an entrepreneur. I run a cleaning company called Miss Clean, where we specialize in professional cleaning services, both domestic and commercial. We've been in business for the last 13 years. As a business, we run a lot of transactions that are money related. When we started, I remember mostly the biggest mode of payment was checks, especially for corporates, and individuals that could pay us via cash. Looking at the involvement of money handling and transactions has changed, and mostly even when COVID happened. I remember there was a big shift from cash handling to now more of online transactions. And most of my clients ask for bank details, and they currently do transfers, especially the corporates. They do just bank transfers. That walking and walking out of a bank was like something we had to keep doing. But these days we don't have such things. It's just at a touch of a button, either on your phone, on your laptop, and things are just happening. So that has even helped us as business people, such that we don't have to wait for money. I remember I used to go to the bank to ask them to give me an uncleared effect so that I can do my next job, especially when business was really still struggling with where we specialize in professional cleaning services, both domestic and commercial. We've been in business for the last 13 years. As a business, we run a lot of transactions that are money related. When we started, I remember mostly the biggest mode of payment was checks, especially for corporates and individuals that could pay us via cash. Looking at the involvement of money handling and transactions has changed. And mostly even when COVID happened, I remember there was a big shift from cash handling to now more of online transactions. And most of my clients ask for bank details, and they currently do transfers, especially the corporates. They do just bank transfers. That walking and walking out of a bank was like something we had to keep doing. But these days we don't have such things. It's just at a touch of a button, either on your phone, on your laptop, and things are just happening. So that has even helped us as business people, such that we don't have to wait for money. I remember I used to go to the bank to ask them to give me an uncleared effect so that I can do my next job, especially when business was really still struggling with cash flow. But now, instantly, you have your client pays, and instantly you have the money. We do internet banking from our main account to mobile banking. When it's transferred to the mobile banking system, then it's transferred now to every employee. That has created a lot of efficiency, because the person paying doesn't have to go to the site where our staff are working from. It just at a touch of a button, or while they're just seated in the office, they can easily pay people, pay them timely. By the time the work is ending, everyone has their money and they can access it and go home. A big part of our transaction, especially receiving payments, involve a lot of the domestic part, where clients, we serve them on a daily basis and they have to pay us on a daily basis, not waiting at the end of the month, like the corporate clients. So most of them use mobile banking. We actually cancelled cash payments years ago. We no longer receive cash as a company. We only operate with mobile banking. Internationally, we also procure mostly our machineries, because it's easier, of course, and cheaper to get them there. Once we've settled with a supplier, we go to our bank and we give them the supplier's details. Sometimes the bank also helps us also get to know the credibility of the supplier and all such details. And then they help us do now the bank transfer, which is all, again, instant. And once it's done, we have the transaction evidence, which we send to our supplier, and our supplier is able to just send the materials and machinery to us within no time. So yes, that has helped us a lot. We don't have to go through so much changing money here, taking the money, or picking the money in cash, or carrying the money in cash, which evidently would lead to enough times, loss of cash.
Kwa majina naitwa Penina Nashipai. Mimi ni mkazi wa Kibiko, Kajiado County. Mwanzo nilikuwa nafanya kazi ya beadwork, kushona shanga napeleka Masai Market. Wakati corona ilipoanza, ikawa ngumu sasa kwenda Nairobi. Nikakaa nikafikiria, nikasema ni biashara gani nyingine yenye naweza kufanya kando na hiyo. Nikaangalia, nikajaribu kuona kwa hii eneo yetu hakuna duka. Nikaanza kaduka kadogo. Customer wangu wengi wanalipa kupitia simu, na inawarahisishia pia na wao, kwa sababu kama mtu ako na pesa kwa simu hata lala njaa. Katika boma yangu niko na mbuzi, na pia hao ninawalisha kwa kununua unga, na si lazima nitoke nyumbani niende ninunue. Ninaweza lipa na kupitia simu, na ninaleta hiyo chakula ya mifugo yangu hapa nyumbani. Wakati ninatumia simu kulipa, inakuwa rahisi kuliko mimi kutoka hapa kwenda pale. Hapo kitambo ilikuwa ngumu kidogo, kwa sababu huenda nitakuwa nimesafiri, nimeenda mahali ambaye hakuna bank, na itakuwa ngumu kwangu kusaidika wakati ninahitaji pesa kwa uharaka. Sasa ninaweza toa pesa pali popote bila shida. Kwa kulipa karo, hapo kulipa na simu imetusaidia sana. Wakati mwingine tulikuwa tunaenda shule ikifunguliwa, tunakuwa na laini kubwa ya kulipa school fees. Unaona mtoto amechelewa kwenda shule, lakini kwa sasa imerahisishwa, kwa maana unaweza toa pesa kwa simu na ulipe school fees ya watoto na waende vizuri shuleni.
M-Shwari is designed for the people on the move.
Mobile technology has made our work to be more easy than it used to be.
In fact, the mobile money has transformed the way we work.
The purpose of this research is really to understand the use and the impact of M-Shwari amongst the Jua Kali sector in both rural and urban Kenya.
The word Jua means sun, and Kali, the hotness of that sun.
It signifies the informal sector in Kenya.
Jua Kali is 90% service industry. We're talking of masons, we're talking of plumbers, we're talking of all the artisans.
The Jua Kali sector is very critical to Kenya.
It is the one that employs so many people every year.
About 19 million people are self-employed in the so-called informal sector.
The only way we can provide solutions to unemployment in this country, which is a serious national problem, is by expanding the Jua Kali sector.
Before the mobile telephone came along, the bankable populace was very, very little.
For a long time, the traditional system has been walking into banks physically. Some of us who had accounts would walk maybe from Kaloleni to Mombasa, 44 kilometers, just maybe to make one transaction. This in itself cuts quite a segment of the population out of the banking services.
There were many difficulties for artisans. Opening an account with maybe Standard Chartered or Barclays, it was very difficult.
M-Shwari, I can just say, is an idea that came at the right time.
It's a product that has been developed by Safaricom,
which allows people to bank electronically and to access credit electronically.
It's really to help provide access to resources, small loans, and also access to savings for many small and medium-sized businesses.
Like us here in Jua Kali, there are things which we shop in small quantities and within a very short duration. And you know, in that short duration, you can't go to your bank in 2 times in 1 hour. But with this M-Shwari of yours, it is very easy.
Instead of taking my 5,000 shillings to the bank to deposit in my account, the account is here. You don't have to move.
Nowadays, I've reduced team saving at the Equity Bank because of time. After working here, I get money, I just deposit in the evening at the M-Shwari.
You can borrow money from M-Shwari in cases where you need money to improve your business.
You'll just go borrow some money from the M-Shwari. You give an amount to pay with a very, very low interest anytime that you're short of money.
There are a lot of people who would like to use M-Shwari, but sometimes the basic understanding of the product is not there.
It's a very good service, but I don't know how to use it.
To myself, I do understand it's like an account, but I'm not all that sure.
Most of us don't understand exactly the transactions that goes on through M-Shwari.
That is what I want to know. What is M-Shwari? What is it for? What are the benefits of it?
The biggest challenge is that of loan.
The conditions, they're not very easier for small earners to borrow.
They don't tell us how much money you have to put in that account to qualify how much money to borrow.
Among some of these challenges is a lack of adequate awareness.
They don't know who is the owner of the M-Shwari, whether it is Safaricom or Commercial Bank of Africa, they don't know.
How is this link between this central bank and M-Shwari?
The product is good, but it needs follow-up.
Safaricom and that other bank, they have never taken that active role of promoting M-Shwari in the Juakali sector.
But if I'm explained more about it, I'll get more interested. It might be a benefit to me.
Most of the people here want to register in M-Shwari, but they don't know the process.
Many of the mobile money services are available in urban settings, and they're often more understood in urban settings. The people in the rural regions often don't have as much access to financial institutions and resources.
Most of the technology is in English, and most of these people do not understand that language.
What we hope that will come out of these research is that the findings will help encourage service providers and policymakers to ensure that the practices they have in place and the policies they have in place really engage the Juakali sector more in the Kenyan economy.
I wish M-Shwari would either be translated in a vernacular language or maybe in Kiswahili, where majority of this community understand it better.
Safaricom or its agents need to move to the grounds and explain to the people how to use this facility.
Nobody could think that you could do business through the phone. It has really transformed lives.
The saving with the M-Shwari gives you a solution to your financial needs.
M-Shwari with the other modifications and improvements can be taken higher than what it is doing right now.
FSD has been working since 2005 to promote financial inclusion in Kenya. Kenya has made huge financial strides during this time. Over 75% of the population have access to a formal account, even if it's just a mobile money account. But are formal financial services really delivering value to low-income Kenyans?
My business partner and I went to the bank and we asked the manager if he could give us a loan, and then he asked us how much we needed at the time. The manager asked us if we have exhausted all our other options, if we've asked family, if we've asked friends before, because he was he wouldn't advise because of the interest rates and everything. So he was now if we don't get anywhere else, now we can go back and he can see if we can get. Okay, it was a bit disappointing because I thought we bank with you guys, probably you'd give us a good rate or something, considering you can see how our account has been growing. After the first experience, it was a bit discouraging, so I'd rather I feel I should just look for other options before I consider them as an option. So far I haven't gotten any loan from a bank.
Despite these achievements, our research shows that the relevance of these financial services in the everyday lives of Kenyans is minimal. So why is it that Kenyans just are not using banks?
Well, I think that's a really good question, because although we've seen the numbers of people having bank accounts go up, what we know is that they don't use them so much.
Yeah.
And I think, again, it's about the fact that when you put your money in the bank, it's not being put into this enabling you to build friendships, to build relationships. People would love to have a relationship with the bank, but then they find that it's really hard to get a loan from the bank.
Right.
And if they do get it, then they find it really hard to manage it, because maybe they've had some crises and the bank won't really listen to them when they need to change
not as flexible.
Yeah, and therefore that puts them in more of a problem than when they started.
What happened now, we had to go back and now ask like our family members for money. So now I was lucky enough, my mom assisted, also my dad gave me some money. Luckily it was interest free, so I'd pay them slowly. Yes.
Unajua sina kazi ingine, kazi ile nafanya ni yangu ya mechanic. Saa hii nikifanya kazi hapa, tuseme nimepata 1,500, naweza kwenda ni save kwa hiyo chama yangu. Hiyo inaitwa Best Rock Sacco. Juu na hao watu huwa wanapitianga hapa wakicollect hizo pesa, badala uende huko bank ufunge line huko na kenye unaenda kufungia line unapeleka 500. Sasa nikaona hiyo chama yangu huwa inafanya mzuri, na kila siku wakipitia hapa, tuseme hata niko na 200, niko na 100, nawapatia na wanachukua, na hiyo pesa wanaenda wanaweka, na hiyo pesa ni yangu. Hiyo Best Rock Sacco, ukiwaitisha tuseme loan, unataka loan, wanakupatia tu, hawakuangi na process mingi.
There are two really important realities to understand about low-income people's lives, and one is that their incomes are really, really small. So whenever they need to spend money for one thing, it means trading off with another. So the incomes are really tiny. And we also saw that they're really volatile. So from month to month, income goes up or down by about 50%. So that's very difficult to plan around. And we also saw that people were very rarely just putting money aside in a savings account or under the mattress even in large sums, because they needed every shilling to be working. It couldn't just be sitting there. To just leave it sitting there would be wasteful. So they needed that money constantly working for them, whether that was in a savings group, where when it wasn't with them, it was with a neighbor who was making an investment. There were lots of different ways that they wanted that money to be active at the same time as it was being saved.
Hii familia yangu mimi utegemea hii biashara ya nyama, ndio wasaidia nayo. Mbuzi natoa sokoni, naenda sokoni, nanunua mbuzi, nakuja nazo, napeleka kichinjioni, naenda kuchinja, nikichinja nakuja nauza. Mbuzi anaweza kama ni wa 3,000, anatoka kama 4,000. Sasa zile pesa nikipata nikichinja wale mbuzi wakiisha, zile pesa narudisha tena sokoni. Zile faida ile napata napeleka kwa chama. Capital ya kazi narudisha tena kazini. Kwa kusaturate namna hiyo inaenda ikizaana faida ambayo naiona. Ndio kwa banki ni sawa, sikatai. Lakini hii naiona nafanya kazi na immediately.
People have sort of two competing priorities that come out of that. One is stretching their budget to make it work when income is low or something comes up that they weren't expecting. And the other one is growing their incomes so that they're investing in a better future, whether that's in an actual income earning activity, like a small business, or whether it's investing in school fees or buying a piece of land. And when you have such a small amount of money to use in terms of savings, you have to be really creative about balancing those two priorities of stretching the budget and growing your income. We found that people were using lots of different financial devices at the same time to try to make those two priorities work together. So they might be taking credit at the shop, borrowing formally and informally, belonging to a number of savings groups. We found like more than 10 in a household that were happening simultaneously.
Mimi ni fundi, sana sana huwa nashona na mapato yangu ndio ninajisaidia nayo kutoka hapa kwa kibanda yangu. Huwa ninaingia kwa vikundi vya kina mama. Ninatoa tu kidogo kidogo, baadaye nikipata huwa natoa karo ya shule, nanunua chakula, mavazi, najisaidia. Sasa si unaona vile nikiweka kwa vikundi vya kina mama, za zingine huwa tunapeleka bank, alafu sikikuja yani kwa nyingi tunakuja tunagawanya.
Chama niko na mbili. Ya kwanza natoa 200 kila siku. Na inanisaidia mimi kulipa nyumba ama kulipa school fees. Hiyo ya pili nachukua, naangalia biashara venye inaendelea, nachukua doko napeleka bank.
Which of these services do you value the most? The bank or the chama?
Chama. Ndo napata pesa haraka haraka. Ndo napata pesa kama pesa ni mingi.
When I did research, I found that Kenyans value financial services not just for what they can get in economic terms, but as we said, also for them to fulfill other well-being goals and well-being values. And actually, respondents and people I talked to say that they can have a lot of motivation in terms of saving in the bank and also in terms of planning for their expenses. But at the same time, it's very difficult for them to build relationships through the bank. So while the banks can give them a sense of social status, it's very difficult for them to actually build a sense of identity and belonging, because through a bank account, they can't really develop relationships and social networks. And at the same time, also, banks don't seem to operate on those modes of development that are typically in communities, so the mutual development and mutual support, because it's not clear when people put their funds into banks whether they can actually get these funds to work for the community through, for instance, loans.
Uplifting a friend means you cannot just focus on yourself. For example, sometimes a member of the chama may not have any money and she may not want the whole community to know she is struggling. The chama can help by supporting her so that people don't know what she is going through. That's how we run things. We agree not to expose each other's challenges to people outside the chama. We can't do that for people who aren't members of the group, but if they are members, then we are able to assist. So by sheltering one another like this, we cover each other's nakedness in times of need.
Tawaambia waingie waungane, waanze vikundi, watoe pesa, wakiunganisha pamoja wapate kitu ili waanze kazi.
And I think Mshwari is really interesting in the way it's come up, because of course it has got a bank behind it, but it's got a very different identity. Yeah. And what people are seeing with Mshwari is that they can take loans, they can learn about it, but they're seeing that the Mshwari is trusting them with their money. And I think there's a perception in banks that the bank doesn't trust people
trust the client
with its money. You have to trust the bank with your money before it will trust you with its money. And Mshwari is slightly doing that the other way around. And that's partly why it's very popular. So it's building a relationship which people start to value, because they want to be able to build that relationship and able to develop in the long term. They want a relationship which is around finance that can take them into the future.
Watoto wamesoma, niko na kijana amemaliza, niko na msichana pia, kijana amemaliza college na ameanza kujisaidia mwenyewe. Niko na msichana amemaliza last year, pia amemaliza form 4. Na pia niko na mwingine mdogo. Naendelea na mimi na bwanangu.
If formal financial providers want to develop solutions that work for people, they need to come out and talk to people. There is a lot to learn.
Kwa majina naitwa Susan Okol na ninafanya kazi ya samaki. Hii kazi nimefanya kwa muda mrefu. Sasa hivi niko na 15 years kwa hii samaki. Naenda Kikomba very early in the morning. 4:30 nishaamka kwa nyumba.
This anthropological project had as its first objective trying to understand how people use mobile phones here in Western Kenya. M-Pesa is a mobile money sending service that was introduced in Kenya in 2007. Since then, it has become extremely popular. Many development economists approach the study of mobile money from a financial inclusion perspective. This project takes an anthropological approach. It sees the practices of mobile money as a part of an existing social and cultural background. This area is a rapidly changing but still predominantly rural area. People are involved in agriculture, but also many other ways of making a living. Trading, having small shops. One important source of income is mobile money remittances. Remittances have a variety of purposes in Western Kenya.
Ebulwale nalwala echa nanyolekana nda accident mano omundu wandumira chisende narumisira kaba japu ni wandumira mara chanjeta.
Kama ukitaka kununua ng'ombe ama kujenga nyumba, ani shughuli kubwa kubwa, ama mtu amekosa school fees, unaweza kuenda ukatransfer ukamsaidia.
Remittances have economic uses, but they also have important social meanings. They express caring and create relationships based on the exchange of assistance.
When I'm just feeling good and I have a little money, then sometimes I'll send something to my grandmothers.
For urban or international migrants, they are a way of maintaining social relationships and social presence in a community. There's an interesting duality to the mobile phone. On the one hand, mobile phones create connections and relationships.
I think M-Pesa has made relationships stronger, and they help you save on time and energy and money.
On the other hand, mobile phones also highlight the ability of individuals to create and shape their networks. They give individuals a lot of autonomy or agency in shaping their connections with others. People use mobile money to participate in groups.
Through mobile, it's easy for people to send their monthly subscriptions or contributions.
A quarter of the money that is contributed in steering committees when we have funerals is by this.
This concept of money pooling has become
Thank you. Welcome to this afternoon session of the Financial Inclusion Statistics Conference. This afternoon session, or this third session of the day, is about regulation and financial inclusion. So we would want to have insights and what the regulators have done in terms of using FinAccess data to shape regulation and also monitor how policy has helped with the inclusion. At this point, we'll start with a presentation from Ben Kipanga. Ben Kipanga is a senior officer at the Retirement Benefits Authority of Kenya. And his presentation will be on retirement benefits sector and what other studies they have done and what is coming out from the information they have. Welcome, Ben.
Good afternoon. Good afternoon. Okay, I'm waiting for the presentation to come up. Okay, I will divert a little bit from the data and look at from the perspective of policy in terms of the pension sector. So this was the agenda, but I will go specifically to the data issues. I will not dwell on the mandate, but I will highlight I will highlight something which the SASRA CEO mentioned, on that most of the regulators are focusing on the stability issues. If you look at our mandate, the first one is to supervise and regulate. But the third one is to develop and promote. That's where now financial inclusion falls in. How to balance becomes a challenge. That is how we are structured. We report to the National Treasury. We register schemes and service providers with specific functions. This is a further elaboration on how you can establish the scheme. It can be through an act of parliament or trust deed and rules. The other determining factor is the membership. We have the mandatory scheme, which is the NSSF. The other issue is whether it's funded or unfunded. All schemes are funded except the civil service pension scheme. But there is a new scheme known as Public Service Superannuation Scheme, which started in 2021, which is currently funded. It's currently at 49.6 billion. Soon it will be a very big scheme. Further elaboration on how we classify schemes in terms of scheme type, the design. In terms of the design, it can be defined benefit scheme or defined contribution or an hybrid scheme. In terms of membership, the occupational ones are employer-based, but we have the individual pension plans, which you can join as an individual. In terms of investments, we have an investment guideline. It has 15 asset classes where schemes can invest. But there is one asset class known as guaranteed, which you can invest. So your scheme can either be segregated or a guaranteed scheme. In terms of when you exit, you can either receive a pension or an annuity. An annuity, that means you'll go to our sister regulator, insurance, and purchase an annuity. The provident funds, that means when you leave service, you get all your money. And whether if you spend it well, that will be fine. The challenge is that when people are paid lump sum, they tend to enter into certain projects which might not be productive at the end. But there is a new product where instead of now going to the insurance sector, you can transfer your money to a scheme which we are calling the income drawdown. The challenge is it faces the market shocks and volatilities in the market, so your money, if the market is not behaving very well, your portfolio might decrease. We have new products in the market, which the first one is post-retirement medical fund. We have allowed members to contribute in the scheme for purposes of purchasing a medical cover in retirement. If you have not been able to contribute during your working life, we have allowed you to transfer at least 10% of your accrued benefits. The other new thing in the pension sector is that we have allowed members to access 40% of the accrued benefits for purposes of purchasing a house. The other thing is that you can assign 60% of your accrued benefits for purposes of acquiring a mortgage, but the money is not leaving the scheme. But the 40%, maximum 7 million, is moving out of the scheme. Now, this is the data. Currently, the pension sector is worth 1.5 trillion. But something happened in 2022, similar to what happened in 2021. I think those who are in the banking sector understand what happened in 2021. Similar things happened this year, 2022, where the interest rates and the exchange rate are not behaving that well, so it affects our pension sector. Where are this money? You can see the concentration is government securities. And there was a debate in the morning whether there is a crowding out. And when our schemes are investing in the government securities, the capital markets are also, or other sectors are affected. But that is a debate for another day. This is a further elaboration. How have we taken the issues of data or financial inclusion. Because of the innovations, mainly digital, we have new schemes. We have NSSF with ABA, looking for the people in the informal sector, those who are not covered, because you'll find that most of the members of the pension scheme are members in formal employment. The other service providers, Octacon, Mopikesa, Keep the Pension by Samara. The other perspective or the other innovation is by the government itself, where they have established a new scheme known as Kenya National Entrepreneurs Savings Trust, where they will be targeting people in the informal sector. Then there is the Mbao Pension Plan, which currently the assets is at 169 million. Membership, 95,000. So if you do a simple calculation, you'll find that the savings by individual is very low. On the other side, these are the kind of schemes with membership. You'll find that NSSF, the active members, is only 2 million. Most of us who are members of scheme are also members of NSSF. Now, we have 18 million people who are working, but majority of them, or 15 million, are in the informal sector, and these people are not covered. It creates a challenge, because when these people are no longer physically active, how will they survive? So it creates a challenge of dependency, which has been alluded in the morning, that there is a lot of dependency. So you can see your child depends on you. When you grow old, and the African culture, you are supposed to depend on your child. Now, if your child who is over 20 years is depending on you, will you be able to depend on that child? It becomes a very serious problem. From the FinAccess, you can see pensions decline in 2021. And basically, we did a survey immediately after COVID, and most people had lost their employment. The other thing which was coming out is that in terms of coverage, either rural or urban, you'll find that most of the people in the urban are covered. But in the rural, they may not be covered. But what is striking is on the gender issues, which is coming out clearly, which needs some policy interventions. We looked at, from the FinAccess, what are the main reasons of these people not joining a scheme. You can see, I wish to be a member, but I cannot afford. So the issue of having that cash to join a scheme, do not know how to become a member, issues of awareness, do not know about pensions. So also issues of awareness, and we shall see in the succeeding slides how we are trying to address this. The other thing is, what are the main priorities in your life? These respondents, their main priorities in life were educating their families or themselves. So education was their key priority. Second, putting food on the table, which is very common. Improving our businesses, but what I've circled is health. Why do you think health is important to the pension sector? Etwasi? Health is very important because the moment you reach age 60, what happens is that the premiums, if you are to secure a cover for yourself, the premiums are so high. And Tabitha has alluded that we also undertake surveys. Now, from our pensioner survey or retiree survey 2021, you see it has changed. The priorities of retirees is their health. So you can see the surveys or the data is talking to each other. And that's why, as the pension regulator, we are to allow members to save for purposes of procuring a medical cover, which is very important. And nowadays, evidence-based, or your policies or any policy proposal has to be backed by data. The other thing which strikes us is the issue of combination or using combination of financial services. How are we trying to address this? Because you'll find that someone or people want to be in a pension scheme, at the same time they want credit, at the same time they want insurance. So how do you put up your product to be that attractive to these people in the informal sector? So we are talking to government to allow us to have a bundled product whereby you can save for your pension, you can save for your insurance, at the same time, you can save a portion of it for purposes of credit. Say that if you want to educate your children, you can go to your pension scheme and get that credit without affecting your retirement savings. What are the other issues we are grappling in the sector? In the morning, it was alluded that there is high dependency. Why? Because many Kenyans are not ready for retirement. Because you'll find that you work until the body refuses to. And that is now where the problem starts coming in. The labor market is skewed to the informal sector, which is a major challenge. Investment shocks. Our market is still shallow and very volatile. The other issue is that majority of our members or the working population only save with the mandatory scheme, NSSF. If you are saving 200 and your employer is saving for you 200, the highest is you will get less than 200,000. For somebody working in Nairobi and you are supposed to go back to your rural areas, it can only assist you in hiring a lorry to transport your items. That is the biggest, and that is the truth. That is where the problem is. So when you hear government talking of the minimum should be 200, or we need to enhance our mandatory contributions, that is the real issue on the ground. But the challenge is affordability. How are we able to incentivize these people to save more? Because saving 200 or 400 shillings is not good enough. Funding deficits or unremitted contributions plus liquidity challenges. You may have a rich scheme, but you are rich on paper. When you retire, the most important thing is liquidity. You need that cash, not the land or the houses. You need the cash. Longevity risks. The good thing is that if you are earning a pension, most of the pension or annuity products is for life. And it's good that we advise our people when they are purchasing the annuity, they must be sure which product are they purchasing. Consumer protection and data protection, which has been alluded in the morning. As we include people and use digital platforms, are we protected? Is our data protected? Risk management issues, which we have discussed. The issue of climate change and sustainable investments. Should we mandate our schemes to invest on sustainable investments, or we leave it for themselves to decide? The elephant in the room is in the morning we are talking of casual laborers. What happens when our workers, or majority of them, are casuals? Will they save for their retirement? The answer is no. The other thing which is happening is that when we put people on contracts, what happens? You pay them gratuity, isn't it? When people become instant rich, there is a tendency of spending all that money. And it creates a problem when you retire and you realize you have not saved for your retirement. So these are the issues we are grappling with, whether we should do auto-enrollment, and if we do auto-enrollment, should we be matching contributions? And we have seen policy pronouncement that if you save, government will save something for, and it has happened in Rwanda. Maybe we need to learn something from Rwanda, who learn from us and establish a scheme known as HOISA, which you save for your pension, you have insurance and the credit facilities. You save, government will put something for you to a certain extent. It also captures the issue of bundle products. Use of technology for financial inclusion. I've mentioned the issue of consumer protection. Issues of long-term investments. We need to balance returns versus risks. And also liquidity. Say that schemes does not invest in products which are not liquid. Disaggregated data. We are moving to disaggregate our data in terms of gender, age, and also region. Because you might find that the people you are covering are only in urban areas. The last one is on awareness creation. And we are looking at people who are already in the scheme. We are doing for them retirement planning. Say that you plan yourself early for purposes of your retirement. Those who are not in, we are undertaking Huduma clinics. This dissemination will be for those who are already in the schemes. We are also talking to employers in order to enroll their members into schemes. We are also using the media, either television and radio or talk shows. And that is the end of my presentation.
Thank you, Ben. I think he deserves another round of applause. Okay, for this session, I want to highlight that we receive our presentations from the regulators. Then we can have a question and answer session at the end. At this point, we would want to hear from SACCOS. Specifically, we want to hear from SACCO Societies Regulatory Authority. And the person making the presentation is Kenneth Bichanga, an assistant manager in SASRA. We want to hear more, especially about the accessing Hustler Fund. Welcome, Kenneth.
Good afternoon. Good afternoon once again. I promise you one thing. I know it is very difficult. I used to be a teacher to teach in the afternoon, because by the time you are at the second slide, a few people at the back are already winking, giving you indications that they are not listening. But I promise you one thing, that in the next 15 minutes, I will be done. Thereafter, you can choose what to do. Is that okay? So I'll try and move very fast. I did not include a lot of details. It's only about 10 slides. So I'm going to leave to my proposal of doing it, being very brief. And then again, my CEO was here and he handled quite a number of issues, but should you have anything, I think there will be a time for plenary for you to be able to do that. My name is Kenneth Bichanga. I work in the Licensing and Regulations Department in SASRA. Good. Our table of content, I chose to concentrate on a few issues, very intentional in terms of what we are able to measure and where most of the challenges were coming from. One of them is the issue of SACCO usage. You will see what the FinAccess data is telling us. We'll also throw something into the spanners so that for the researchers who are here, you can be able to see what kind, any low-hanging fruits for you to do a research on the information. And then, of course, policy interventions. And then finally, there's the issue of quality. What are the issues that come out in terms of quality? When you talk about quality, what is it we're interested in? Because one of the things that you will notice is that financial access measurement deals with 4 dimensions. One is access, the other one is usage, the other one is quality, impact, and of course, welfare. Impact and welfare are the same thing. So let's start, this is just a definition of data, which I know you're well versed about it. That was just to jog our mind in terms of, it's basically observations or measurements that we make. And that what we're trying to say is that data on its own cannot tell us anything. If you get data for 1 year and you look at it, it doesn't give you any insights. You must do a trend analysis, is data you've collected over a longer period for it to be able to give you insights on what exactly is happening. That is what information from the FinAccess. It did indicate that if you look at all the way from 2006 to 2021, the trend has been that if you look at the trajectory, in 2006 the usage of SACCO products was at 13%. But when you look at the figures for 2021, the percentage fell to 9.6. Of course, as a regulator, that gives us a reason to worry, because we need to drill down to these numbers to find out why is the market telling us that they are not using SACCO products. Is it that they are not fit for purpose? What is it that we can come up with to be able to trigger more uptake of the financial products in the market? Of course, that is the position. However, I also give you another slide that tells us about a different story about the industry. And I chose to take deposits and look at the membership. We've tracked it all the way from 2014 to 2021. What is happening? If you look at the deposits in 2014, there were 206 billion. By 2021, they have risen to 474, and that figure is likely to go up, because here, the figures I'm showing right now only for deposit taking. We have another segment that we brought in 2021, which again has added the figure. It is now at 800 billion. So again, if you look at the membership, we now stand at about 5.9 million members in the sector. The membership, meaning the membership has been growing. Now the hard question is, when you look at the FinAccess data, which indicates that usage is going down, whereas our data internally that we've kept over time is indicating, then there are hard questions that we need to ask. That is not a question that we're going to answer right now, but for researchers who are interested, it's a place you can gain insights and do more research, drill into the numbers to try and see, is there a correlation between what is presented in the FinAccess data and what we have, because these are absolute numbers. Okay, good. Again, when we look at the FinAccess data, it tells us about, in terms of the reasons why SACCO people are not having. Of course, the question for usage went further to ask, if you do not have an account in a SACCO, or you don't use a SACCO, what are the reasons why you do not use a SACCO? And there are a number of questions. Again, of course, these are questions that relate to quality of service, and again, in terms of matters about education. Again, there are issues in terms of, when we look at it, for us, it is a challenge, because it triggers us to come up with policies that speak to the challenges that are being brought out by the market. One of the information that comes out is that from the FinAccess, 38.6% of the population or the respondents indicated that they do not have information about a good SACCO. I totally agree with them, because what we are basically saying is that our SACCOs have not done enough, and therefore they need to do a lot of groundwork to market their products. So again, what is it we are going to do? Of course, in a few slides, you'll be able to see some of the policy interventions. Then there is the issue of lack of trust. Again, we've come up with policy intervention to address the issue of trust. Of course, that tells you that if an institution is going to be closed tomorrow, of course, you would not want to put your money there. So what mechanisms can government or as a regulator come up with to ensure that we ramp up the trust for members to be able to put their money there? Then, of course, there is the issue of lack of money. I don't know how we can address that, but again, it's a challenge. But I think the market has spoken. And what we do is listen and come up with strategies on how to deal with the challenges. Okay. Then, of course, there is the issue of transparency, which I think is also important, which speaks to the issue of quality of service. And we do understand when somebody tells you people are not transparent, then again, those are conduct issues. And then it therefore means that we need to come up with policy interventions that speak to that challenge for us to be able to address the challenges that our members are experiencing out there. Now, again, apart from just looking at the challenges, we also went further to look at the data that we have in our office to see what it's telling us in terms of the quality of assets that are held in the sector. It's not only enough to talk of 800 billion, but again, it's also important because one of the things that we'll notice is that one of the largest assets, which constitutes between 70 and 80% of the total assets, is the loan portfolio. And therefore, the quality is a key concern to us. So, and therefore, what we do is there is a report that is made by the institutions which are regulated by us on a quarterly basis. Now, during COVID, what happened was that previously they used to submit the report on a quarterly basis. But again, during COVID, we did realize that there are some interventions that we needed to come up with to address the challenge. Because at that time, if you remember, people are not paying their loans. And again, if people are not paying their loans, which, as I indicated, constitutes 70 to 8% of the assets, you have every reason to get worried. So what do you do? So if you look at the figure, around the first quarter, we had the figure jumping up to about 9.85%. That's about 10%. That is worrying for a regulator. So what is it that we did? Again, as you can see the data, towards the end of quarter 3, there are issues, of course, in the market. It's going to around 9.3. Of course, that tells you the nature of a market that we have. There are challenges out there. One of the things is that inflation has gone quite high. I was reading today that in October alone, it was at 9.6%. You know the implication, that if you're not making a return, which is higher than 9.9, then it will be wiped out within a very short time. The other issue is the rise of costs due to drought. Those are realities which are out there. You can now see them being displayed in the numbers that you are seeing here. And that is the beauty about numbers. The other one is the issue of the key grain and cooking oil products. Due to, of course, they have gone up, the prices for oil. You and me know right now the price of a liter of oil in the market, or petrol in the market, is quite high. I think it's the highest so far. So again, in terms of production as a key input, that of course makes it quite expensive. So again, that is a key concern. So, and that is why you're seeing the numbers going up. That is as a result of the macroeconomic factors which are beyond our control. What are the interventions we did during COVID? One of them, there were 2. Of course, there are others which were by the National Treasury, but I chose to concentrate on what we did as an institution. The institutions were required to restructure loans that were granted to members to give them a breathing space so that they can be able to gain back and repay their loans. Of course, the frequency upon which SACCOs were submitting the report again was revised so that we are able to monitor the performance of those loans on a monthly basis as opposed to receiving the reports on a quarterly basis. So those are policy interventions which were meant for during the COVID period. We are now post-COVID. So again, there are other challenges which traverse the COVID period. So again, that means that we still have to be ingenious enough to come up with policies that speak to the challenges that are being faced by the market. In terms of quality, again, some of the challenges we found in the market was, in terms of quality, there is the issue of unexpected charges. That is a conduct issue. Somebody asked a question in the morning in terms of the quality. And what we do as a regulator is we'd want a situation of fair pricing to the members. But again, when they tell you there is unexpected charges, that you walk into your SACCO today and what you are told at the time of entry is not the same charge there you're being charged. We need to control that. So how are we doing that? Of course, I'm going to indicate what we have been able to do that. Then there is the issue of abusive technology, collection techniques. If you're aware, there are SACCOs who have used very unscrupulous methods to recover money from their members. Some are using what the people, debt collectors. Some of those guys, I don't know, anyway, you will tell me, for the people who have experience or who have seen those guys undertaking, you saw there was an incident on TV the other day, isn't it? That is not a debt collector, but you can see what has happened. Somebody is saying a house of 80 million has been brought down by goons. So some of those debt collectors at times use goons. And those are things that we would not want some of our institutions to take members through. So again, it's a conduct issue, which we, and then there's the issue of lost money when you drill down to the numbers. Mostly those are issues of fraud. I will tell you, we've had serious incidences of fraud in the market. Institutions have lost money, and of course that translates to members also losing money. But again, what we are saying is that institutions must have very good systems that can be able to withstand those challenges, okay? Because when institutions lose money, you know who at the end of the day is going to suffer. Good, so in terms of policy interventions to speak to those challenges, as I said, those are conduct matters. We have developed a complaints management guideline, which is available, and we have even automated the complaints system for SACCO members, that if you have a challenge with your SACCO, you can complain to us, and after which we'll make a follow-up to the individual institution. We did conduct a market survey, a study sometimes back on the policy legal framework in the SACCO subsector, and that led us to come up with draft regulations that SACCOs are supposed to comply with. Of course, which again speaking to some of the issues here. Again, we developed regulations for the withdrawable deposit taking regulations as a whole section on member protection, fair treatment, all those things are already, fair pricing are already addressed. That when we go for on-sites, those are some of the issues. We already developed an on-site tool that when we go to out there for inspection, some of the things we look at are not just the ordinary. We don't look at the numbers. We go to look at, do we have a complaints desk in the first case? Do you have a complaints register where you record, and how were those complaints resolved? So some of the issues we are doing. In terms of education, again, what you will notice is that you heard that SACCOs, a number of them have rebranded. Now, what is happening is that some of the conventional SACCOs that you used to know, which were teacher-based, for example, have opened have rebranded and are now accepting people from other professions or other business, professions. So again, that requires, so what we are saying is that they are now changing the membership structure from being homogeneous to heterogeneous. That means that they have now to go an extra mile to educate those members about the kind of products, offerings that are available in their SACCO. That is something that we are addressing. To address the issue of fraud, we did set up the SACCO-cited fraud investigation unit, is akin to BFIU in Central Bank, where it is manned by officers from DCI. We have about 6 of them, and so far there are quite a number of cases that have been prosecuted, and we've had successful closure of some of the cases. So at least there's work being done towards ensuring that fraud cases or people who are culpable are taken into to answer for what they did. The issue of, again, in terms of safety net, what we are doing is we did present a policy a paper to the cabinet, which was approved on 12th May 2022, which is supposed to operationalize. The position is that the law provides for the establishment of a deposit guarantee fund. However, in its current form, it has challenges, and therefore we had to make changes for it to be operationalized. So we had to go back again. The process is you have to go through your ministry, through the cabinet, and then it goes to parliament. So we got an approval on 12th May. It's now heading to parliament. Once we get the approval, we've already done the matter on how the board is going to be constituted. Then this will be an independent body, just like what we have for the people who have been in the sector. We used to call it Deposit Protection Fund, which has now transformed into Kenya Deposit Insurance Corporation. The purpose is to provide a safety net mechanism, and this will enhance trust in the market, that should any of the institutions go down, we have a better resolution mechanism, as opposed to closing a shop, closing shop, and members go there and they cannot find their money. Finally, we normally call this a game changer for the industry. And this is out of our experience for the last 12 years of implementing the Act. What we had noted is that most of the institutions or most of the circles are struggling because of their size. We cannot blame them, are not able to buy or purchase top-of-breed management information systems. And we understand it's because of the cost implications. Some of those systems in the market are very expensive. So we formed a special purpose vehicle to implement this, where circles will be able to plug in at a cost for them to be able to get the MIS services, core banking system, so that they can concentrate on their core mandate and give this service to a specialized institution that will be able to run that. Of course, that will reduce their cost, enhance their resilience in terms of cyber threats. Competitiveness, of course, will go up in terms of long-term savings mobilization. And finally, there. Thank you so much. I'm done.
Thank you, Mr. Bichanga. At this point, we want to hear from the capital markets, how they have harnessed or have used FinAccess data and the studies they have done, or any other information they see that is relevant for us to know. So I welcome Wilberforce Ongondo from CMA. He's a Senior Manager, Research and Analytics.
Good afternoon, all protocols observed. Making a presentation on how we intend to deepen capital markets participation using financial inclusion statistics. On our mandate as Capital Markets Authority, we have a twin mandate. The first mandate is to regulate, and the other mandate is the development. Facilitation of the development. And I think when you come to financial inclusion, generally it falls under the mandate of development. And for us to be able to ensure that we do proper development facilitation, it's important that as we make decisions as the authority, we make policy decisions that are based on evidence. And how do we get this evidence? This evidence comes from data. And that's the nexus between our intention to deepen the market through financial inclusion, because these statistics enable us to make decisions that are based on evidence. So I've already talked about our mandate. Some of the products that we have in the market, of course, we have the equity market, debt market, commodities and derivatives market. One of the challenges that we've had in this market is the challenge of uptake. There have been low uptake, as witnessed by, of course, the low number of IPOs, products that have been we've designed, but the uptake have not come, and etc. So as we'll see in the subsequent slides as we move ahead, that's one of the areas we hope through evidence that we get from this data, we'll be able to address as we move on. It's good that, of course, we've had 6 editions of the FinAccess surveys, but the last survey at least gave quite some prominence to the other sectors, not only banking, but other sectors, including our market, and we are grateful. So in this last survey, we were able to have questions that went to look into the functionalities of the Emakiba offer that was there before and some other products. And we also tried to investigate the reasons why uptake has not been as expected, and some more as we shall go, as we shall see as we move ahead. And also the importance of FinAccess to us is we do internal surveys and internal research, but FinAccess also provided us with another view that we could compare with the findings from our own research, so that we can be able to see, because it's important to also have another view in order to, first of all, be able to either corroborate or even be able to look deeper into if there are gaps. And as we moved ahead, also through the FinAccess, the reach of the FinAccess was very important, because this FinAccess survey was done all over the counties, all the counties. But when we do our internal surveys, due to capacity constraints and other resource constraints, we are not able to cover as wide as a coverage that is offered through FinAccess. So, and that's a very important perspective. So for the 2021 FinAccess, we looked into areas, Emakiba bond that had been issued before, the 2 issues, participation in shares, treasury bill bonds, and other products. Of course, the intention of Emakiba was to bring in the retail investors into to include them when the government to also invest and save with the government product, that is the bond, and it was supposed to promote a savings culture and also make it available through the mobile phone. Promote the access. And in our when we went deep to look into the FinAccess data, we were able to find that majority of the respondents were very much interested in the guarantee to get their investments back. And this is very important even to the youth, because before we were of the opinion that the youth were only interested in gambling. But from this data, we found that the youth are also, first of all, very much interested in the guarantee, that is the risk, and also the ease of exit. So when we are designing products, it's very important to take that into consideration. And from the rural urban, if you look at the uptake, mostly the rural population were very much interested because of the low entry requirements, the access. But you look at the urban, they are looked more into the risk in terms of guarantee to get their cash back once the bond is sold. It means that for the urban population, when they experience shocks, their interest mostly is how fast can I be able to get monies so that I can attend to the issue at hand, as opposed to the rural population looking into, at least I have something that I can invest in. So this tells us that there is already some difference. And if you look in between the rural and urban, as we shall progress, there will be a mix. There will be a mix of that, depending on the geographical location. And if you look at, of course, this I've already mentioned, on the youth, the reasons for investing was guaranteed, and also people above. So there are similarity between 18 to 25-year-old and people above 55-year-old, because the people above 55-year-olds also, they want, so that when they are addressing shocks like maybe as was mentioned before, health problems and etc., they want to get their cash in time. But the youth also want to get cash in time and easier to exit, maybe to do something else as entry. But in between this population, you find that they are more interested in the ease of purchasing, as not only not so much on the entry, but ease of purchasing, maybe convenience, because maybe at this age in time, people are not so, they are actually investing and they're not so much looking at the immediate needs. And if you look at the same, by looking at the counties, for example, Mandera, because of the geographical location, they are more interested because of the access, minimum entry requirement. But if you come to Nairobi, you look at the guarantee of getting cash back in time was very, very important. But areas in between, Kiambu and Nakuru, a mix of both. Uasin Gishu, them they really concentrating on ease of purchase. And therefore, what we came to as a conclusion is our market is actually segmented, as has been shown before from the previous presentation. And therefore, going forward, it's important that we make policies based on different segments of the market. We don't just have a one-size-fits-all. So when you are having products, we look at the target population, and we design the products on that. The same applies to awareness, the same should apply to literacy and all that, because they are at different levels. And we're asking ourselves, how do we go by that? What are the challenges? One of the biggest challenges that we're experiencing is we need, yes, to segment our market, yes, but how far down, how far granular can we go? Because we don't have all the resources. It's important we have segments that are viable. We don't have all the resources at hand. And this brings into perspective the need for deep analysis. This deep analysis can only be informed by data. And that's why we are thinking of how do we build infrastructure for big data analytics, so that we can be able to do more analytics and come out with further insights that can be able to help us make better decisions. So those are some of the lessons we've learned through this looking at FinAccess data. When you come to participation in shares, you can see from the slide, the uptake has been quite low, both, as mentioned before, both for shares and from all the age groups, and also the participation for the bills, treasury bills and bonds, still the same kind of scenario. As I've said before, we've done internal studies for Investor Education Measurement Index. And why we are looking at this Investor Education Measurement Index, because we thought that financial literacy, awareness is very important, that we keep tracking our efforts as we move ahead. And for this index that we developed, our dimensions were looking at the attitude, knowledge, and practices of these investors. And we've been tracking, moving forward, there's been some improvement. And I believe as we progress in the next FinAccess surveys, as we move on, I believe it will be very important for us because we'll be looking at our insights that we get internally and also what we get into the FinAccess. And some of the challenges that I think we need to also address going forward is to ensure that we have more participation in terms of more coverage for the other sectors. I know we have resource constraints, but more coverage on for other sectors that are not banking. In terms of additional questions, and I end there. Thank you.
Let us give Wilberforce another round of applause. Thank you so much. We hope you can also do some deep dives, given the coverage for capital markets. In terms of the small number, that's where the deep dives especially work, because we're able to target those who are using the products, the issues that are arising from there. At this point, we want to invite Teresa Nyantuka, the Assistant Manager, Policy and Strategy at the Insurance Regulatory Authority. Thank you.
Good afternoon, everyone. Good afternoon. I won't take long. I know you are worried that I'll take up to an hour and you're looking at your watches and wondering whether you will beat the jam on Thika Road. I will be brief. I'm going to present the financial inclusion from the insurance perspective, mostly based on the FinAccess data survey. So, because this is, I've said it's going to be based on FinAccess data, I just want to do a brief background on which I'm going to build on the presentation, is that the FinAccess has various dimensions on measuring financial inclusion, mainly access and usage, and it basically looks at the population that has got access to financial services. And in the FinAccess survey, I think it is captured as formal, prudential, formal, non-prudential, formal registered, and informal, that is not subject to any registration or regulation. What we found out from the FinAccess survey is that the insurance landscape has changed over time, and it has partly been driven by mobile technology, and the measurement for insurance has been included from 2006. But I want to point out that previously, up to 2021, the coverage was small on the issues to do with the insurance. So the coverage was expanded in 2021, and mostly that is where my presentation is going to focus on. What does it mean? So does it mean that we've not been measuring the insurance development, as given that FinAccess has not given much depth from the previous surveys? No. We've been measuring the development of insurance and over time, and we use 4 key indicators that are globally used so that we can be able even to compare with other markets. So we have insurance penetration, insurance density, insurance coverage that is defined as lives of a population, and then policies of a population. How has the industry performed from 2014? We can see that insurance density has been growing while insurance penetration has been going down. Insurance penetration is the contribution of insurance to GDP, in which we take the total premiums divided by the GDP. So we see that it has been declining. However, I want to point out that insurance premiums have been growing. So what does it mean that penetration has been going down? Among other issues, it could mean that the economy is growing faster than the insurance premiums are growing. The others, the researchers in the room can find out. Insurance density is the insurance per capita, in which it is the proportion of the total population to the total premiums. And we see that it has been growing. Insurance coverage, which is lives of a population, we see it has also been growing. It slightly declined in 2021, probably because of COVID, but we need to do more investigation to find out why that was the case. The same applies to total policies over the total population. We see that it also declined in 2021. That is what we have from data, industry data on insurance. So what about the FinAccess survey? We see that from the FinAccess survey from 2006 to 2019, we were looking at two dimensions, access and usage. In 2021, they increased to 4. What about the classification of access? Again, the reason I'm putting these classifications here, as much as they are defined in the FinAccess report, is because I'll make reference to them in the presentation. So I'm going to make this classification in relation to insurance, whereby we have formal prudential, which is basically about insurance that is regulated and supervised mainly by IRA. And so in terms of access, we look at insurance companies and insurance intermediaries. Then we have non-prudential, basically that is subject to non-prudential regulation. That is where NHIF falls. Then we have formal registered institutions like SACCO. We have specific definitions for the same, like in insurance. What did we find out, or what can we learn from the FinAccess survey as far as the insurance is concerned? The survey shows that the population accessing formal financial services has been increasing while the excluded is decreasing. Is that true for insurance? What we see is that the population accessing formal insurance is also growing. However, the excluded population remains high compared to the other financial services, especially banking. In terms of managing risk, we find that people have got their own informal mechanisms of managing risks. But do we have the depth and the prevalence of those other forms that they have? That information is important in terms of informing policy, because you find markets like South Africa, they have found a way of mainstreaming informal types of insurance into formal insurance, and that is why you find their insurance market is much bigger compared to the Kenyan market. Again, from the FinAccess survey, we see we have insurance, including NHIF. We see that the usage declined slightly in 2021. Again, from the survey, this could be attributed to the impact of COVID. we still look at usage of insurance compared to the other financial instruments. In this chart, there's this insurance regulated by IRA and NHIF has been separated, whereby we see that NHIF usage slightly declined, while usage of the regulated insurance services increased. Again, a question I would like to pose to the policymakers and the researchers. When you look at this chart, NHIF is the National Insurance Fund. It is insurance. Then we also have insurance regulated by IRA. Are they not insurance? When we are measuring insurance, why should we separate? Why is it important? Or should we look at them as one? We also established that from the survey that usage of insurance differs by region in terms of residents, rural, urban, whereby we found out that urban usage is higher compared to rural, meaning the rural people are excluded from insurance usage. In terms of education, the higher the level of education, the higher the level of insurance usage. What does that mean? Sorry, I'm going back. Then in terms of access by policy type, this is still from the FinAccess. We see that the data is categorized as the policy is owned by oneself in own name, or it is the person jointly owns in insurance with another person, or the insurance in someone else's name. In this chart, what we see depends on the type of insurance someone has. For example, we see like crop insurance, majority of the people have it in their own name. While for crop or life insurance, it differs. We see in 2021, owned in someone's name declined for livestock insurance. So what does this chart tell us in terms of policy and in terms of interventions? So what are the barriers to insurance usage, or why is it that people don't have insurance? Because we've seen from the data that only 6.9% of the Kenyan population is using insurance. So what are some of the reasons? The key of the reasons is that most people can't afford. They would want to have insurance, but they cannot afford. Then we also have people saying that they do not know about insurance. So what does this chart mean? Someone wants to buy insurance, but they cannot afford. Is that true? Can we make a policy decision based on this? I think on our part, what we are doing as the authority is that we want to understand more, and that more we could not get from this survey, because if something is important to you, you will surely purchase it. Because some of us purchase very expensive items, but we don't think that it is important to take insurance for those items, because the moment you lose, then you go back to where you began. And in terms of paying for insurance, we see most people pay through the employer and mobile money. Through the employer, probably these are people who are covered by the employers. So we see that mobile money is at least driving insurance usage. Where do people get financial advice? Most people are advised by family and friends, and some don't, just make their own decisions. So we see that media and advertisement, the number of people, the proportion of people who depend on media and advertisement and other forms of advice is low. So in terms of the decisions we make, like at the institutional level, sometimes we spend a lot of money in advertisements, but what we are seeing from this survey, that most people don't rely on advertisement, or if we are going to advertise, how do we need to package so that it speaks to the people and so that it resonates with them, considering that they listen to family and friends. This is still the same, but now by gender we see there is a differentiation between male and female on how they get financial advice. This information is important because you can see that most females depend on family and friends, while males depend on themselves when it comes to financial advice. So we've looked at just a few of the findings from the FinAccess survey, because we were advised that this presentation should be brief. So that is a snapshot of what we found out from the FinAccess survey. We have also looked at our internal data from the financial industry data that we receive, which we've analyzed. So in terms of inclusion, what does it mean then? Based on the findings, it means that we need to continue critically thinking about tracking access to insurance across a range of dimensions. Then this has been important and it will continue being important. The other thing that the FinAccess survey has done in terms of the findings to inform what the authority is doing, among other information that we've received and combined with the FinAccess. Remember, FinAccess is the only data that we've had that captures information from the entire country. As the authority, we've not been able to do a survey to that magnitude because of the cost. So based on the FinAccess survey findings in terms of inclusion, we've been able to develop microinsurance framework, social insurance framework, and crop and livestock insurance framework. All these are aimed at improving or enhancing access to insurance. Because from the survey, when you do deep analysis, you find that most people are excluded and they are the low-income people, so microinsurance is expected, for example, to address that. Then what this has done, because you cannot regulate without the requisite powers given in the Insurance Act, so what we've done is that the Insurance Act then has been revised so that it's possible to regulate, for example, microinsurance. Social insurance framework is something that is ongoing, and to change the Insurance Act is through a memorandum to the National Treasury. So you can see the FinAccess survey has been useful and will continue to be. So what are the gaps in the survey? As I said earlier, from 2006 to 13 or 15? 19. The coverage on insurance issues was so small, but the same was expanded in 2021. However, we still need more granular information or data in terms of access, usage, impact, and welfare as far as insurance is concerned, so that then we can be able to make more policies or understand the industry better. We also need granular information on microinsurance and agricultural insurance. At the same time, we need to have customized parameters to measure access to insurance. If you look at the FinAccess survey, the definition of access is more skewed to banking. So when we come to insurance access, what does it really mean? We need to come up with customized parameters so that we can be able to measure insurance access. Then in the survey, we also find that we are trying to separate NHIF and private insurance. So what is insurance? We need to come up with a clear definition when we are doing surveys what insurance is, because the role of insurance in the economy is the same. The role NHIF plays to the economy and the role these other private insurance, the way we've categorized, is the same. So we need to consider measuring it as one so that we can understand the contribution of insurance to economic growth or to financial inclusion. Having said that, what is the way forward? We intend to do deep dive studies to inform policy and decision making. We need more data. We also need to subject the data that we already have to further analysis so that then we can be able to get more insights and even be able to get more research areas to understand where gaps are so that we can make informed decisions. With this, I say thank you and I hand over to Tabitha.
Thank you, Teresa. Let us give her another round of applause. We are going to the last presenter, that is from the central banker, Cyrus Mugo, an economist at the Kenya Central Bank. This is the last presentation, so we will try and be done with the discussions by 4:30 so that, yeah, thank you.
Good evening. I'll take a little bit of your time, maximum 10 minutes. I won't stay for long, I promise. So for me, I'll talk about the relevance of disaggregated supply-side data in driving financial inclusion. So firstly, I want to say what is supply-side data. First, financial inclusion refers to the state in which all working-age adults have effective access to credit, savings, payments, and insurance from financial service providers. So supply-side data are data collected from financial service providers, which are banks, cooperatives, microfinance institutions, and other financial institutions, which now we have chamas, we have insurance, we have pensions. And supply-side data is gotten in a regular basis. It's collected in regular intervals. Like for banks, we collect it on a monthly basis. For insurance and pensions, I believe it's on a quarterly basis. And then for cooperatives, for deposit-taking cooperatives, it's on a monthly basis. So the regular intervals we get on the supply-side data is quite high. So supply-side data mostly capture organizations that report to financial regulators, thus leaving an important sources of financial services, especially the informal finance, upon which large numbers of poor and low income count on. From the FinAccess data, we see that 4.7% of the population, they still depend on informal lenders. But is 4.7 small? It's still big considering the population that we have. So we cannot assume, us as the regulators, the data that we have, we still have to do more to capture the unregulated entities. So what data can we get from the financial providers? So the providers of financial services, the supply side, they track the services they deliver as a basic function of their business. The data often include total number of loans, savings accounts, including volumes of the loans and deposits. They may also include detailed data on types of products that they offer, as well as point of service, which could be number of branches, mobile banking penetration, etc. In some cases, there may be client data, which could be number of individuals, number of farms, location, gender, income levels, and other data identified in different market segments. But the question you might ask yourself, why, when you go to the central bank website, you get the data, it's not broken down into these further categories like gender, location, income levels. But it's because of the standard templates that we do offer to banks. These standard templates are mostly concerned on financial stability and monetary aggregates. So, but we have to be alive that there are different data metrics that have come in terms of measuring financial inclusion. So these different data dimensions will need to be enhanced in terms of data collection of the supply side data from the various regulators. So why do we need the disaggregated data? The disaggregation of the data provides deeper understanding of a situation or to clarify underlying trends and patterns. Data may be grouped in different dimensions, which could be age, sex, geographic area, education, ethnicity, disability, social status, or other social economic variables. There is also significant momentum behind the assumption that better and more consistent and increasingly disaggregated data are critical for decision making and progress tracking in extending access to financial services. Now, what are the new initiatives or insights in data collection, especially from the central bank side? So, new data initiatives have emerged to better offer more meaningful supply-side data. With the recently launched Enterprise Data Warehouse by the central bank, which envisions granular data from supervised financial institutions, it presents new supply data dimensions. So these data dimensions include gender, demographic, county, economic sectors, business segments, tenure, and economic activities. The data currently, as banks might attest to this, they report on an aggregate basis. So they collect all the data from the branches to the head office and send an aggregate level to the central bank. But now that will change because now we'll need also from the branch level. So from the branch level data, we'll be able to do a geographic location, and we can tell the county how much deposits are in a county, how much loans are in a county, how much access the gender in a county, and also the business segments advanced to the loans in a county. So we are going further and disaggregating the data further up to the county level, and also to customer information, which will now be broad and encompass the economic sector of the gender, and also the residency, which now banks will be able to classify if they're working with a non-resident or residents using the various criteria that we'll provide to them. So in terms of mobile money payments, we'll also approaching the mobile money operators to also encompass approaching the county perspective, and also do a geo-mapping for their reporting. Also will be per county, and we'll be able to get this data on a frequent basis, on a regular basis. Now, granular data on loans and deposits provide regulators a better view in understanding the trends, identifying the risks, and making evidence-based policies. So questions like, are loans advanced to male or female? This we can get now from the data going forward as soon as we launch the Granular Data Initiative, which is coming with the EDW, where the Enterprise Data Warehouse. And then you'll be able to take what is the uptake of loans in county, maybe in Bungoma, maybe in Kwale. All this, you can be able to get it now easily, and what sector economic activity are the loans mainly advanced to, what defaults on loans, or who defaults on loans. I heard this yesterday, one of the presenters saying that female default more than the male. So we'll be able to get from the data itself, straight from the bank. You can also be telling who defaults more and what demographic are loans advanced to. Is it the younger generation or the older generation? So this is a new aspect in terms of data collection. And also in terms of deposit mobilization, we can also tell by county, and also in terms of who is being advanced more. Is it the male being advanced more vis-a-vis the female? What are the volume of deposits for maybe non-financial corporations? These are the private enterprises vis-a-vis the households. So this data, the supply side data, will complement the demand side data. So the demand side data, as we know, we usually collected the FinAccess survey that was done, it was 2021. But what about 2022? What is the current situation in 2022? So those are the questions that we need to ask ourselves. So the supply side data needs to complement the demand side. The supply side data need to complement the demand side data. So having regular intervals of the data will help policymakers to look for gaps, establish priorities, and monitor change over time. Analysis of granular data can also help can find new correlations to spot financial inclusion trends, and disaggregated data will help ease policy monitoring. The demand side data surveys, like I said before, are conducted to 2 to 3 years, but with supply side data, this can be done on a weekly basis, monthly, or quarterly. We envision to start granular data on a weekly basis, so you can imagine having all this data on a weekly basis and doing some analysis on it, and also on a monthly and quarterly. So it will be better for policymakers and also for policy monitoring of this type of data. So what are the other initiatives that are being done in terms, especially in capturing unregulated financial entities? We have a technical working group with regulators, which we call the Monitoring Financial Statistics Technical Working Group, that has a work plan in terms of capturing the unregulated financial entities. We cannot assume the 4.7% it's too small. For us, we have to capture all the chamas, if you want, the chamas, the Shylocks, all these we need to bring them on board. So how we do it, we have a work plan with the technical working group, and it's been implemented step by step. But a point of success, the central bank is already capturing the digital credit providers, which is at step forward. So we're also encouraging the full adoption of the international standards, such as the compilation of system of national accounts, and also the international sector standard industrial classification of all economic activities, which is ISIC revision 4. So with this, it will give us all the disaggregated data in terms of economic activities, and also in the system of national accounts, we'll be able to classify the various customers with the banks and also the supervised financial institutions. And as I promised, I was very short and straight to the point. Thank you.
Thank you, Cyrus. I think we have had the 5 presentations from the regulators. It's a time to engage in some discussions or questions and answers. So I invite questions. I don't know if you have the mic or microphones going around. I can ask the presenters to come forward so it is easier. Please, Teresa, Wilberforce, Cyrus, and Bichangi. Unfortunately, RBA representative is not available at the moment, but we can have your questions. Then you can forward them to them. But we invite questions to this on this what has been presented, and any other questions relevant to financial inclusion that you would want to ask in terms of regulation and policy. Yes. So give your name and the institution probably you are coming from, then I ask your question.
This is Amrit Haya from FSD Kenya. I have 2 questions. A very short one for Cyrus, which I think it's a fantastic initiative to be really focusing on disaggregating data at the supply side level, because that's a big gap in our understanding of financial inclusion and other economic indicators. And so I guess my question to you is how and when will the CBK be able to make that kind of data available as a data aggregator? We'll be able to make that data available to the market, because I think it would be tremendously valuable. Second question, again to Kenneth actually. I was just curious about the SACCOs, because since the opening, I mean, SACCOs started as a mutual financial institution which kind of are able to sort of leverage in-depth information about their members, you know, based on sort of some sort of a common livelihood or economic situation. So I'm wondering, since the opening of the common bond, how has the quality and nature of the sort of financing that SACCOs offer changed in terms of the outcomes of that financing? What has been really the impact of opening the common bond in terms of what SACCOs are able to deliver for their members? Thank you.
Thank you, Amrik. Yes, you can have another round of questions, then we take...
Okay, I am Adan Shibia. I'm from Kipra. Just a few questions or comment. The first one to RBA, that's to Ben Kipanga. I think one of the issue, what from the presentation, the data shows that issues of awareness as well as how to join a pension institution is some of the key concerns. So, what innovative ways can be used to reach those rural population? I think in the presentation you have indicated, you know, like the mainstream media, but some of the rural areas that may not be, could still be a challenge. So what, perhaps, I think we need to think in terms of what are the very innovative ways of reaching those in the rural areas. And perhaps related to that is, you know, pension is a kind aspect of the mindset. You work, you retire, you depend on the pensions. Yeah, so those outside the formal, how do we handle those issues of the mindset? Then for the SASRA, to Kenneth, very good initiative to come up with the complaints management guideline. I think that will be very key in terms of addressing some of the challenges, issues of you know, those conduct issues. So I think what is not clear is how is the public, what measures are being undertaken to sensitize public on the availability of these complaints management intervention, such that we're able to see that people know that if there are concerns, they can report, and the mechanisms of reporting. Then on the insurance, I think I will agree that more disaggregated analysis is key, especially on aspects of, on the different categories of products, including particularly those related to weather-related shocks. Yeah, so I think that is key, and I think the presenter has also mentioned that in the way forward. Yeah. But perhaps I think we wanted to see perhaps supporting this FinAccess with the data that you have. You know, looking at some trends, I think should have been a bit more insightful in terms of providing some complementary insights. Yes, then finally, for the CBK, that's for Cyrus, again, a very good initiative in terms of collection and analysis of supply side data. So I don't know whether the regulated financial institutions, the way they already capture data is already sufficient to meet that vision of giving us that data from the supply side. So yeah, so related to that, what is the engagement with the regulated financial institutions? Thank you.
Okay, thank you. We have two questions here. So we'll take the two, then you can allow the presenters to respond.
Thank you for the presenters. I am Dr. Nyaga, Mount Kenya University. I have two questions, one from the CMA, Authority, CBK. But I'm going to write on the previous questionnaire relating to the supply side data. Let's appreciate that this source of supply is being regulated. And they have the fear to be realized that they are not complying. To what extent is the CBK going to ensure that this data is away from manipulation? To the CMA, you talked about the products, the shares, the bonds, the swaps. I'm more particular to the swaps. Which sector is capturing authority or much attention to the applications of swaps as well as derivatives? Thank you.
Thank you.
Good afternoon. My name is Rose Masibili from Mount Kenya University. I just have one question directed to the CMA. Attention is just drawn to the products that we were going through during the discussion. And there is one that has really gained popularity, the unit trusts. I just wanted you to shed some light on them. Would we look at it as a form of enhancing financial inclusion, especially maybe among the youth, because currently there are firms that are really trying to look at it as an alternative from saving in the banks and maybe the interest rates and the time of withdrawal. But at the same time, are there any risks with the unit trust as a product? Yeah.
So thank you. Let us allow the presenter to respond. So we can start from this end with the central bank.
Yeah, thank you for your questions. I'll begin with the question from FSD. When will the data be available? So currently we are in engagements with the pilot institutions. So as soon as we finish with the pilot institutions, we can have a definite timeline on when to roll out. But currently I cannot give a definite timeline, but we are already in engagement with pilot institutions. So I'll go next to Kipra. There was a question on how much regulated financial institutions, the info collected, and what is the engagement with the regulated entities. So the engagement, as I've said, we have already begun engagement. We had all the bank's representatives a while back, told them on the initiative that how the data needs to be collected in terms of the granular data. And I can say it was very receptive. They were very okay with it. And so I can say the engagement with the regulated entities is quite receptive. On the Mount Kenya University, the question on data manipulation. The way the GDI or the Granular Data Initiative is structured is such that we are moving away from filling of forms or filling of templates. So it will be system to system talking to each other. So in terms of manual entries or manual manipulation, it will not be there. I'm not an IT guy, so I'll not give you the specifics of how they're doing it, but it's system to system, so there'll be no reporting forms back and forth. So banks, also the next question was banks, if banks are receptive, and I can say, again, banks are well receptive with the initiative.
Thank you. I think I have two questions from Amrik and one question from Shibia. I think I'll start from Amrik here, FSD Kenya. Thank you for your question. One is, and I'll give examples in terms of the nature of services that they are currently offering after opening the common bond. One of the things is that, and I'll be very honest here, is that most SACCOs, when they were opening the common bond, they were never prepared on the things that they are going to find out there. They thought it's just bringing in members and you give them the conventional services, not knowing that the new members who are coming in come in with their unique nature of needs. It therefore calls that an institution has to come up with products which are geared towards the needs of the unique members that you are incorporating. Now, I'll give you an example. I once went to a SACCO somewhere in Western. For purposes of confidentiality, I'll not give you the name. But one incident caught my eye, and they had come up with a product, MSME product, which they were giving out to local business persons. And one of the things they did was that this gentleman brought in a title, a security for the facility he had gotten from the SACCO. Now, what these guys did is that they took the certificate, the title, instead of going through the normal process of perfecting the security, so that should you have any other person going for another facility, you'll not get using the same. Now, what these guys did is that they took the certificate and went and locked it in their safe. That is a perfection. So you can tell where they were coming from. There was a challenge. Now, apparently, this client was knew that he's not going to service the loan. So what did he do? He left them the paper, and the guy migrated to Uganda with the money. So when you go and find this facility is not performing, so you ask the hard questions. So what security were you given for this facility? And they bring, they're very confident, they bring the certificate. But when you look at it, you find that this title was never perfected, meaning that their processes in the first case were not right. So now what we are currently doing, we realize that is a gap that was open. Any new products that is being introduced, it is a requirement that they must bring to us for approval before they can roll out. And they must give a case that this is something that, give us a case, proof of concept that this is something that is going to work out there. Yes, so again, that was a challenge that institutions have had. Of course, we've had some who have been very successful. One case I'll give in point is one in Mombasa, which has come up with products geared towards the local community, and they are doing quite well, and they are doing good business. So yes, there are those that have succeeded, and there are those that have burnt their fingers. That is the truth. That's the bottom line. The second question is about the impact that these products have had. One thing I'll have to admit here is that it's something that when I came in, I've kept on thinking about, and I thought that it is important for us to come up with mechanisms of measuring the impact of the products that are being given out there, because as we approve, and that is it. But I think it is necessary for us, so it's a good point, it's something that we're going to look at so that we also measure, apart from just approving, what is it that we can do so that we are able to measure the impact that is having on livelihoods. Fine, yes, there are impacts out there in terms of people who have been transformed by virtue of the facilities that they have been getting. But again, the question is, you ask that question to a regulator and we don't have the documentations, then it means there is a gap. So it's something, yes, good. Thank you for the good question. I'll be able to take it up and then come up with a process so that next time when it arises, when we are talking about impact, as we saw from the FinAccess data, we can be able to give you data and justify and say this is what has happened to the livelihoods of people. And thank you very much. The other question was from Shibia from Kipra about the complaints management guideline. Yes, we did. We see that is ideally a supply-side approach in terms of what institutions are supposed to be doing. So we gave it to institutions. They're supposed to establish a desk, a complaints desk. But again, for us as the regulator, what we do is we do go out to educate members during member education days, and we bring out some of the issues that we've done. One of them is the issue of complaints, that should they be having challenges with their institutions, they have a right of complaining directly to us, and then we make a follow-up. We've already developed a portal where they lodge their complaints, and then we have people who are in charge who normally take up those issues. Of course, at times it has not been quite fast. I think it's something that we'll need to look at in terms of moving forward. And then, of course, there is the issue of visibility. I will definitely, again, be very honest here, is that in terms of visibility, we have also not been very good in terms of visibility. And one of the things we have done is that we've come up with a number of approaches in our current strategic plan, the new one because the current one is ending in December, so that we try and work on our visibility. And some of the things that we are planning to do are, say, road shows, where we go out there and meet the general public and tell them the services that are available in our circles, what is it that they can be able to do, and when they have issues, they can be able to approach. Because one thing I'll tell you, we did develop the portal, yes, but how many people get there to lodge their complaints? Again, that is an issue. When you look at the numbers in terms of complaints that we receive, the numbers are very small. We are talking about a membership of 5.9 million. So if you are receiving complaints of about 100, I think that is a question of something that we seriously needs to be done in terms of our visibility. The other issue is, of course, we do quite often issue press releases, of course, and this entails institutions when they're having challenges. But I think from a positive side, that's a good point. I think it's something that we'll need to work on, so that moving forward, we try and incorporate the larger public, because we know they're the ones who are accessing these services for the better of the SACCO subsector. I hope I've answered the two questions comprehensively. Thank you very much.
Thank you. I'll have two questions, one from Mount Kenya and the other one on unit trusts. First of all, I'll start with the swaps. The swap as a product, capital market product in Kenya is not yet, has not taken off, but I understand you have bilateral, within the banking sector, you have bilateral contracts that work. But I believe as our market grows, our system grows, we'll eventually end up having that market. And for the derivatives, we have a derivatives market that is currently operational, but is still young. And I believe as we progress, the market will eventually pick up. When it comes to the mutual funds or unit trusts, they exist in Kenya, and one of the important, at least good observations we've had is, as much as the uptake of shares and bonds going down, we have observed a trend that the uptake of unit trusts, that is assets under management by these funds, has grown exponentially. So it is debatable to say that capital markets uptake is going down generally, because if you take into account the growth that has happened, especially on this front, it negates that. And as the authority, we encourage especially retail investors to invest through these mutual trusts, regulated mutual trust unit funds, because they are professionally managed, and therefore the retail investor going through them doesn't have the burden of having to be savvy. So it's a good investment avenue, and it's important for especially the retail investor to take in through that, because they are well regulated, and the returns, looking at the returns from these, going by the trends, the returns have also been very attractive. And in terms of deciding whether inclusion of these retail assets under management or these mutual funds into the financial inclusion, I think that's something that we'll need to look at in terms of how we define our financial inclusion, because I also understand when you are looking at the mobile money, M-Pesas and etc., they still have some, it's not clear whether some aspects are really inclusion or not. Therefore, we need to just go back to the basics and see whether participating or investing in mutual funds, does it make you an investor included or not? But what's important that we have the data and we have the trends, and therefore once the definitions are agreed on, it's just a question of relooking at it and including or not including. And just the same way as we have said before, that as we include the non-banking sector within this space, as we bring on SACCOs, capital markets, and etc., we'll really have to look at some of these issues so that as we move ahead, we define maybe our inclusion to include some of these products or not. Thank you.
So thank you for your comments. I think we can still engage tomorrow, and also, of course, online. We ask the online participants to also send in their comments or questions, and they can be addressed online. I think we have come to the end. We have come to the end of today's sessions. I want to thank you all for participating, and the ones that are online, thank you so much. We hope to see you or have you join us tomorrow, and also the ones that are here for the live event. Thank you so much for coming. So tomorrow will be our third day, and I invite you all to join us. Tomorrow we'll be looking at how the financial inclusion journey has been value adding, the issue of climate and environment risk and financial inclusion, and whether the financial sector is serving women. So thank you so much, and I wish to close here and say thank you very much.